Yes, guys, am I being audible? Good morning, good morning. Okay, I hope I'm being audible. Yes, okay. Yes, how about the Google Meet folks? Am I being audible? Yeah, okay, great, superb. And yes, the YouTube folks, the YouTube live folks, am I being audible, guys? Yes, okay, 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 perfect, perfect. Great, guys, great. So, shall we begin? Shall we begin? Yes, perfect. Humble request to all the Google Meet folks, please keep your videos, please keep your camera turned on. That's the whole objective of a Google Meet and a YouTube live. Else I would have just kept the YouTube live only. So yeah, humble request from my side. If you're attending the session on Google Meet, I just request you to keep your cameras turned on so that it can be interactive. That's the entire purpose of having two platforms here. Okay, guys, let's start. Hey folks, welcome you all to a new session. This is CA Ganesh Bharadwaj, and now we are in the day 2 or the part 2 of this costing revision series. Now, in this part 2, we are going to learn two chapters. We are going to basically revise two chapters. One is marginal costing, the other one is process costing. These two are supposedly the most important chapters, or two of the most important chapters in our entire syllabus, costing syllabus. And out of this, marginal costing is slightly the biggest chapter of all. So that's why I am starting off this day with marginal costing, so that let's finish it off properly and then we'll move on to the next one. Clear? So that is going to be the agenda for this part 2 of this costing revision series. Now this particular part 2 itself is going to contribute somewhere around 20 to 25 marks in your exams, right? Now the most important part that we are going to do here is as I told you guys earlier in the day 1 as well, marginal costing is the biggest of all chapters in our regular batch. I think about 25 hours approximately, if I'm not wrong. So here in this revision batch, obviously we can't cover all those, the entire number of sums that we did and all in our regular batch, and of course we can't completely do all the concepts. But yes, I have designed this particular revision module in such a way that we are going to touch upon all the important concepts. Predominantly all the concepts will be covered in this particular chapter, right? So the coverage will be as follows. I have just branched this chapter into 3. The first one is the basics, right? And then we have the cost volume profit analysis. I will tell you what all fits into this category. And then finally we have a particular segment called as absorption costing versus marginal costing. So I have just classified this chapter into 3 for the purpose of revision, so that it will be easy for us to recapitulate the entire discussion, right? Clear with this? Fine. So in this CVP analysis, right? CVP stands for cost volume profit analysis. It's another name for marginal costing. So we will be learning about the concepts of contribution, PV ratio, break-even point, cash break-even point, margin of safety, the CVP pairs, or as I call it, CVP jodis, right? Or the CVP couples, whatever it is. Then the break-even chart, the profit volume chart, sales mix, merger of plants, sensitivity analysis, indifference point, shutdown point, and key factor analysis. That's your limiting factor analysis. So we will be touching upon all these areas, and of course we will also be doing some numerical problems. This is what I have planned, and this will be done in such a way that it's going to be a very effective revision, because as of now I've not done a revision, or my revision video on marginal costing is not there anywhere on YouTube. So I thought, let me give a very holistic coverage of this entire chapter, despite the fact that it's going to be a revision, but let's revise almost the entire chapter. This is going to be the objective. So my humble request to you guys is please participate then and there. Use the chat box and just participate. It's going to enhance your learning experience for sure. Catch up running notes. And for those who are going to watch this later on a recorded mode, right, you also participate as if I'm standing in front of you and doing this revision, so that it will definitely enhance your learning experience. Clear with this, guys, right? And trust me, this revision is definitely going to step up your preparation with respect to this particular chapters that we're going to do today for sure, right? That to that extent I can definitely give you a commitment. Now shall we get started, guys? Shall we get started? Right, fine. Now this chapter, marginal costing, first let us get started with the basics. And for the purpose of getting into the basics of this chapter, let me take a numerical example. Now let us say that the selling price is rupees 10 per unit, the variable cost is rupees 6 per unit, the fixed cost is rupees 10,000, right, in total, and the sales volume, let us say is 6,000 units. Let us say is 6,000 units, right? Now with this, let us try to prepare a marginal costing income statement, right? Let us revise what is the concept of PV ratio, a concept called as break-even point, a concept called as margin of safety, and of course we will also try to calculate the profit. These are the 5 things that we are going to see using this particular example. By the way, before you start any chapter, you should know what is the objective that particular chapter is going to help us achieve. This chapter completely revolves around the objective of decision making, which means this chapter needs to be looked at from the perspective of variable cost and fixed cost. So in this chapter, the cost classification will be from the perspective of variable cost and fixed cost. Clear with this, guys? Right. And there is only one concept in this entire chapter that deals with the objective of stock valuation and profit computation. That is the segment C of this particular chapter, which is absorption costing versus marginal costing. That is the only segment in this chapter that deals with stock valuation and profit computation. What it is, I will be doing it. I will walk you through at the time when we are entering into the segment C. But till then, predominantly about 95% of the chapter, all the other concepts of this chapter revolves around the concept of division making, wherein the cost classification will be strictly from the perspective of fixed cost and variable cost. Clear with this, guys? Now, how does the marginal costing income statement looks like? So the first one is the marginal costing income statement, right? So the marginal costing income statement goes as follows. First, you'll be having sales minus variable cost, gives you something called as contribution, minus fixed costs, finally gives you something called as profit. Now we all know that variable cost makes sense only when it is represented on a per unit level, whereas fixed cost makes sense only when it is represented in total. Why? Because that is the cost behavior pattern of variable and fixed cost. Variable cost, an example would be your material cost, correct? So only if I produce the next unit, this variable cost will be incurred, whereas that is not the case with fixed cost. An example of fixed cost could be your factory rent, right? So in your fixed cost, irrespective of your output level, this 10,000 rupees will always be incurred. You cannot do anything about it. Clear with this, guys? Clear with this, guys? So marginal costing income statement says that, it is better if you present your income statement as sales minus variable cost, that gives you something called as contribution, minus fixed cost, that gives you something called as profit. Sir, why, sir? Rather, I could say sales minus total cost. When I say total cost, it's variable plus fixed, directly gives me profit. Why are you having one speed breaker in between called as contribution, and from there once again you're reducing fixed cost and arriving at a profit? This manner of presentation will enhance your level of decision making. Sir, how? Fine. First, let me just walk you through the statement, and once we are through with this, we will be having a lot of clarity as to how this helps us in our decision making objective. Now, first, guys, now in this case, every time I sell a unit, what is the revenue that I get? I get 10 rupees, right? And every time I sell a unit, I also incur 6 rupees variably, which can be tracked on a per unit level, correct? So every time I sell a unit, I earn 10 rupees, and every time I sell a unit, I need to spend 6 rupees. So technically speaking, this 4 rupees is my variable profit. I can track this profit on a per unit level, correct? Now, is this my final profit? No. Why? Because my fixed cost is yet to be adjusted. So the variable profit is only called as contribution. Clear with this, guys, right? Why is it called as contribution? Wait, I will come to that. The name, the reason for the name, the logic for the name. Now, in this case, you tell me the company has sold 6,000 units. Each of the unit has given them a revenue of 10 rupees. So basically, the sales is going to be 6,000 units into 10 rupees. That's going to be 60,000, right? Now, the variable cost will be, they have sold 6,000 units and each of the unit had a variable cost of 6 rupees. That's going to be 36,000, right? Now, if you do this, you get a variable profit of how much? You can even calculate this, 6,000 units into 4, that gives you 24,000. Now, how much is your fixed cost? Your fixed cost is going to be 10,000 rupees. So technically, you are left with a profit of how much? 14,000 rupees. Now, sir, why is this variable profit called as contribution? Simple. Now, I earn a variable profit of 24,000 rupees, that is called as contribution, right? Now, from this contribution, first I try to recover whatever fixed cost I have actually incurred, and whatever is earned over and above recovering my fixed cost is called as my profit. Or in other words, this variable profit contributes first towards recovery of my fixed cost and then towards generating my profit. Since it contributes towards two things, that is recovery of fixed cost and the generation of profit, they are using the word called as contribution. Are you clear with this? Right? This is the reason why instead of using the word variable profit, they are using the word contribution. Clear with this, guys? Clear with this, guys? Now, using this marginal costing income statement only, the other concepts like PV ratio, break-even point, margin of safety, and all of these are actually developed, and these are actually very much useful for us to take meaningful decisions. We will be seeing that. First, are you guys clear with the marginal costing income statement right now? Sales minus variable cost gives you contribution, minus fixed cost gives you profit. Now, this is the most important thing that you need to know throughout the chapter, because for every single sum that you are going to do, this marginal costing income statement is the base from which you need to enter into any kind of numerical problems in this chapter. Clear with this, guys? And are you all able to understand the logic for this income statement? Right? Fine. So now let's move on to the second one, B. Let's move on to the second one, B. Now, what have they asked for? They've asked for the PV ratio. Now, here we have sales minus variable cost gives you contribution, right? Now, on a per unit level, what is the sale? Or in other words, my selling price is 10 rupees. And on a per unit level, what is my variable cost? My variable cost is 6 rupees. And on a per unit level, what is the contribution? Also known as the variable profit, to put it in layman words. So that is going to be 4 rupees, correct? Now, in terms of total value, that is for 6,000 units, what is going to be my total sales? My total sales is going to be 60,000 rupees. My total variable cost is going to be 36,000 rupees. And my total contribution is going to be 24,000 rupees. Agreeing with me on this or not? Guys, yes, right? Now, what did I do? Very simple. On a per unit level, I generate a revenue of 10 rupees. I incur a variable cost of 6 and I make a variable profit known as contribution. From now on, I will be using the word only as contribution. I earn a contribution of 4 rupees. Now, for any kind of output level, I just need to multiply each of these three figures with the volume. In this case, 6,000. So for any volume level, I can find out the total sales, the total variable cost and total contribution. Agreeing with me on this, guys, right? Now, if I say that, if I want to express all these things as a percentage by keeping my sales as 100, right? That is, if I want to express my variable cost as a percentage of my sales. Now, variable cost expressed as a percentage of sales is how much, right? If I generate a revenue of 10 rupees, I know that I will be incurring a variable cost of 6 rupees. Or in other words, can I say my variable cost ratio is 60 percentage? Agreeing with me on this or not? That is, every time you generate a revenue of 100 rupees, 60 rupees is your variable cost, correct? Yes. So the variable cost can be represented both on a per unit level as well as a percentage expression. Agreeing with me on this? Similarly, contribution also move proportionately only. So can I say every time I generate sales worth 10 rupees, I am earning a contribution of 4 rupees. Or in other words, contribution can also be expressed as a percentage of sales. Now that percentage in this case is going to be how much? 40%. Agreeing with me on this or not? Right? This 60 percentage is called as VC ratio, variable cost ratio, and this 40 percentage is called as PV ratio, profit volume ratio. Are you clear with this? Sir, how is this profit? I told you contribution is nothing but variable profit. Are you clear with this, guys? So when they say PV ratio, it is nothing but contribution expressed as a percentage of sale. Are you clear with this, guys? Yes, you guys are all clear with this, right? Fine. So now, why do we use this expression? If I want, I can track my variable profit on a per unit level, or if I want, I can track my variable profit, that is my contribution, as a percentage level. Every time I sell a unit, I will earn 4 rupees of contribution. Or I can say, if I generate sales worth 100 rupees, I will make a variable profit of 40 rupees. Correct? Suppose they are saying, this year I'm planning to earn generate a revenue of 1 lakh rupees. In that case, 1 lakh into 40%. So 40,000 rupees is going to be your contribution. Directly we can arrive at the figures. Are you clear with this? So if the sales is given in the units, you can multiply it with contribution per unit to arrive at the total contribution. Or if the sale is expressed in value, you multiply that with PV ratio to arrive at the same contribution value. Are you clear with this, guys? These are all multiple ways of doing it. These are all multiple ways of arriving at the figures. Are you all clear with this? Are you all clear with this? Right? Next. So now your PV ratio is done. Now let's move on to the next one. So what is the other one? Yes, your break-even point. So now the next concept is called as break-even point. Now what do you mean by a break-even point? The break-even point is a point where I exactly make a profit of 0. That is, it is a point of sale at which there is no profit, no loss. Are you clear with this, guys? It is a point of sale where there is no profit, no loss, right? Now in this case, in our example, when will we be having a no profit, no loss? Can I say when my sales, total sales is exactly equal to my total cost, there will be a no profit, no loss. Agreeing with me on this? Right? Or can I say when my contribution is just sufficient to recover my fixed cost, that is when my profit will be 0. Agreeing with me on this or not? Guys, are you all clear with this? That is, when I earn a contribution that is exactly sufficient to recover my entire fixed cost, right? Then the point of sale at which my contribution is equal to my fixed cost is called as my break-even point. Now this contribution should not be more than your fixed cost. In that case, you will be starting to earn a profit. It should also not be less than your fixed cost. That will be a loss scenario. Your contribution earned should be exactly equal to the fixed cost. The point of sale at which my contribution is exactly equal to my fixed cost is called as my break-even point. Are you clear with this, guys? Are you clear with this? Now, guys, please do not mug up any formulas, right? Mark my words, there is not even a single formula that needs to be mugged up here. Everything is absolutely logical. Spend some little time and you are done. That's about it, right? So now in this case of break-even point, I told you it is a point of sale, right, where my contribution is equal to what? My contribution is equal to fixed cost, right? So it is a point of what? It is a point of sale. So how many units should I sell? so that my profit is equal to 0. So we need to find that sales units only. So how do we do it? Can I say the number of units? So the sales units, I don't know what it is, I need to find out, into the contribution per unit which we got here. The contribution per unit is how much? 4, right? Should be equal to the total fixed cost. In our case, what is the total fixed cost? 10,000 rupees. Correct, guys? Yes. So now, can I say the required sales units to exactly earn a 0 profit or 0 loss is going to be rupees 10,000 upon 4. This is nothing but how much? 2,500 units. Agreeing with me on this. So if I exactly sell 2,500 units, right, I will reach a break-even point. That is, there will neither be a profit nor will there be a loss. My contribution will be exactly sufficient to recover my fixed cost. Are you all clear with this, guys? Or in other words, this is nothing but fixed cost divided by contribution per unit. That is, I need to earn a contribution that is equal to my fixed cost, and every unit gives me a contribution of 4 rupees. So how many units should I sell to recover my entire fixed cost? That is the meaning of this. Are you clear with this, guys? Are you clear with this, guys? Right? Now, another way of doing it is, I told you, contribution can also be calculated by saying that it is nothing but sales in value into PV ratio. Correct? No? So sales can be expressed in units, or sales can also be expressed in value. Sales in units into contribution per unit gives you the total contribution. Similarly, sales in value into PV ratio also gives me what? The contribution value only. Right? Can I say sales in value into PVR should be equal to my fixed cost? Right? So now sales in value into, what's my PV ratio here? My PV ratio is 40%. So can I say into 40% should be equal to rupees 10,000, or the sales, required sales in value should be equal to rupees 10,000 divided by 40%. So how much is that? 10,000 divided by 0.4, that gives you, yes, 25,000 rupees. Are you clear with this? Or in other words, if you directly want to calculate the break-even point in value, see, break-even point is nothing but a point of sale. And whenever they are mentioning about a sale, it can either be expressed in units or can be expressed in value. So if you want to calculate the break-even point in value, you can use directly the formula fixed cost divided by PV ratio. Are you clear with this, guys? Are you clear with this? Or there is one more way of doing. We found out the break-even point in units, correct? 2,500 units, right? And every unit actually has a selling price of 10 rupees. So 2,500 units into 10 rupees. This way also you can find out 25,000 rupees. So basically, break-even point, remember, can be expressed as can be expressed in units, or it can also be expressed in values. Are you clear with this, guys? So now the break-even point formula, to put it short, if you want to express in units, it's going to be fixed cost divided by contribution per unit. If you want to express in value, it's going to be fixed cost divided by PV ratio. Are you clear with this, guys? Are you all clear with this? Always remember, if you want to find out something in units, use contribution per unit. If you want to find out the same in value, instead of contribution per unit, use PV ratio. As simple as that. Clear with this, guys? Clear with this, guys? This is one trick that you can use in marginal costing, a very logical trick as well. Clear with this, guys? So now, can I say that in our case, what was the break-even point in units? 2,500 units, correct? So if I am exactly selling 2,500 units, now there will be 0 profit or 0 loss. Correct, guys? No profit, no loss. Suppose I start selling more than 2,500 units, this will be a profitable situation for me. Suppose I'm not even able to reach 2,500 units, this is a loss situation for me. That is, at this point of time, my contribution earned will not even be sufficient enough to recover my fixed cost, and I will end up reporting what? A loss. Are you clear with this, guys? So the break-even point is a parameter. Any businessman will first calculate the break-even point, and he will say, now, when am I going to achieve this? I need to first achieve this 2,500, and after that, whatever sale I make, that will only go on to generate my profit. Are you clear with this, guys? Are you all able to understand this? That is the concept of break-even point. Now, let us move on to the next concept called as margin of safety. Let us move on to the next concept called as margin of safety. margin of safety. Now, how is it getting calculated? Now, what is this margin of safety? Now, guys, in our example, now tell me what is the total number of actual units sold. In our example, the company has sold a total of 6,000 units, right? So, the actual sales is how much? 6,000 units. Now, we just calculated that the break-even point happens at where? It happens at 2,500 units is what your break-even point is, right? Now, margin of safety means the number of units sold in excess of my break-even point. Are you clear with this? So, in this case, how many units have I sold in excess of my break-even point? I have sold 3,500 units in excess of my break-even point. This is called as margin of safety. Clear with this, guys? Are you all able to understand? Are you all able to understand? So, I have sold 3,500 units over and above my break-even point. This is called as my margin of safety. Sir, why are we using the word margin of safety? Basically, what the businessman will look at is, okay, currently I am selling 6,000 units. I know that my break-even point is 2,500, which means currently I'm in a comfortable position. Now, tomorrow, even if something goes wrong, max I can afford to lose a volume only to the extent of 3,500. If I lose volume beyond 3,500, I will end up in a loss situation. So, to that extent of 3,500 units, I have a cushion, right? That is why it's called as margin of safety. Are you clear with this? This is the logic for the word margin of safety. Are you all able to understand this, guys? Right? Now, how would you calculate margin of safety? First, let me tell you this. Yes, this is nothing but you can take it as the total sales minus break-even point. Right? Now, have one thing in your mind. Now, in this case, what happens? The company is first, the moment they sell 2,500 units, the entire contribution will go on to recover the full fixed cost. Correct? Suppose they are selling 2,501 unit, right? The contribution generated by that one extra unit will directly go on towards generating profit. In this case, the company's profit will be 4 rupees. Correct? Suppose the company has sold 2,502 units. The company's final profit will be those 2 units into the contribution generated. So, or in other words, margin of safety is nothing but the profit generation sale. Agreeing with me on this? Right? The break-even point is nothing but your total sales that recovers your fixed cost, and your margin of safety is nothing but the total sales that goes on to generate your profit. Are you clear with this? So here the margin of safety can be easily called as your profit generation sales. Now, profit generating sales. Now, you just look at this. Now, I have something called as this entire marginal costing income statement. So, look at this here. I have sales minus variable cost gives me contribution minus fixed cost gives me profit. Correct, guys? Now, look at this. Interesting observation. So, now in this case, what's going to be my total sales value? So, it's 60,000, right? So, my sales is going to be 60,000, right? Then minus my variable cost, which is going to be 36,000, gives me my contribution, which is going to be 24,000, right? Minus fixed cost gives me 10,000, gives me a final profit of how much? 14,000. Correct? Now, can I say, look at this. Can I say this 10,000 rupees of fixed cost was purely recovered by the contribution generated from these 2,500 units? Agreeing with me on this or not? That is nothing but my break-even point. That is, I'm repeating, the fixed cost was completely recovered using the contribution generated by the 2,500 units. Agreeing with me on this or not? Or in other words, can I say the break-even point 2,500 units into the contribution per unit? How much is the contribution per unit? 4 rupees, right? So 2,500 into 4, that's how we got this 10,000. Are you clear with this, guys? Right? Now the overall 6,000 units that I have sold, right? That gave me the overall contribution of 24,000 rupees. 6,000 units into contribution per unit of 4 rupees. That gave me the overall contribution of 24,000 rupees. Agreeing with me on this or not? Guys, yes? Similarly, the profit I am reporting of 14,000 rupees, why? This purely came from the margin of safety units of 3,500. So 3,500 units into the contribution per unit of 4 rupees. That's how I got this 14,000 rupees of profit. Agreeing with me on this, guys? Agreeing with me on this? Or in other words, can I say my contribution is tied to my total sales, my fixed cost is tied to my break-even sales, and my profit is tied to my margin of safety. Agreeing with me, guys? Agreeing with me, guys? So now I'm just writing it down here. I'm just writing it down here. So here, what we will write down is, so the total sales, right, is tied to the contribution. The break-even point is tied to your fixed cost, and your margin of safety is tied to your profit. Are you clear with this? And if the sales, the break-even point and the margin of safety, if they are expressed in units, right, you can multiply these figures with contribution per unit, right? If these are expressed in values, you multiply them with what? You multiply them with PV ratio to arrive at these figures. Are you clear with this, guys? Are you clear with this? That is all about it. That is all about it. So marginal costing is nothing but one vertical statement and one horizontal statement. Remember this fully. Remember this fully. That is, your total sale is made up of break-even point plus margin of safety. Correct? Your total sales is nothing but break-even point plus margin of safety. Always remember, break-even point is a point, right? The balancing figure is my margin of safety. This break-even point will not change unless and until there is a change in my fixed cost or my contribution per unit. This will not change, right? Whatever excess sale that I make, if the number of units that I sell increases, only the balance cushion will increase. The margin of safety will only increase. My break-even point will not change. Clear with this, guys? So the total sale is nothing but break-even point plus margin of safety, right? And my total sales is tied up to my contribution. My break-even point is tied up to my fixed cost, and the margin of safety is tied up to my profit. Are you all clear with this, guys? Right? And margin of safety is nothing but my profit generating sale. This is something that you need to understand. This is something that you need to understand. So here, in order to calculate the margin of safety, you can use multiple formulas. Like you can use different formulas. Can I say margin of safety is equal to, now you have, so we know that it is tied to profit, correct? So just now I told you margin of safety into PV ratio gives you what? It gives you profit, right? Or can I say margin of safety is nothing but profit divided by PV ratio? Guys, correct? Guys, correct? So margin of safety is nothing but profit divided by PV ratio. Or if you want it in units, you can say it is nothing but profit divided by contribution per unit. Are you clear with this? Similarly, I can also say margin of safety is nothing but, it is nothing but the total sales minus break-even sales. Correct? Or it can be in value, or if you want, you can also express it in units. Are you clear with this, guys? Yes, you guys are able to follow this, right? There are so many ways of arriving at your margin of safety, your break-even point. These are all different ways of reaching at the same destination. The problem is many students think that, these are all formulas to be mugged up. They will say, this is one formula, this is number 2 formula, this is number 3 formula, and they start on a mission to mug up all these things. It doesn't work that way, right? It can clearly not work that way, because this is absolutely logical. You can come up with the formula by yourself if you know the base understanding of this. Clear with this, guys? We just took about half an hour, and this is all about predominant portion of the entire chapter. Right now we will only be developing and entering into the other advanced areas, keeping this as the base. Are you all clear with this, guys? Are you all clear with this? Now one last time, so tell me, what is that marginal costing income statement vertically and horizontally? Vertically, it's going to be sales minus variable cost. Come on, guys, tell. Sales minus variable cost gives you contribution, minus fixed cost gives you what? Your profit. And here on the horizontal side, you will be having the total sales that is broken up into break-even point and margin of safety. And your total sales is tied to your contribution using CPU, your contribution per unit, or PV ratio, as the case may be. your break-even point is tied to your fixed cost, and your margin of safety is tied to your profit. As simple as that. And this is about the entire chapter, guys. Right now, if someone is asking you to mug up formulas here, it clearly doesn't work that way. Then you will find marginal costing difficult only. This is all about it. Are you all able to understand this? Right? Shall we proceed into a few numerical problems? Yes. And of course they've asked for the profit as well. The profit anyways we found it, right? Okay, fine, guys. So now can you tell me a few formulas as to how do you arrive at profit? Profit is equal to, I can say, total sales minus total cost, or I can also say it is contribution minus fixed cost, correct? Or I can also say it is margin of safety in value into PV ratio, correct? Or I can also say it is margin of safety in units into contribution per unit. There are so many ways in which you can arrive at it. Guys, are you all able to understand this? Right now, these are all different formulas I've seen. Many people, they write it in one full sheet of paper and they start mugging it up. Now these are something, instead of you're wasting your time in mugging this up, if you spend your time in understanding the logic behind it, you yourself can write all these things by yourself. Clear with this, guys? Don't take the pain of remembering things. If you learn it conceptually, it will stay with you for a lifetime. That's about it. Clear with this, guys? Shall we proceed forward? Right? These are all like, it need not be, remembered. On the spot, you just visualize the vertical and horizontal statement. Marginal costing is sorted for a lifetime. That's about it. Fine, guys. Now, shall we move on to the numerical part? Okay. So this is what I've just mentioned it here in the book as basics and all. Beyond this itself, we have covered it right now. So you can just go through all these things. And one very important thing, the basic assumptions of this particular chapter. The basic assumptions of this particular chapter is selling price per unit will remain constant, variable cost per unit will remain constant, and the fixed cost in total, not the total cost, the fixed cost in total will also remain constant. Clear with this, guys? So what do you mean by this? Let us say I am selling 1 lakh units, right? Now for this 1 lakh units, for the first 20,000 units, I can't have a different selling price. For the remaining 80,000 units, I can't have a different selling price. No, right? Sir, in reality, it can happen. Yes, it can happen. What will I do in that case is a subject matter of discussion in CA final. Clear with this? You have a self-paced learning module there in strategic cost management. We will be seeing, not here in your intermediate level. That's an advanced level area. Clear with this, guys? In your intermediate level, suppose they have given a particular number of sale units. Right from the first unit till the last unit you are selling, the selling price will be the same. The selling price can change. If at all it changes, it will be changing for the entire 1 lakh units. It will not be partly for some units you will be having one selling price, the remaining units will be having a different selling price. No, that is not a subject matter of discussion in intermediate. Similar is the case for variable cost as well as fixed cost, correct? If at all these changes, we will be seeing a concept called a sensitivity analysis, wherein we will be saying what will happen if there is a change in selling price, variable cost, fixed cost. Yes, but all these changes will be happening right from the first unit till the last unit you sold. Clear with this? It will not be partly for some units and partly for different units. That discussion is there only in your CA final. Are you all able to understand this? Right? This is the basic assumptions on which this entire chapter is being made. Yes, and the uses of marginal costing, of course, it is used for pricing, short-term decision making, and market penetration at a lower price. Now, one more thing, guys. One more thing. I'm not sure if you guys are aware of this. You have two subjects, right? Costing and FM, right? When I say costing, I mean cost and management accounting. Now, costing always focuses on short-term decision making, and financial management always focuses on long-term decision making. Have this very clearly in your mind. The decision making taken by costing is always 100% short-term. Costing will not take long-term decisions. Sir, I want to take long-term decisions, then go refer FM. Clear with this? That's why these two are interconnected. That's the reason why, if you notice, only in FM you have the concept of time value of money, because we are going beyond 1 year. Have you ever seen the concept of time value of money in costing? No, because costing always talks about short-term decision, right? So which is important, sir? Long-term or short-term? Generally, we prefer long-term only. No, it's not like that. When you're starting a company, you start off with a long-term planning by doing capital budgeting and all that, right? But will everything go as per the plan? Suddenly something happens, a crisis comes in, you need to take an immediate short-term decision. That's when costing comes into the picture. Now this is even more critical. Taking a short-term decision is even more critical, because given the scenario, you need to know what best needs to be done, right? Concepts like sensitivity analysis, your limiting factor, there is a scarcity of raw material, which I should use these raw material to produce which type of products. That is a short-term decision making. It's not permanent. If it's a long-term decision making, we need to refer FM. Clear with this, guys? So the ground rules are set, the boundaries are very clear. So long-term decision is taken only by FM, the short-term is taken only by costing. This is something that you all need to know, right? Coming up here, so now in your CVP analysis, yes, the contribution, PV ratio, break-even point and all we've seen. Yes, the cash break-even point, I will come to that. The margin of safety, CVP pairs is also done. Now what we will do is, let's move on to a numerical problem. One second, let me just see. Okay, yes guys, look at this. Yes, please take this illustration. Now they have given that the selling price is 25, the variable cost is 15, and the fixed cost is 20,000 rupees. Now wait, they are asking a lot of things like contribution. What will be the profit if they are selling 4,000 units? What is the sales required to earn a profit of 50,000? And all these things are given. Now guys, 1 minute. The moment you read any question in marginal costing, now don't keep on staring at the question. It will stare back at you, right? There is no point in it. What you need to do is immediately drop the marginal costing income statement, plug the figures there. That will automatically lead you to the solution. Clear with this? In this case, what I will do, sales minus variable cost gives you contribution minus fixed cost gives me profit. I will just plug it. Okay, only the units are given, per unit data is given. So 25 minus 15, the contribution per unit is 10. The fixed cost is given in total as 20,000. Rough work you do and keep, right? This will lead you to the solution. Now first, what have they asked for? PV ratio. How will you do it? How will you do the PV ratio? It's going to be 10 rupees upon 25 rupees, contribution by sales, or say contribution per unit into selling price per unit. Anyways, so 10 upon 25 into 100, that's going to be 40%. Clear with this? Yes. Then what will be the profit if I'm selling 4,000 units? Very simple. The contribution will be 40,000 into, 4,000 units into 10. 40,000. From that 40,000, 20,000 will be reduced for fixed cost. Remaining 20,000 will be my profit. 40,000 minus 20,000 gives me 20,000. Clear with this, guys? Right? That's about the second part. Third part, look at this. What is going to be the sales required to earn a profit of 50,000? What they are saying, look, I want to earn a final profit of 50,000, right? What should have been the sales I need to make? Simple. Sales minus variable cost gives me contribution minus fixed cost gives me what? Profit. Now they have said they want to earn a profit of 50,000. This 50,000 will be earned after recovering for my fixed cost of 20,000. Correct? No, guys. Yes. Which means I should have generated a contribution that first recovers the entire fixed cost of 20,000 plus contributes to a profit of what? 50,000 rupees. So my contribution should be how much? 70,000. Are you clear with this? So to earn a profit of 50,000, I should have generated a contribution of 70,000. Correct? Right? Now for me to generate a contribution of 70,000, how many units should I sell? Very simple. 70,000 divided by the contribution per unit. Every unit gives me a contribution of 10. I need to earn a total contribution of 70,000, which means I need to sell how many units? 70,000 upon 10, 7,000 units. Are you clear with this, guys? Right? Or in other words, how do you do this? The sales required in units is going to be fixed cost plus profit. That is my required contribution divided by what? Divided by, yes, that divided by my contribution per unit. I think there is some mistake here. Just a minute, guys. There's some mistake. Okay, the final answer is correct. Look at this. I will just do it here. It's going to be 20,000 upon 20,000 plus 50,000, which is 70,000 divided by 10. Yes, 7,000 units. I think they have just done a mistake here. So if you want the sales in units, it's going to be fixed cost plus profit divided by contribution per unit. Are you clear with this? So I need to earn a contribution of 70,000 rupees, right? That 70,000 rupees, every unit was going to give me a contribution of 10, which means I can earn the 70,000 rupees only by selling 7,000 units. Clear with this, guys, right? So the required sales is going to be the required contribution divided by contribution per unit. Required contribution is nothing but fixed cost plus profit. Are you clear with this? Similarly, if you want to express this in values, very simple, fixed cost plus profit divided by PV ratio, or in other words, I know that my PV ratio is 40%, meaning what? If I make sales worth 100 rupees, right, I know that I'm going to earn a contribution of 40 rupees, correct? If this 40 has to be 70,000, right, how much should be my 100? Or in other words, 70,000 divided by 40%. Are you clear with this, guys? So wherever you are using the word contribution per unit, instead if you replace it with your PV ratio, you will be getting the sales in value. In this case, it's going to be how much? 1,75,000. Is this figure right? So it's 7,000 into 25. Yes, it's 1,75,000 or 70,000 divided by 0.4. Are you all able to understand this? Yes. To convert the rupees into units, then divide the sales. Yes, you can do that also. That's what I said. If you want, you can also first find it in units, 7,000 units, multiply it with the selling price of 25 rupees, you will get this 1,75,000. Or directly, if you want, you can say it is nothing but your fixed cost plus profit, the whole divided by PV ratio. Are you clear with this, guys? Now, I have seen many people write all these things as formulas and mugging it up, right? Required sales is equal to fixed cost plus profit divided by PV ratio. Tell 5 times, if not write 100 times imposition, doesn't make sense. You just put it up on a statement, it will lead you to the solution. What is the point in mugging up? You have a lot of other things to remember, right? Don't waste your time here. Clear with this, guys? Spend some extra 2-3 minutes, learn it conceptually, it will stay with you for a lifetime. That's about it, right? Then you have the sales required to earn a profit of 40,000 rupees after tax, okay, when the tax rate is 60%. Now, guys, first let me tell you one thing. This is an exceptional case. Generally, taxes are not even considered in our subject. I told you this, right? But for some reason they have given, I want to earn a profit of 40,000 rupees after tax. They have given that the tax rate is how much? 60%, right? So after tax, they want to earn how much? 40,000. So the tax rate is how much? 60%, which means if you earn 100 rupees, 60 rupees goes by tax, right? And the balance 40 is only left with you, right? This 40% is equal to 40,000. How much is the profit before tax that they want to earn? 40,000 divided by 40%, 1 lakh, right? That's all. Now this 1 lakh is a required profit. To earn a required profit of 1 lakh rupees, how much should be the sales that needs to be made? 1 lakh plus 20,000. 1,20,000 is going to be my required contribution, correct? So that divided by PV ratio or divided by contribution per unit, you will get the required sales in value or in units. Are you clear with this, guys? So that is what they have done. 1,20,000 divided by 0.4. So whatever it is, it's going to be 3 lakh rupees. Yes, fine. Or in other words, it's going to be 1,20,000 divided by, what's the contribution per unit? It is 15, 10 rupees, right? It is 10 rupees. 10 rupees, no? Yes, divided by 10, it's going to be 12,000. Are you clear with this, guys? And that's about it. That's about it. So if you want to express the sales in units, it's going to be 12,000. If it has to be expressed in value, it's going to be 3 lakh rupees. Done, guys? Yes, you guys are clear with this? Fine. The next one. What is the sales required to earn a profit of 25% on sales? Now wait. What do you do? What do you do here? Don't immediately think what formula I should use. Put up the statement. It will lead you. So sales minus variable costs gives you a contribution minus fixed costs gives you profit, right? So now they have given that. So they have asked us to find out the sales. Let's keep the sales as X, right? So variable costs gives you contribution. So what is the PV ratio, guys? What is the PV ratio? 40%. So can I say if I keep my sales value as X, my contribution will be 0.4x, correct? Because basically my variable cost will be 0.6x, right? X minus 0.6x, it will be 0.4x, right? My fixed cost anyways is sorted. I know my fixed cost is going to be 20,000 rupees, right? This is going to be 20,000 rupees. So what is going to be my profit? They are saying I want to earn a profit of 25% on the sales. So 0.25x, correct? You have framed an equation. So can I say this is nothing but 0.4x minus 20,000 is equal to 0.25x, correct, guys? Or in other words, 0.4x minus 0.25x is equal to 20,000. Now 0.40 minus 0.25, that gives you 0.15, right? So 0.15x is equal to 20,000. X is equal to 20,000 divided by 0.15. So how much is that? 20,000 divided by 0.5. So 1,33,333. Are you clear with this? Or if you want to find it out in units, divided by the selling price, but of course there will be some decimal round off. So this is going to be divided by 25, is it? The selling price is 25. Yes, divided by 25, you get in units of 5,333. Are you clear with this, guys? Are you all able to understand? Very logical. This is why I said spend more time on the concepts. Again and again, I'm telling you, remember the Abraham Lincoln's whatever he said. So if you give me 6 hours to chop down a tree, I will spend the first 4 hours sharpening the axe. Spend more time on conceptual learning. The execution will just take a few minutes. That's about it. Clear with this, guys? Fine. With that, we are done with this particular basic illustration. Now, one more thing. Let's go on and do one question here at the back. Yes, this is a masterpiece question. Just a minute. Please take the first question for practice. I mean, not the practice sum, the classroom discussion question. Please take the first one, guys. Please take the first one. Now, what have they given? Read it carefully. Read it carefully. Look, ideally, this I have numbered it as question number 1, but there are 6 parts in this question, right? Once we finish all the 6 here, your basic concepts are going to be sorted. Sir, in exam, can we solve through the statement without using the formula? Now, which one you're talking about? See, in any of these methods that I told you, this statement is something that will lead you to the solution. When you are writing the solution, of course, you need to write the formula. In this case, if you see, there is not much of a formula, but everywhere else, you look at this, I also used a formula. I just asked you not to mug it up, but in exam, it needs to be written for sure. So here, how do I calculate the required sales to earn a profit? I'm saying it is I backworked and I calculated here. Okay, 70,000 divided by contribution per unit, but I need to mention it in the exam. How did you get the 70,000? It's nothing but 20,000 plus 50,000. That is nothing but fixed cost plus profit divided by contribution per unit. So what I told you is this has to be in your, maybe in your rough, or if you want, you can even put it on paper, not a problem. But definitely using this, you will be able to write the formula on your own. That is what I'm saying. I'm not saying formula is not required. Please don't mistake it as, I'm telling don't write the formula. No, I'm asking you not to mug up the formula. I'm saying you can write it on your own if you do the statement. Are you clear with this? So please write the formula like this, but you can easily do it provided you are having the statement with you. Right. So now let's go on to that first question. Where is it? Okay, yeah. Now, guys, read it carefully. If margin of safety is 2,40,000 and it is being 40% of the total sales and the PV ratio is 30%, calculate the break-even sales, the amount of profit on sales of 9 lakh. This is the question. Now, what have they given here? The margin of safety is 2,40,000. So they are saying the extra sale that they have made over and above the break-even point is 2,40,000. And they are saying this 2,40,000 is 40% of the total sales. So how much is the total sale? 2,40,000 divided by 40 into 100. So the total sale would have been 6 lakhs. Agreeing with me on this? Guys, yes? Hello? Yes? So how much is going to be your break-even point? Break-even point is going to be 6 lakh minus margin of safety of 2.4 lakh. Guys, correct? Guys, correct. Or you can say 6 lakh into 60%. If 40% is my margin of safety, the balance 60% has to be my break-even point. Correct? No? Right? 6 lakh into 0.6, that's going to be 3.6 lakhs. Are you clear with this, guys? Are you clear with this? So my break-even point is going to be how much? The break-even sales is going to be 3.6 lakhs. In this question, break-even point cannot be found in units. Why? Because the per unit data is not given. Have they given us the per unit data? No. They have only given us the values and percentages and the PV ratio. So had they given us the contribution per unit, we could have found out. So in this case, we can only express the PV, your break-even point in terms of values. Next, calculate the amount of profit if my sales is going to be 9 lakhs. Right? So what will be the profit if my sales is going to be 9 lakhs? You can prepare the statement and you can find out. Correct, guys? So PV ratio is how much? 30%. Now, can anyone tell me what is the fixed cost in this question? How much is the fixed cost? How much is the fixed cost? So fixed cost is going to be how much?
1,08,000.
1,08,000. Perfect. How did you get 1,08,000? Very simple. I told you, remember the marginal costing jodis. Break-even point into PV ratio gives you your fixed cost. Correct? Break-even point is a point which generates a contribution that is equal to fixed cost. So the contribution generated at the break-even point is equal to nothing but your fixed cost. Correct? So 3,60,000 into your PV ratio of 30%, that's going to be 1,08,000. So you get a fixed cost of how much? 1,08,000. So now with this you can calculate, you can prepare that entire marginal costing income statement when the sales is going to be 9 lakh. So when the sales is going to be 9 lakh, so 9 lakh into 0.3, it's going to be 2,70,000. That's going to be my contribution minus fixed cost of 1,08,000. I will be getting what? I will be getting a profit of 1,62,000. Correct, guys? Yes. Look at this. This is what they have also mentioned. The break-even point is 3,60,000, and your what is this? The profit. Yes, the profit is going to be 1,62,000. If I'm not wrong. Yes, 1,62,000. Now there is another way of calculating the profit. What is it? Using the concept of margin of safety. Guys, we know profit is equal to margin of safety into PV ratio. Correct, guys? Hello? Hello? Guys, yes? Yes, Prashant? You there? Yes. Right? So, remember the jodis that I told you. Your profit is nothing but, can I say, margin of safety into PV ratio. Correct? Now, when I'm generating sales worth 9 lakh rupees, how much is the margin of safety? 9 lakh minus 3.6 lakh. My 3.6 lakh is my break-even point. Any sale I make over and above this 3.6 lakh is called as my margin of safety. 9 lakh minus 3,60,000 is how much extra sales have I made? 5,40,000. That is the margin of safety. That into 0.3. 30%, that is directly going to give me how much? 1,62,000. This way also I can find out my profit. Look, guys, you can play around with the figures provided you have your horizontal and vertical statements of marginal costing. Clear with this? Are you all able to understand? This is much more easier way of doing it. Clear with this, guys? Right. Let's move on to the next one. X Limited has earned a contribution of 2 lakh rupees and a net profit of 1,50,000 on sales of 8 lakh rupees. What is the margin of safety? Now, if you just read the question, you cannot make out anything. What should you do first? Guys, what should you do first? Put up the statement. Scribble it, it's okay. Right? Put up the statement. It will lead you to the solution. And with that, you write the formulas and present it in the exam. Presentation part, you do it. Not a problem. But how do you know what to do? That can be done only if you prepare the statement. Sales minus variable cost gives you contribution minus fixed cost gives you profit. Right? Now, it has earned a contribution of how much? 2 lakh rupees. Okay. And then they have said a net profit is going to be 1,50,000. So, a lakh and 50 here. And then what have they said? The sales is going to be 8 lakh rupees. Right? Now, clearly you know what is the PV ratio? 2 lakh upon 8 lakh into 100. It's going to be 25% is my PV ratio. Guys, yes. Now, what have they asked us? What is the margin of safety? What is the margin of safety? One look you can answer. One look you can answer. What are the jodis? Margin of safety is connected to what? Margin of safety is connected to what? It is connected to profit. Correct? So, margin of safety into PV ratio is going to be equal to your profit. Now what happens here? Or can I say margin of safety is equal to profit divided by PV ratio? Yes. Profit is 1,50,000. PV ratio is going to be 25%. So my margin of safety is going to be how much? 1,50,000 divided by 0.25 is going to be 6 lakh. Guys, clear with this? Clear with this? That's about it. That's about it. But when you're writing in the exam, you should write this formula for sure. I am not saying don't write the formula. Please don't misunderstand. I am saying, I'm telling you the ways to write the formula by yourself. That's what I'm telling you. Clear with this, guys? Are you all able to follow this? Are you all able to follow this? Right? So first they also calculated the PV ratio. And then margin of safety is equal to profit by PVR. It's 1,50,000 divided by 25%, 6 lakh rupees. Are you all able to understand? Guys, yes, this is actually a beauty provided. You are able to understand the base of marginal costing. Next one. Let's move on to the next one, the third one. The ratio of variable cost to sales is 70%. Wait, they have given the VC ratio. So what is the PV ratio? 30% is the balancing figure. The break-even point occurs at 60% capacity sales, right? Capacity sales means what? The company has some capacity, right? Maximum capacity. We don't know how much that is, but they are saying when I am operating at just 60% of my total capacity, at that point itself, my break-even point happens. Clear with this? Compute how much is that capacity sales. right? And when the fixed costs are 90,000 rupees, also compute the profit at 75% capacity sales. There are two questions here. Number one, first calculate what is the total capacity sales. That's what they're asking. Number two, if the company is operating at 75% capacity sale, how much will be the profit? Two things they are asking us to find out. Now first guys, now look at this. In this question, once again, what you need to do here is you need to first put up the marginal costing income statement, right? Now I'm just doing it in a rough here, but anyways, it's being done. The solution is being done. Now guys, please participate along with me. Now first, what have they given? The ratio of variable cost to sales is going to be 70%. It means that my PV ratio is going to be 30%. The break-even point occurs at 60% of the capacity. First, can I calculate the break-even point? Will I be in a position to calculate the break-even point? Yes. How can I calculate the break-even point? Fixed cost I have, PV ratio I have. So now the Jody's fixed cost is always tied to my break-even point. Correct? Right? So break-even point is equal to fixed cost divided by PV ratio. We know that, right? So in this case, my break-even point is going to be how much? 90,000 rupees divided by my PV ratio of 30%. So 90,000 divided by 0.3, that gives me how much? 3 lakh rupees. Done guys. Yes, it gives me a break-even point of 3 lakh rupees, right? Now they are saying this 3 lakh rupees is equal to 60% of my capacity, which means how much is the company's 100% capacity? So the capacity sales is going to be, if 3 lakh is going to be 60%, how much is going to be 100%, right? So divided by 60 into 100. So I can say that company has an overall capacity to sell, generate revenue worth 5 lakh rupees. Are you getting this guys? Are you getting this? This capacity sales is not actual sales. They are saying that I have a capacity overall to sell worth 5 lakh rupees. Are you clear with this? Now the second part of the question, compute the profit when the company is operating at 75% capacity. Now the actual sales is going to be how much? 75% of 5 lakhs. How much is that? 3,75,000, correct? When I am operating at 3,75,000, how much is going to be my profit? Right? Very simple. I know that my break-even point is how much? 3 lakh rupees. And now my actual sale is how much? 3,75,000. So what is my margin of safety? Margin of safety is going to be 75,000 rupees. Correct guys? Yes. So margin of safety into PV ratio of 30%. Into PV ratio of 30%. So 75,000 into PV ratio of 30% gives me how much? 22,500. So I would say now 22,500 rupees is going to be my profit when I am operating at a 75% capacity level, which generates a revenue of 3,75,000. Guys, are you clear with this guys? Any issues here? Or if you want, you can also prepare a marginal costing income statement. But if you do that, you need to calculate the fixed cost. And for you to calculate the fixed cost is given in the question, right? That way also it can be done. So in that case, what will happen? The sales is going to be 3,75,000, right? Into PV ratio. So 3,75,000 into 0.3, that is going to be 1,03,500. That is going to be what? That is going to be your, yes, that is going to be your contribution, right? So 3,75,000 into, one second, into 0.3. Okay, it's 3,12,500 minus 90,000 of fixed cost. You will get the same 22,500 rupees. Guys, are you all able to understand this? Guys, are you all able to understand this? Yes, right? There are multiple routes to the same destination. This is why I said, if you know the vertical and horizontal statements of marginal costing, you can play around with it like a puzzle. Right, guys? Done? Done? Shall we proceed forward? Yes, guys? Yes. Prashant, Ramya, Sheba. Yes, the others also. Priya, Bharat, and the ones online and the ones on YouTube live. Everyone, guys, you there? Shall we proceed forward? Okay, great. Fine. Now let's move on to the next one. So the fourth question, PV ratio of X Limited is 50% and the margin of safety is 40%. Now be very clear. PV ratio is calculated as contribution upon sales into 100. That is vertically. Margin of safety is done horizontally. That is, if out of the total sales made, 40% is margin of safety, right? So don't confuse the two. Place it properly. Calculate the net profit when the sales is going to be 1 lakh rupees. How will you do that? How will you do that? They have said my total sales is 1 lakh. My margin of safety is how much? 40%, which means my margin of safety in value is how much? 4 lakh into 40%. 40,000 rupees is my margin of safety. This is nothing but my profit generating sales. So 40,000 into 50 percentage PV ratio is going to give me my profit, because margin of safety into PV ratio is going to be my profit, 20,000 rupees. Guys, are you clear with this, guys? Right?
Yes, sir.
Right? This could all be MCQs. Who knows? Who knows? This could even be MCQs. Ideally speaking, this can be an MCQ question. Clear with this, guys? Let's move on to the next one. Ascertain the profit when the sales is going to be 2 lakh rupees, the fixed cost is 40,000 and the break-even point is 1 lakh 60. So they are asking us to calculate the profit when the sale is 2 lakh, right? The fixed cost is 40,000, break-even point is 160. How will you do that? How will you do that? Can you tell me in this question how much is the PV ratio? Please don't look at the solution. How much is the PV ratio?
25%.
25%. How did you calculate the PV ratio? Now in this question, you need to have some presence of mind. Fixed cost and the break-even point are given, right? Now make use of the marginal costing jodis, right? So your fixed cost divided by PV ratio is equal to break-even point, correct? Or in other words, PV ratio is equal to fixed cost divided by break-even point, correct? No, right? Fixed cost is how much? 40,000. Break-even point is how much? 160,000. So 40,000 divided by 160,000. In this case, my PV ratio is going to be 25%. Correct, guys? Now with this, you can calculate your profit. Sales is 2 lakh. So 2 lakh into 25% gives you how much? A contribution of 50,000. 50,000 minus, yes, the fixed cost of 40,000 rupees. So now you get how much? 10,000 rupees of profit. Guys, are you clear with this, guys? Are you clear with this? Look, this is exactly what I've given here as well. All the solutions are provided. It is not the solution for which you are attending the lecture. It is for the process, the thought process, the way in which the journey is all that is important. Clear with this, guys? This is how you need to look at the questions, and this is how you need to, crack it. Clear with this, guys? Done? Any issues? Shall we proceed forward? Right.
Yes, sir.
The next one. Let's move on to the final one. Ascertain the sales when the fixed cost is 20,000, profit is 10,000 and the break-even sales is 40,000. Look at this. Calculate the sales when my fixed cost is 60,000, profit is 10,000 and the break-even sales is 40,000. Now, one second, I'm just erasing this off. Now, if it is mentioned like this, right? So immediately and all, you might not know what to do. That's why I keep on telling you, put it up on a statement that will lead you to the solution. Now look at this. Sales minus variable cost gives you contribution minus fixed cost gives you profit. Now what have they said? When the fixed cost is going to be 20,000, right? The profit is going to be how much? 10,000. Okay. Now they have asked us to calculate how, and the break-even sales is 40,000. They have asked us to calculate, find the sales figure. Now tell me, guys, in this position, how much is my contribution? My contribution is going to be profit plus fixed cost, the balancing figure 30,000, right? Now they have given us the break-even sales, right? They have also given us the fixed cost, correct? So with this, I can calculate the PV ratio, fixed cost divided by break-even sales, that is 20,000 divided by 40,000. 50% is my PV ratio, correct? So, or in other words, contribution divided by PV ratio can give me sales. So if I may generate sales worth 100, 50 rupees is going to be my contribution, right? So if 50 is equal to 30,000, how much is going to be my sales? Or in other words, sales into PVR is equal to contribution, correct? Or in other words, sales is equal to contribution divided by PVR. In this case, it's going to be 30,000 divided by 50%. How much you get? That's going to be 60,000 rupees. Are you clear with this, guys? Are you clear with this, guys? Any issues here? And that's about this question as well. Now, this is why I keep on hammering on conceptual learning, right? Now, if you were to mug up all these charts, right, you might not even know in which sum you need to use which formula. Did we even go as per the formula? We first saw what was the question. We put it on a statement. It led us to the solution. While presenting, we did the formula, right? This is the right way of learning marginal costing. So marginal costing can either be too easy if you learn it by concept, or it will be extremely difficult if you mug up by formula. There is no middle ground here. It can either be on extremes. You can either fall in one of the category and the choice is yours. Guys, are you all able to understand this, right? At the time when you're learning the concept, you might have felt, sir, why are you doing all these things for half an hour, 45 minutes in a revision batch? But you just see how quickly we did so many number of numerical problems. Right? Do this for all the subjects. That's what I would suggest, because it is a very smart way of cracking all the papers. learn things conceptually, it is going to be easy for you in your exam. Your life is going to be simple, first of all. Right, guys? Done? Okay, just a minute. Is there anything else left out? Let me just see in the basic concepts. Is there anything else left out? Okay, break even point is okay. Okay, let us also do this. Okay, there's something called as a break even chart. That is, they might ask you, rarely test it, but if you were to plot all these things on a chart, how would it look like? Right? So this is an example given. Selling price is 25, the variable cost is 10, the fixed cost is going to be 15,000 rupees, right? And they have given that the present sales is 15,000. Guys, am I being audible? Is it fine? Yes, it's going on fine. Okay, right. Yes, great. Now again, so here sales minus variable cost gives you contribution minus fixed cost gives you profit. So now here we know that the selling price is 25, variable cost is 10. That gives me a contribution of 15 rupees, and the fixed cost is going to be 15,000 rupees. So now first with this we can calculate the break even point. What is the break even point here? Fixed cost divided by contribution per unit. 15,000 upon 15, it's going to be how much? 1,000 units. Correct, guys? It's going to be 1,000 units, right? So now if you were to plot this on a graph, you can see that exactly at 1,000 units, what happens? Okay, so I'll tell you what to do here. So here what happens? Now there will be two lines that you need to draw. One is with respect to the total revenue. The other one is with respect to the total cost. Total revenue will start from the origin. Why? If I'm operating at a volume of 0, my sales will be 0. Correct? Slowly as the number of units increases, what happens? Your revenue will also proportionately increase. Are you clear with this? This is a total cost line. If I am selling 0 units, still I will be incurring fixed cost. So it starts at the fixed cost and proportionately it will increase from there because of the variable element. Are you clear with this? There will be a point where my total revenue is equal to total cost. That point is called as my break even point. That is going to be 1,000 units. Less than this point, if I am operating at less than 1,000 units, what will happen is my total cost will be more than my total revenue, and hence it will be a loss situation. Clear with this, right? Now the tables will change automatically. If you are operating above the break-even point, your total revenue will be more than the total cost. That will be a profit situation. Are you clear with this, guys? Right? Now the angle that gets formed here, there is an angle, no? Right? When two lines are intersecting, there is one angle that forms there, no? This angle is called as angle of incidence. Are you clear with this? It is called as angle of incidence. Suppose instead of this, suppose it was like, let's say there are two lines here, right? And these two lines were like this. That is, if the angle of incidence is wide, it means that the gap between my revenue and cost is more, which means that it is reporting a more profit. Are you clear with this? Or in other words, wider the angle of incidence, more will be your profit. Are you clear with this? Because at the end of the day, angle of incidence represents the gap between your total revenue and total cost. If the gap between the revenue and cost is more, it means you have a more margin of profit. Are you clear with this? These all could be tested as conceptual MCQs anywhere. So please catch up running notes. Mark this somewhere. Clear? In your institute study material, it runs into pages, right? I am not saying, there's nothing wrong about it, because if I'm explaining it in a lecture, yes, I can give you an examples and right away do it. If it has to be printed, it needs to run into pages. No other option, right? So this is what I said. This is the reason why I'm saying. In fact, institute has honestly done a very good job with respect to coming up with a good material, because the quality has drastically improved as compared to how it was before. So we need to give the credit where it's due. Yes, there are certain things like sequencing which could have been better, certain quality of examples could have been better, but still the quality of the study material as compared to what it was before has drastically improved. So that needs to be said. Anyways, guys, are you clear with this? This is about the angle of incidence. It is the angle that gets formed between which two lines? Total sales and total cost. Are you clear with this? Right, guys? Fine. That's about it. Now, if you were to plot the profits, the profit line will look like follows. Clear with this? That is, at 0 units, what will be your profit? Your profit will be equal to, you will be having a loss that will be equal to your fixed cost. Correct? I haven't sold anything. My contribution is 0 minus fixed cost gives you a profit of that is equal to a negative profit equal to the fixed cost. Correct? So it starts off here, right? And at any point you calculate one profit, you touch the two lines here, so automatically you will be getting it. And exactly at the break-even point, you can see that it cuts the origin. That is no profit, no loss. Are you clear with this, guys? You just go through it once. If at all there is, they ask something like this, maybe you can handle it. Are you clear with this, guys? And that's about this particular break-even chart. Now, one more thing I think is the cash break-even point. I saw it somewhere. Can anyone help me out? Yes, here we go. Okay. Now, guys, one more thing. What do you mean by a break-even point? Break-even point is a point where my contribution is sufficient enough to recover my fixed cost. That's why we said it is fixed cost divided by contribution per unit. If you want it in value, it's going to be fixed cost by PV ratio. Correct, guys? Now, what do you mean by a cash break-even point? It refers to the point of sale where my contribution just recovers my cash fixed cost. So the formula is going to be cash fixed cost divided by contribution per unit. Sir, can you give us an example? Yes. Now you have fixed cost here, right? Let us say this fixed cost is going to be 1 lakh rupees. Out of this 1 lakh rupees, the cash fixed cost is 80,000. When I say cash fixed cost, it means the amount that I actually pay and incur. Example is going to be factory rent, supervisor salary, any kind of other fixed cost that involves payment of cash, right? And even depreciation, amortization are also fixed cost. Correct? Depreciation is also a fixed cost, right? Let us say depreciation is 20,000 rupees. You tell me, will I pay depreciation to a third party out of my pocket? Will I pay depreciation out of my pocket? I will not pay depreciation out of my pocket. But why I do it is because of matching concept. I use an asset for production. So I have already capitalized it to the extent I am using it. So over a period of time, I am writing it off. So though it is ideally a cost for me from a perspective of, an accrual concept, but what we are doing here is we just want to know. I'm just starting off on a business. Generally, when a person starts off on a business, they will not be too greedy to recover the entire fixed cost. They will say, tell me what is the cash fixed cost. I want to know the point where at least my contribution will recover my cash fixed cost. I don't want to recover my full fixed cost. It's enough if I recover my cash fixed cost. In that case, the cash break-even point will be what? Cash fixed cost divided by what? Contribution per unit. It tells you how many units you should sell so that your contribution exactly recovers the cash fixed cost. Are you clear with this, guys? Now, at a cash break-even point, will there be a profit? Will there be a loss? Or will there be a no profit, no loss? At cash break-even point, will there be a profit? Will there be a loss? Or will there be a no profit, no loss? Tell me, guys. No, there will not be no profit, no loss. No profit, no loss will be there only in break-even point. At the cash break-even point, you have still not recovered 20,000 rupees, no? At the cash break-even point, your loss will be equal to the depreciation amount. Are you clear with this? Are you clear with this, guys? At the cash break-even point, you would not have recovered your non-cash fixed costs. Clear with this? So you still will be reporting a loss. That's fine. But I just want to know the point where I will just be able to recover my cash fixed cost. Clear with this, guys? These could be conceptual level MCQs. So please watch out for these things. Maybe catch up running notes somewhere. Clear with this? Yes, done. And that's about the concept of break-even point and cash break-even point. So now, what are the concepts that we have done here? This is, okay, contribution PV ratio, break-even point, cash break-even point, margin of safety, CVP pairs is also done. This chart is also done. Okay. Okay, now, let us move on to another concept, an interesting concept called as, yes, volume analysis. I think I missed mentioning the name, but the illustration is here. Volume analysis. By the way, guys, honestly tell me, the ones who maybe are attending or may have not attended my regular batch, because in regular batch I list out the learning objectives at the start of every chapter. So how many of you are seeing that there are so many concepts in marginal costing? For the first time, you're seeing that, okay, there are so many concepts in marginal costing, is it? right? So you guys knew this before, like there are so many concepts in marginal costing, because many students, as I have seen, they know a lot of concepts, but they don't know it by name, right? So they don't know, oh, this is called as volume analysis, or this is called as sensitivity analysis. Sir, if you give us some, we will be able to answer, but we didn't know that these are the names for this. Okay, so it is better to know it by concept name, so that it will be easy for you to revise towards the end. That is the reason why I'm giving the name. Okay, now look at this volume analysis, what it talks of. It's a very, very favorite area personally for me, because I still remember in my, when I wrote my CA intermediate, right? I didn't learn by all these names and all this. I have classified it only, you know, while I started my teaching thing. So I didn't know this. Actually, this came as the first question of my CA Inter costing paper. First question, I was blinking what to do, but again, conceptual learning only helped me. So I just prepared some statement, tried figuring it out, but at the end of the day, fine, I was able to crack it. But again, I'm telling you, this is ideally a concept. After writing the exam only, I got to know that this has a name called volume analysis. Let me tell you what that is. Now, just a minute. I've just coined up an example. 1 second. Okay. Now, I hope you guys are catching up running notes. Are you guys doing it? Yes, good. Now, volume analysis. Guys, in exam, please don't expect the institute to mention the name of the concept and all. It never works that way. You should be able to figure out what concept they are testing in a chapter. Now, let us say, I'm again giving an example. Let us say selling price is 10, variable cost is going to be 6, fixed cost is going to be rupees 10,000. Okay, done. Now, I am preparing a marginal costing income statement for two volume levels, 5,000 units and 7,000 units. Just an example. Now, what's your marginal costing income statement? Sales minus variable cost gives you contribution, minus fixed cost gives you profit. Now, so what's going to be your sales at 50,000 units level? It's going to be 5,000 units level. It's going to be 50,000. Variable cost will be 5,000 into 6. That's going to be 30,000. Your contribution is going to be 20,000 rupees here. Your fixed cost is going to be 10,000 and your profit is going to be 10,000 again. Now, suppose I'm selling 7,000 units. So my sales is going to be 70,000. My variable cost is going to be 7 into 6, 42,000. Right? And my contribution is going to be 28,000. Fixed cost remains to be 10,000. And my profit is going to be how much? My profit is going to be 18,000. Now guys, if you make an observation here, now, can I say that in this case, what happens? Your profit increases by how much? Your profit increases by how much? 8,000 rupees. Your profit increases by how much? 8,000 rupees. Can I say this increase in profit is purely on account of the increase in contribution? The contribution has also increased by 8,000. Why else will my profit increase? There is no change in the fixed cost in between. So if at all my profit is changing, the change in profit is always equal to the change in contribution. Agreeing with me on this? And why is my contribution changing? Because now what am I doing? Instead of selling 5,000 units, I am now selling how many units? 7,000 units. So there has been an increase in the volume by 2,000 units. Agreeing with me on this? Or in other words, can I say that 8,000 rupees, right, is nothing but the contribution generated by this extra 2,000 units? Agreeing with me, guys? Right? Or in other words, can I say the contribution per unit is equal to delta profit divided by delta units. Delta means what? Change. In this case, it is nothing but 8,000 rupees. The change in profit is nothing but the change in contribution, and that contribution is pertaining to the change in units, correct? So 8,000 rupees is the contribution pertaining to how many units? 2,000 units. So how much is the contribution per unit? 4 rupees per unit. This way also I can find out. Guys, correct? This is what we found out there itself. 10 minus 6 is 4. Suppose the per unit data and all is not given. Correct? Assume in the question they have just given you sales 5,000 units, 7,000 units. If 5,000 units is sold, the profit is 10,000. If 7,000 units is sold, the profit is 18,000. This is all they have given. Can you find out the PV ratio? Yes. Yes. Just the top figure and the bottom figure they are giving you. Sorry. Can you find out the contribution per unit? Yes. How will you do it? Difference in profit is nothing but the contribution pertaining to the change in units. So my contribution per unit, one more formula is now available. That is nothing but delta profit divided by delta units. Are you clear with this, guys? Right? Suppose you want to calculate the PV ratio. How will you do it? Very simple. PV ratio is equal to delta profit divided by delta sales. Or in other words, can I say this 8,000 rupees is the contribution that got generated from the extra sales of 20,000 rupees. Correct? So can I say that 8,000 upon 20,000 into 100, that's going to be how much? 40%. Are you clear with this, guys? Are you clear with this, guys? Right? This is called as volume analysis. So in your volume analysis, suppose in a sum, if they just give you year 1, year 2, 2 top figures and 2 bottom figures, can you end up calculating the PV ratio or the contribution per unit? Yes. Are you clear with this? Right? Here I will say the PV ratio is the delta profit divided by delta sales. I was earning a negative profit, that is a loss of 15 lakh. It has now become how much? 75 lakh, which means I have earned an extra profit of how much? Extra profit of 90 lakhs. This 90 lakhs is nothing but the contribution generated due to the incremental sale of 150 lakh. So 90 lakhs upon 150 lakhs into 100. In this case, the PV ratio is going to be 60%. Are you clear with this, guys? If they just give you the top and the bottom figures, still you can find out the PV ratios or the contribution per unit. Clear with this, guys? See now how many formulas are there for PV ratio? PV ratio is equal to contribution by sales into 100. Correct? Or fixed cost divided by break-even point into 100. Or profit divided by margin of safety into 100. Or now we also have one more formula, delta profit divided by delta sales into 100. Clear with this, guys? You need not mug this up. The situation, based on the situation, you yourself can arrive at the formula and write it by yourself. Clear with this, guys? Done? Are you all able to understand this? Yes, you guys are able to follow this? Fine. Shall we move on to the next one? Okay, so what have they asked? Yes, now once you find out the PV ratio, now you can prepare the entire marginal costing income statement. Right? So you know that the sale, take year 1 or year 2, whichever you want. So the sale is 100 lakhs. What will be the contribution? 60% on 100, 60 lakhs. They have given us the profit was how much? The profit was 15 lakhs. So the balancing figure has to be your fixed cost. Are you clear with this? Are you clear with this, guys? Yes, this way you can find out and prepare the rest of the income statement. Now for any output level, you can prepare your income statement. Clear with this, guys? And that is about the concept called as volume analysis. Done with this? Are you all done with this? You guys are clear with this, right? Shall we move on to the next one? Yes, guys? Yes, done. Shall we move on to the next one? Yes, okay. Now, let's move on to the next one, which is called as sales mix, merger of plants, sensitivity analysis, indifference point. Okay, let me take up sensitivity analysis. Okay, sensitivity analysis. Now, what do you mean by sensitivity analysis? First, guys, what do you mean by sensitive? Have you might have seen this advertisement on Colgate sensitive. What do you mean by sensitive? So, while other things remaining constant, an introduction of a change in one variable impacting the others is called as sensitivity. That is, you would have seen advertisements where they will eat one ice cream and they will say like it really becomes very difficult for them to that the way your teeth responds to it, right? That is called as sensitivity. Similarly, even in marginal costing, we are going to see how a change in a variable is going to impact the other components, right? Now, if you see in this chapter as of now, what we have learned, what is marginal costing all about? We are just playing around with four numbers. We are just playing around with four numbers. What are those four numbers? You have selling price per unit, you have variable cost per unit, you have fixed cost in total, and you will be having volume, right? Yes, guys, right? Actually seeing till now, your marginal costing is nothing but we have four input figures. We have four input figures: selling price per unit, variable cost per unit, fixed cost in total, and volume, right? Now, how these four inputs will impact my profit is the study of marginal costing. Correct, guys? To put it in short, right? How these four inputs, change in these four inputs is impacting my profit is what we have been seeing in marginal costing. In you take any of the sum, these are all the figures that we have been seeing. So, but what we are doing is we are seeing how these four figures will impact my profit. So, to understand the study, we are having some tools called as PV ratio, right? You have this break even point and you have this margin of safety. So to put it short, your marginal costing is nothing but the study of how these four variables impact the profit through the tools called as PV ratio, break even point, and margin of safety. This is all the study of marginal costing. Clear with this, guys? Clear with this? Now, what is sensitivity analysis saying? Now, suppose I am slightly increasing my selling price while keeping the other factors unchanged. How is it going to impact my profit? Or suppose I am slightly decreasing my variable cost while keeping the other three input factors unchanged. How is it going to impact my profit? Right? Or in other words, the sensitivity analysis talks about how a change in one variable while keeping the other constant is going to impact my profit through the PV ratio, break-even point, and margin of safety is called as the study of sensitivity analysis. Clear with this, guys? Clear with this, guys? Right? That is about the concept of sensitivity analysis. Now, how and all we will just be seeing right now. Now, I always get reminded of this sensitivity analysis. The moment I say sensitivity analysis, I get reminded of one student who, so in just like how I told you guys that, this Colgate sensitive advertisement and all. So by mistake, I thought of that Colgate active salt, that advertisement is there, no? So I told one madam will immediately break open the wall. She will come and she will ask, do you have your toothpaste and all? By mistake, I said that madam was Kajal Agarwal. That guy said, no sir, now it's Samantha. How can you say Kajal Agarwal? No? I said, they evlo highlights ra irukku idella vittittu idha paakreen naan. But see, our students are always on the top of all the current affairs. Okay, right. Coming back here, guys. So sensitivity analysis. Now, sensitivity analysis. Now, I told you that it is a study of how a change in one variable is going to impact your profit through these three tools called as PVR, break-even point, and margin of safety. Now, guys, you all participate and I want your interaction on this. Now, what we're going to do here is, first, let me just put it up here. The three tools, PVR, break-even point, and margin of safety. Right? Now, first, let me talk about the selling price. First, let me talk about the selling price. Let us say I am increasing my selling price while the other factors remaining constant. I am just increasing my selling price. Let us take an example. Let's say presently my selling price is 10. Variable cost is going to be 6. My contribution per unit is going to be 4. Right? And let's say the fixed cost is currently going to be 10,000. Correct? Just an example, guys. Right? Now, while other aspects remaining to be constant, and let us say the volume is how much you want the volume? Let's say it's 1 lakh. Okay, right. Now guys, now what happens? Let us say while the other factors remaining constant, I am slightly increasing my selling price. Now what will happen to the PV ratio? Now the selling price alone I am changing. Instead of 10, let us say it becomes 12. Okay, right? So now what? The variable cost continues to remain 6. My contribution becomes how much? 6 rupees now. Correct? Now what happens to my PV ratio? Earlier my PV ratio was 4 upon 10 into 100, 40%. An increase in your selling price while the other things remaining constant, will obviously increase your contribution per unit, and hence your PV ratio will also increase. Correct, guys? Right? So obviously my PV ratio will increase. Correct? Right? Now what happens to my break-even point? Earlier, every unit was generating 4 rupees, right? Now every unit is generating 6 rupees. So now you tell me, logically speaking, it will take lesser time for me to recover my entire fixed cost. Agreeing with me on this? So obviously my break-even point will go down. Correct? Now I am not changing anything else. The volume also continues to remain the same. Now what happens to your margin of safety? So volume is the same, right? But my break-even point has come down. So now the balancing figure will obviously increase. My margin of safety will increase. And when my margin of safety increases, my profit will increase. Are you clear with this? Because margin of safety, after all, is nothing but your profit generating sales. Clear with this, guys? Clear with this, guys? Now you are able to understand what is sensitivity analysis. A change in one variable impacting my profit through these three tools is called as sensitivity analysis. Similarly, if I'm reducing my selling price, what will happen? Instead of 10, let us say it is now 8. This continues to be 6. My contribution per unit becomes how much? 2 rupees. So 2 upon 8 into 100, that's going to be how much? 25%. Or in other words, my PV ratio will fall down. Correct? Now, since the contribution per unit has reduced, it takes more time for me to recover my fixed cost. My break-even point will increase. Volume is same. Now, break-even point is more, which means the balancing figure is going to be less. My margin of safety will increase, and when my will decrease, and when my margin of safety decreases, my profit will also decrease. Clear with this, guys? Clear with this, guys? Now, second one. Let's talk about variable costs. Suppose I'm increasing my variable cost. What will happen? So while everything else is constant, let us say I'm keeping everything else is constant. So now selling price is 10, but variable cost, instead of 6 rupees, I'm now making it as 8 rupees. What happens to my contribution? It becomes 2 rupees. Correct? So PV ratio will now obviously fall. Guys, correct? Right? When my PV ratio falls, now what happens? Now every unit recovers only 2 rupees of contribution. It takes more time for me to recover my fixed costs. Break-even point increases, and when my break-even point increases, the balancing figure, margin of safety, will obviously fall down, and hence there will be a fall in my profit. Guys, correct? Right? Similarly, what will happen if you decrease your variable cost? Now what happens here? Now let us say instead of 6 rupees, my variable cost is just 4 rupees. Now what happens? My contribution per unit will increase, right? This increases my PV ratio, right? Now I'm generating more contribution per unit. What happens here is, right now I will be able to recover my entire fixed cost more quickly. Correct? So my break-even point will fall down, and when my break-even point falls down, the balancing figure of margin of safety will be more. An increase in margin of safety will result in a higher profit. Guys, clear with this, guys? Right? Done. Next, third one. What is the third input factor we've got? Fixed cost. Now guys, logically think and tell me, if there is an increase in the fixed cost, how will it impact my PV ratio? What will happen to the PV ratio? If my fixed cost increases, what will happen to my PV ratio? Come on, think and answer. Guys, come on, use the chat box.
Overall profit decreases.
I'm not asking about overall profit. I'm asking about the impact it has on the PVR. Exactly. Very good. Very good. So now here, your PV ratio will not get impacted. PV ratio is dependent on contribution and sales only. If directly you increase your fixed cost, that will not impact my PV ratio. I'm not saying it will not impact your profit. I'm just saying it will not impact your PV ratio. Correct? Now, how will it impact your break-even point? Will it impact your break-even point? Yes, it will. Now you have more fixed cost to recover, right? The contribution per unit is the same. You have more fixed cost to recover. What will happen now? Your break-even point will be more. It will increase. And when your break-even point increases, the balancing figure volume will obviously decrease. Are you clear with this, guys? Right? Suppose I'm decreasing my fixed cost. Once again, no change in my PV ratio, but now I have only lesser fixed cost to recover, which means my break-even point will fall down. The balancing figure, margin of safety, will increase. Guys, clear with this? This will end up in a more profitable situation for me. Are you all able to understand this logically? Right? Now let's go on to the last one, the fourth one, volume. Now tell me, if I increase my volume, what will happen to my PV ratio? What will happen to my PV ratio? If I increase my volume, what will happen to my PV ratio? Again, no impact. You are only increasing your volume. How will it impact my PV ratio? On a per unit level, the selling price and my selling price and my contribution per unit variable costs are all one and the same. So it will not impact your what? It will not impact your PV ratio. What will be the impact on break-even point? What will be the impact on break-even point? Once again, no change. Very good. Why? Because break-even point is about fixed cost upon contribution per unit. Fixed cost is also not changing. My contribution components are also not changing. Now, break-even point is a point. Are you clear with this? That point is fixed. That's about it. Unless and until there is a change in your fixed cost or in your contribution per unit, this will not change. Correct. Now, as there is an increase in volume, now what will happen? Only your margin of safety will increase. Are you clear with this? That's the reason why more the volume, more the profit. Clear with this, guys? Right? Now, similarly, what happens if there is a drop in the volume? Right? Now, your PV ratio, there will be no impact on the PV ratio. Similarly, no impact on your break-even point. But now, what happens? Your margin of safety drops, and hence your profit will also drop. Are you clear with this, guys? Are you clear with this? This study is called as sensitivity analysis. This study is called as sensitivity analysis. And remember one thing, if you make an observation here, if my PV ratio gets affected, definitely my break-even point and margin of safety will get affected. Correct? If my break-even point gets affected, definitely my margin of safety gets affected, but it need not be the case where my PVR will get affected. That is, if my break-even point is getting affected, definitely my margin of safety will get affected because it's a balancing figure. But it is not necessary to affect my PV ratio. Similarly, if my margin of safety gets affected, it is not necessary that the PV ratio and the break-even point should get affected. Are you clear with this? Are you clear with this? This is the overall conclusion that you can draw from the concept of sensitivity analysis. Are you clear with this, guys? Are you clear with this? Yes, you guys are fine with this? Yes, shall we move on to the next one? Shall we move on to the next one? Right? Yes. Okay, great. 1 second. I have a question here. The change in profit is equal to change. Okay, right. That's a sensitivity analysis as same in financial management. Yes, it is the same. Sensitivity analysis, the concept will always be the same. It depends on which variable and which final effect that you're talking about. In marginal costing, you're talking about the impact these four variables will have on your profit. Yes, in your in your financial management, in fact, in final and all, will be having, even in capital budgeting, we'll be having sensitivity analysis. I think even in intermediate level to some extent we have. Yes, the concept of sensitivity analysis is the same, right? The components which you do the sensitivity analysis alone will be different. That's about it. Fine, guys, done. Let's move on to the next one. Right? Any other doubt? Just a minute. Let me just take it up. Okay, fine. Right. Now let's move on to the next one. Now the next concept is about sales mix and marginal costing. Sales mix and marginal costing. Sales mix and marginal costing. Now guys, what is this? Now, carefully listen. In sensitivity analysis, there is a reason why I did sensitivity analysis first and then I'm moving on to this particular sales mix immediately. In sensitivity analysis, I told you that only 4 components will impact your profit. Correct? Right? That is your selling price, variable cost, fixed cost, and your volume. Correct? These are the 4 components that will impact your profit. Any change in these 4 components alone will actually impact my profit. This is what we saw till now, guys. Yes. Now we will now see there is a 5th component that can also impact your profit, right? Sir, which means till now poi sollitengla, have you lied to us? Not like that, right? It's a gradual learning, that's why. Okay, so there is also a 5th component that impacts your profit, that is called as sales mix. Clear with this? What do you mean by sales mix? Now, let me just take an example to tell you to explain the concept of sales mix and also help you understand how the sales mix is going to impact your profit. Let us take an example of a company called BMW. You guys know BMW? Yes, the automobile company, right? Now, BMW is actually into the business of manufacturing cars, and they also manufacture bikes. Right? So everyone knows that they manufacture cars. Maybe some of you might not know that they manufacture bikes, but yes, they also do. Clear with this? In reality, they also do manufacture bikes, super bikes they manufacture. It will not be like normal, the price range itself will be high. Fine. Now, what happened was, now BMW, what they are saying, year 1, year 2, right? 2-year data they published. 2-year data they published. In both the years, they didn't change the selling price. They didn't change the variable cost. They didn't change the fixed cost. And in both the years, the total volume was 1 lakh units. They have sold 1 lakh units, right? So as the volume changed, volume also did not change. However, in year 1, the profit was different. In year 2, the profit was different. Why? I'm again telling you, they did not change any of these 4 components. Still, in year 1, the profit reported was different. In year 2, the profit reported was different. Now, what happened was, in year 1, I told you, no? In year 1, I told you that they sold 1 lakh units, right? The breakup was, they sold 60,000 cars, right? And they sold 40,000 bikes. Clear with this, guys? Whereas in year 2, what they did, they sold the same 1 lakh units only, but the internal sales mix or the composition alone changed. They sold 40,000 cars, right? And 60,000 bikes. Are you clear with this? Now you tell me, everything was the same, but the internal composition alone changed. Maybe cars might be having a higher contribution per unit, right? And bikes may be having a lower contribution per unit. In year 1, though the total number of units were the same, but if you see in the internal composition, in year 1, they have sold more of a high profitable product. Whereas in year 2, they have sold only lesser of a high profitable product. Maybe that is the reason why in year 1, the profit reported might have been high. And in year 2, the profit reported might have been less. Are you clear with this? Or in other words, you're not just these 4 factors, one more factor called as sales mix. Sales mix is nothing but the composition of the different products being sold also impacts your profitability, and the study of this is called as sales mix and marginal costing. Clear with this, guys? Right? Now, sir, how is this going to impact our profitability? Now, it is not just that, it is also how do I calculate the break-even point when the company is selling more than one product? These are all a few extra learnings that we are going to do here. Now, guys, remember one thing. This sales mix will be applicable only for companies that deals in more than one product. If the company deals in only a single product, whatever we've seen till now, that alone will stand, right? Over and above all the concepts we have learned, if a company is dealing in more than one product, 2, 3, 4, 100, whatever number of products, in that case, your sales mix concept will come into play. Are you clear with this, right? To understand the concept of sales mix better, now let us do a numerical illustration. Let us do a numerical example question. So please take the second question for classroom discussion. Please take the second question for classroom discussion. Here it is. Yes, guys, please take the second question. Shall we get started? Right. Now, the following set of information is presented to you by your client AB Limited, producing 2 products X and Y. So X and Y, they have given that the direct material is 20, direct labor is 6 rupees per unit for X, for Y it's 18 and 4. The fixed expenses during the period is expected to be 1600 rupees. The variable expenses are allocated to the products at the rate of 100% of direct wages. The selling price per unit of X is 40, Y is 30. The proposed sales mix, they are saying, alternate 1. They are planning to sell 100 units of X, 200 units of Y. Alternate 2, 150 each of X and Y. And alternative 3, 200 units of X and 100 units of Y. As a cost accountant, you are required to present the management the following. Number 1, the total contribution and profit from each of the above sales mixes. Then, number 2, the proposed sales mix to earn a profit of 300 rupees and 600 rupees when the total sale of X and Y being 300 units. Calculate the break-even point when the sales mix is 2:1. Recalculate the break-even point when the sales mix is 1:2. Now, this is about the question. Now, first, what we need to do is let us calculate the contribution per unit of each of the 2 products. Now, if you look at this, product X, product Y, they have given the selling price 40 and 30, correct? So this contribution is 40 and 30. From that, reduce all the variable costs. So you have the variable cost here, your direct material, direct wages. Apart from that, there is one direct expense also, which is equal to 100% of direct wages. So here if you see 26, and you also have your direct expenses, which is being given, right, minus 6. So here it's going to be every unit of X generates a contribution of 8. Similarly, every unit of Y generates a contribution of 4 rupees. Clear with this? This is the first step that we have done. That is calculation of what? The contribution that each of the products are generating. Now, what have they asked here? First, what we need to do? We need to calculate, okay, what should be the proposed sales mix to earn, okay, fine. There are 3 alternatives given in the question. We need to calculate the profits for each of these 3 alternatives, right? Now, let us do that. Calculation of profit under different sales mix. Now, suppose scenario 1, 100 units of X is being sold and 200 units of Y is being sold. Now, you tell me guys, what will be the total contribution? 100 into 8, that will be the contribution generated by X. Similarly, 200 into 4, this will be the contribution generated by Y, correct? So, the total contribution generated is going to be 1600 rupees. Now, from this, they have given that overall, the company incurs a fixed cost of 1600 rupees. This 1600 rupees is a fixed cost that is pertaining to both the products put together. Clear with this? It's a common fixed cost. So, from that, you reduce your fixed cost. So, now the profit is going to be 0. The profit will be 0 when I'm selling 100 units of X and 200 units of Y. Suppose in the second situation where I'm selling 150 units of X and your 150 units of Y. In this case, what will be the total contribution, right? So once again, we've got it here. So it's going to be 150 into 8 plus 150 into 4, right? That is going to be the total contribution, 1200 plus 600, which is 1800. From there, you reduce your fixed cost, you'll end up with a profit of 200 rupees, right? Suppose I'm selling 200 units of X and 100 units of Y. Then multiply the same with the respective contributions per unit, 200 into 8 and 100 into 4, right? You get a total contribution of 2000 rupees. From that, subtract 1600, you will end up with a profit of 400 rupees. Clear with this, guys? If you notice here, in all the 3 situations, 100 plus 200, I have sold 300 units. 150 plus 150, here also 300 units. 200 plus 100, here also 300 units, right? Overall, the volume has not changed, but a change in the mix results in different profits here. So if you see in the first scenario, the profit reported was 100 rupees. The second scenario, it was 200. The third scenario was 400. This way, we can clearly see that a change in the sales mix can also impact your profit. Are you clear with this, guys? Are you clear with this, right? Next, what have they asked as the second one? Now, what should be the proposed sales mix to earn a profit of 300 rupees? Right? And the second scenario, they've asked to earn a profit of 600 rupees, but they've given one condition. The total sales of X and Y put together should only be 300 units. So first, let us calculate how many units of X and Y I need to sell in order to earn a profit of 300 rupees. Now, very simple and logical calculation. Let the number of units of X be X. So which means the number of units of Y is going to be 300 minus X, because they've given us a condition that number of units of X plus number of units of Y has to be 300. So if you keep this as X, Y has to be 300 minus X, correct? So now the total contribution will be how much? 8X. That is, every unit of X generates a contribution of 8 rupees and every unit of Y generates a contribution of 4. So 4 into 300 minus X. We are replacing Y as 300 minus X, right? So this is going to be the total required contribution minus my fixed cost of 1600 should be equal to 300 rupees. With this, we can frame an equation. So we can arrive at the fact that it is going to be 4x is equal to 700 rupees. So now how much is my X value is equal to, I think they have done a mistake here. Just a minute, guys. It's going to be 700 divided by 4, right? So it's going to be 175, right? This is not 1754. Right, it is going to be 175. Are you clear with this? So now with this, we have calculated that I need to sell 175 units of X. Obviously, Y is going to be 300 minus 175, 125 units. So when the company sells 175 units of X and 125 units of Y, they will end up making a profit of 300 rupees. Are you clear with this, guys? Are you clear with this, right? So easily we can find out how many units of X and Y respectively need to be sold in order to earn the required amount of profit. Done, right? Now, moving on to the next one, which they have asked for. Suppose the company wants to earn a profit of 600 rupees. How many units of X and Y needs to be sold? Once again, you frame the same equation. 8X plus 4 into 300 minus X minus of the fixed cost of 1600 should give you a profit of 600 rupees. Frame the equation. Now you will get the X value as 250 units. The Y value is going to be 300 minus 250. It's going to be 50 units. So when the company sells 250 units of X and 50 units of Y, they will end up making a profit of 600 rupees. Are you clear with this? Right? That's about this particular segment. Now coming to the most important part, calculation of the break-even point. This is where this entire, the crux of the matter lies here with respect to the calculation of break-even point. When the sales mix is 2:1. Now guys, now you tell me what is the issue here. You tell me what is the issue here. Now, let me write it up. I have two products, X and Y. Product X generates a contribution of how much? It generates a contribution of 8 rupees, and product Y generates a contribution of 4 rupees, right? And I have a common fixed cost of rupees 1600 to be recovered. Guys, correct now? Yes? Guys, yes, you there? Guys, there?
Yes, sir.
Right. Now, what happens is, generally, we know that your break-even point is nothing but fixed cost divided by contribution per unit. Correct? Now, fixed cost, I know it's 1600. Now, contribution per unit, which one should I take? Should I take 8 or should I take 4 or should I take both? Right? This is where the case becomes little interesting when it comes to your sales mix. Now, basically, you tell me guys, logically, you tell me, this 1600 rupees of fixed cost is being incurred not only for selling units of X, it is also towards units of Y, correct? Right? And what do you mean by a break-even point? A break-even point is a point of sale where I generate a contribution that is sufficient enough to recover my fixed costs. Now, this 1600 rupees should be recovered not just by any one of the two products. These two products should jointly go on to generate a contribution that is sufficient enough to recover my 1600 rupees. Agreeing with me on this? Agreeing with me on this? So here the contribution per unit is neither X nor Y. It needs to be a weighted contribution per unit. Are you clear with this? What is the meaning of weighted contribution per unit? They have given in this question that the sales will always be in the ratio of 2:1. Correct, guys? It will always be in the ratio of 2:1. Or in other words, every time I sell 3 units, if you see, 2 units will be X, 1 unit will be Y. This is the meaning, no? Guys, correct? Right? Every unit of X generates a contribution of how much? 8 rupee. Every unit of Y generates a contribution of how much? 4 rupees. So if you multiply this here, 8 into 2 is 16, 4 into 1 is 4. Totally, I end up generating a contribution of 20 rupees for every 3 units being sold. So representatively, the contribution per unit is going to be how much? 20 upon 3, it is going to be 6.6666 or 6.67. Are you clear with this, guys? This is the reason why here, when it comes to sales mix, we don't say it's fixed cost by contribution per unit. We use an additional word and call it as fixed cost divided by weighted contribution per unit. Are you clear with this? And how will you calculate the weighted contribution per unit? It is nothing but the contribution of a particular product multiplied by its weights. This calculation, this is nothing but, can I say this is 8 into 2 by 3 plus 4 into 1 by 3. Correct, guys? This is what we did here. Basically, we did 8 into 2 plus 4 into 1, the whole divided by 3. That only we are writing it like this. Or not, this is nothing but the contribution per unit into weights of each of the products. Are you clear with this, guys? If you do this, you get the weighted contribution per unit, and now with this you can calculate the break-even point. How do we do it? Let me just walk you through here. Now in this case, you look at it. Here if you see, the weighted contribution per unit is going to be how much? 6.667. Correct? Right? So now my break-even point is going to be fixed cost divided by weighted contribution per unit. So Now, please do not round it off. Retain the decimals in your calculator. That is 6.66666666, right? So if you say 1600 divided by 6.66666666, right, you will get exactly 240 units. So what does it mean? I need to sell 240 units, right, to exactly recover my fixed cost. I need to sell 240 units of X or Y or both. I need to sell 240 units of both. So this 240 units of both means in what ratio? The mix is given. So this should always be in the ratio of 2:1. Are you clear with this? So out of this 240, 2/3 will be X units and 1/3 will be Y units. With that, you can calculate how many units of X and how many units of Y needs to be sold. Are you clear with this? Or in other words, in this case, first you calculate the break-even point by taking fixed cost by weighted contribution per unit. You will get the total number of units required to be sold. Multiply this with the mix or the weight of the product. You will get the product-wise break-even point. Are you clear with this? If I sell exactly 160 units of X and 80 units of Y, I will be in a position to break even. Are you clear with this, guys? Are you able to understand? Are you able to understand? Right? So when you have a mix of products, what is the formula to calculate a break-even point? Your break-even point is going to be fixed cost divided by weighted contribution per unit. Clear with this? Suppose you want to calculate the break-even point in values, what will you do? It is going to be fixed cost divided by weighted PV ratio. Are you clear with this? Take the PV ratio of the respective products and multiply it with what? Multiply it with the weights. Are you clear with this? That's called as a weighted PV ratio. Are you all able to understand, guys? Suppose what will happen if the sales mix is changed to 1:2? Once again, calculate the weighted contribution per unit. 8 into 1/3 plus 4 into 2/3. So this is what you get as your weighted contribution per unit. Fixed cost divided by weighted contribution per unit. So now you arrive at 300 units. Are you clear with this? So only if you sell 300 units, you will be able to recover your entire fixed cost. 300 units of what? X or Y or both. 300 units of both, right? Break it up and arrive at each and every component. So which means if I sell 100 units of X and 200 units of Y, I will be able to generate a contribution that exactly recovers my common fixed cost. Are you clear with this, guys? Right? You are all able to understand this. You're all able to understand this. This is how you need to calculate break-even points when a company is dealing in more than one products. Are you clear with this, guys? Right? I think this has been mentioned on the top here as a concept. Let me just walk you through that. Just a second. Where is it? Where is it? Where is it? 1 second. I think it's gone. Just a minute, guys. Yes, look at this. The overall break-even sales is going to be what? If the quantity mix is known, I will say it is sales quantity into your weighted contribution per unit. Or in other words, how do you do it is your fixed cost divided by weighted contribution per unit. If the sales value mix is known, you will divide the same by. You will take the fixed cost divided by weighted PVR. Are you clear with this, guys? Are you clear with this? Right? So the contribution value has to be how much? Quantity, the sales, if it is in units, you multiply it with weighted contribution per unit. If it is in value, multiply it with weighted PVR. Are you clear with this, guys? Right? This is what we have seen in the previous question that we just finished right now. Fine, guys. Done. Right? With that, the second sum is also over. Okay. Done. So now, what are the concepts left out? Okay. Let me also do this merger of plants. Okay, what do you mean by merger of plants? What do you mean by merger of plants? Now, guys, simple. Let's say I have a plant A and I have a plant B. Now I want to combine these two plants. Let us say these two plants are adjacent, right? There is a wall in between. Now I'm just removing the wall and making this into one, right? I'm merging two plants together, right? When I merge two plants, right, how will you apply the concepts of marginal costing? Nothing great, nothing great. You will think that, so this is nothing, sir. Plant 1 plus plant 2 is going to be equal to the merged plant, right? Use the figures and calculate. Prepare an income statement for the combined sales, combined variable cost, combined contribution, combined fixed cost and all. With that, you can do it. Absolutely correct. But in these questions, only one thing needs to be watched out for. Suppose they would have given the volume data and they would have mentioned that the plant A is working at 60% capacity, right? Let us say plant B is working at 80% capacity. Now you should always be careful. What you need to do is convert both the plants into 100% capacity, right? And then you add it up. Clear with this? Because 60% capacity of plant A and 80% capacity of plant B can't be added as such, because presently they are working at the 60% and 80% capacity respectively. When you are merging, what is totally available is 100% capacity. So you convert everything into 100% and then apply the concepts of marginal costing for the merged plant at 100% capacity. Clear with this, guys? An example is given here. Look at this. Company A is presently operating at a capacity of 60%, and at 60% capacity level, they are generating sales of 300 crores or 300 lakhs or whatever it is, right? The VC ratio is 50%, which means the PV ratio is how much? 50%, right? And the fixed cost is 30 crores. Similarly, company B is operating at 90% capacity level with a sales of 540 crores, right? The VC ratio is 70%, which means the PV ratio is 30% and the fixed cost is 75. Now, when I am merging the two, I can't say, okay, company A plus company B, merged plant, sales is going to be 300 plus 540, so it is going to be 840. No, please do not do that. What you need to do, first convert both into 100%, because when two plants are merging, obviously what is getting merged is 100% capacity, right? Once you convert that, then you decide what needs to be your activity level of the merged firm. That is different. But when you are merging, you merge it at 100%. So now this is 300. Convert it into 100%. How will you do that? If 300 is 60, how much is 100, right? So the merged, the sales value at 100% capacity level of A is going to be 500. Similarly, for B, it's going to be 540 divided by 90 into 100. That's going to be 600. Add the two. Now, if I'm merging these two firms, the total capacity sale is going to be how much? 1100. Similarly, they have given that the VC ratio is 50%. So here, obviously, apply this 50% on the 100% capacity level. So 50% of 500 is 250. Here it's going to be 70%. 70% on 600 is going to be 420, right? Add the two, you will get how much? 670, right? Now you get the contribution of the merged firm. Are you clear with this? So now you can say that the merged firm's PV ratio is going to be 430 divided by 1100. It's going to be 39.09%. Are you clear with this, guys? Are you clear with this? Now, fixed cost, don't do the same thing for fixed cost also. Don't say, fixed cost is going to be 30 divided by 60%. No, fixed cost remains constant irrespective of your activity level. So, fixed costs are addable as such. Correct, no, guys? This 30 crores of fixed cost, what they have given here, whether this company operates at 60% capacity or it operates at 100% capacity, it will continue to be 30 only. That is the concept of fixed costs. If you say this is also 30 divided by 60 into 100, then you're treating fixed cost as variable cost. Are you clear with this? So fixed cost can be addable as such because they are not dependent on the capacity or the output level. So now what will I say? The fixed cost of the merged firm is 30 plus 75. How much is this? 105. Are you clear with this? So the break-even point of the merged firm is going to be your 105 crores, the total combined fixed cost divided by the PVR of the merged firm. So now I will say, look, I need to generate sales worth 268.61 lakh rupees in order to break even. Are you clear with this? This is post the merger. Are you clear with this, guys? Right? You guys are able to follow this, right? Next, one more thing. What is the sales required in the merged firm to earn a profit of 20 lakhs? Simple. So the required contribution will now be 20 lakhs plus 105 lakhs, right? So the required contribution divided by, take up the PV ratio of 39.9%, 39.09%, you will get the required sales to earn a profit of 20 lakh rupees. The remaining part are all similar to the basic concepts. The only thing that you need to know here is when you're merging two firms, convert both the firms into 100% capacity and then merge it. Clear with this, guys? Are you all clear with this, right? Yes, please respond, guys. Use the chat box. Are you guys there? The whole point of having a live session is only for that. Done, right? Fine. So sensitivity analysis is also done. Merger of plants is also done. Okay, so now we are left with a few more concepts. Just a minute. Let us just go and take the scoreboard. So this is done. This is also done. Okay, so I think we are just left with 3 more areas in this one, in this particular CVP analysis, and apart from that, we've also got something to do in absorption costing versus marginal costing, right? Done, not a problem. So now guys, can we take a small break now and we'll just come back and finish off the remaining part of the chapter? Yes, you guys want a break now?
Yes, sir.
Right, okay, it's been about 2 hours plus, so yes, we'll take a break right now. Maybe we'll meet back at so at 10:45 works, right? About 15 minutes break. Okay, great then, so we'll meet back at 10:45 sharp, right? About 15-17 minutes, little over 15 minutes break. So we'll meet back at 10:45 guys, right? So we'll be finishing off this chapter and then we'll proceeding with your process costing. Yeah, done. But hope we can start now. Where is my pen? Done guys, perfect. Now let's move on to the next concept called as indifference point, right? So now we are left with 3 concepts plus 1, so overall 4 concepts. We'll be doing it right away. So the next one is the concept of indifference point. Just a minute. Right. Now, what is this concept of indifference point all about? I'm using a short form, IDP. Now guys, right now we all have this, you all must be using this Jio SIM, right? But before 2016, that was before when Jio, entered the market with a bank. Now we all had the other players, like there were so many players, like Aircel, Uninor, there were so many players. And there was always one, decision that we all had to take in our real day, everyday life. So that was regarding prepaid versus postpaid. Now we don't have this decision to be taken because anyways, though we all go for a prepaid plan, it's all unlimited calls and all that. But back then, these guys were looting us literally. They used to charge hefty amount and they say we are complimentarily giving you 750 MB per month, it seems. So now we use about 2 GB per day. So that's what they used to do quite a while back. That was before 2016 when Jio entered the market. Now guys, using this example of a prepaid versus postpaid SIM, we can understand the concept of indifference point, and let's see what it says. Now in prepaid SIM, generally what happens is, now they will say per call you need to pay how much? 50 pice. An example I'm saying, they will say per call, or let's say per minute of talk time, you need to pay 50 pice, right? And since we are giving you that SIM card and we are blocking the number for you, that is, they are giving you the mobile number, so the SIM usage charges monthly is going to be 100 rupees, or in other words, here the variable cost is going to be 50 pice and the fixed cost is going to be 100. Whereas if you go for a postpaid plan, what they will say is, look, it's a postpaid plan, that is, you can talk for how many number of hours you want, it's fine. At the end of the month, we will prepare a bill and we will give you, right? So what happens here is, per minute, they will charge us, let us say, 30 pice, right? That's 0.3 rupees, okay? And they will say monthly rentals for us is going to be 500 rupees. Generally, what happens in a postpaid plan, if you see, they will have a monthly fixed charges, right, which is slightly higher, and they will be having a lower cost per every minute of talk time. This is how it used to be. And of course, in the prepaid, if you see, the fixed cost will be less, right? But every time you make a phone call, the charges will be high. Now, you tell me guys, out of prepaid or postpaid, which one is better? Out of prepaid or postpaid, which one is better? Now, there is no one such answer, a flat blanket answer saying always prepaid is better or always postpaid is better. Had that been the case, then there would have been only one plan. They wouldn't be having two plans, fully aware of the fact that always one plan is better than the other. Now, sir, how are you saying that, we can't come to a conclusion like that? Because both the alternatives have one disadvantage and one disadvantage. In case of a prepaid plan, the advantage is by way of a lower fixed cost. Whereas in case of a postpaid plan, the advantage is by way of a lower variable cost. Clear with this, guys? So now, imagine you are a person who is a missed call party, right? So that is, you will not call anyone. Now suddenly after Jio, everyone started becoming generous. They didn't become generous. That is because of unlimited talk time now being available. But before, let us say you are a missed call party, you don't want to spend much, but you need to have a mobile number for sure. Which one will you prefer? You will only prefer prepaid. Why? Because anyways, you are not going to make much calls, right? You just need to have a number. You will go for that option that gives you a lower fixed cost. Correct, guys? Yes, the reason is that anyway your volume is less. Correct? The number of phone calls you will make is less. If at all once in a while I make a phone call, it is okay. I am ready to pay some 0.5 rupees instead of 30 paise. I am ready to pay 50 paise. That is fine. But I will not be ready to commit a higher fixed cost. 500 rupees and all, I will not be ready. I will obviously go for the option that has a lower fixed cost. Correct? Suppose you are a businessman, you need to make a lot of phone calls necessary. Now, predominantly since your volume is higher, your overall cost will be having more of a variable component. So you will be driven by that alternative that gives you a lower variable cost. So now in this case, it makes sense to go for a postpaid plan. Or in other words, to put it simple, when your volume is less, it is always better to go for that option that has a lower fixed cost. And when your volume is high, it is always preferable to go for that option that has a lower variable cost per unit. But there will be exactly one point where both the alternatives will give you the same result, and that point is called as an indifference point. You are not being different to the both alternatives. It's called as an indifference point. Are you clear with this? Right? Are you clear with this? So the point, again, the point here is what? The point of volume, the point of sale, where both the alternatives will give me the same cost, right, is called as my indifference point. Now, how do you calculate the indifference point? Very simple. I need to find out at what point of volume both the alternatives will give me the same cost. Let the volume be X. We need to calculate X only right now. So alternative 1's total cost will be how much? 0.5X plus 100. Correct? We should be equal to 0.3X plus 500. Yes, guys? Right? So now this is going to be 0.5X minus 0.3X. I am bringing this to the LHS and taking this forward to the RHS is equal to 500 minus 100. Correct? Right? Or in other words, I will take X common out here and say X the whole into 0.5 minus 0.3 is equal to 500 minus 100. Or in other words, X is equal to 500 minus 100 divided by 0.5 minus 0.3. This is nothing but 400 divided by 0.2. How much is 400 divided by 0.2? That is going to be 2000. Are you clear with this? 2000 units, or in this case, I will say 2000 calls. If you are a person who knows that in a month you will definitely make 2000 phone calls, right? If you're exactly making 2000 phone calls, whether you go for a prepaid plan or you go for a postpaid plan, your final bill amount will be the same. But if you are planning to make a number of phone calls which is less than 2000 numbers, which is less than 2000 phone calls, in that case, it is preferable to go for prepaid because it has a lower fixed cost. No, sir, I'm a businessman, I'm going to make more than 2000 calls. Now, predominantly, your total cost will be driven by variable cost. So, you go for that option that gives you a lower variable cost per unit. Are you clear with this? Or in other words, how this indifference point concept helps us is, so there is an indifference point in this case, which is 2000 units. Right? In this case, it's a phone call. Suppose, let's say a company is manufacturing. They have two alternative ways of production. Right? Which alternative should I go for? Using both, let's say machine 1, machine 2, right? One machine has a higher fixed cost, lower variable cost. Another machine has a lower fixed cost, higher variable cost, as the case may be. Now, in this case, which machine should I use for production? First, you calculate the indifference point, right? If your planned volume is less than your indifference point, go for that option that has a lower fixed cost. And if your planned volume is more than your indifference point, go for that option that has a higher, again, talk in terms of advantage. So that has a lower variable cost per unit. Are you clear with this, guys? And at exactly the break-even point, whether I go for alternative 1 or I go for alternative 2, I will end up getting the same result. And this is the concept of indifference point. Clear with this, guys? So how do you calculate indifference point? If you look at this, it is nothing but difference in fixed costs divided by difference in variable cost per unit. Are you clear with this, guys? Are you clear with this? So your indifference point formula calculation is going to be difference in fixed cost divided by difference in variable cost per unit. Are you clear with this, guys? Done? You guys are able to understand this? You guys are able to understand this? Now, let me just add up one more, let me just continue with this example. Let us say we are running a call center. Okay. Let us say we are running a call center. Now, in this call center, so what is the work of a call center? Basically, a bank will hire a call center. They will say, in a month, you need to call and disturb so many number of customers. Correct? So that's why we keep getting a lot of phone calls for all these loans, credit cards and all that. Why are they doing? Are they doing it because they like you or they want to talk to you? Absolutely no. They have targets. Correct? So that is the reason why they do it. Now, let us say a bank has approached us. We are running a a call center. They are saying, look, for every call you make, I am going to pay you 1 rupee. For every call you make, I am going to make you 1 rupee. Now you tell me, guys, will the bank be bothered whether I use a prepaid SIM or a postpaid SIM? No. The bank is not going to get bothered whether I use a prepaid SIM or a postpaid SIM. Correct? Now, what happens if I use a prepaid SIM, if I use a postpaid SIM, right? The scenario will be as follows. The selling price will be 1 rupee. That is from the perspective of the call center. It anyways will get 1 rupee. Correct? No? Whether I use a prepaid SIM or a postpaid SIM, per call I will get 1 rupee. Who will pay me? The bank will pay me. Correct? Right? Minus variable costs. If I use a prepaid SIM, my variable cost is going to be how much? 0.5 rupees. Whereas if I use a postpaid SIM, my variable cost is going to be how much? 0.3 rupees. Correct, guys? Yes. Now, what's going to be my contribution per unit? My contribution per unit or per phone call is going to be 0.5 if I use a prepaid SIM, and it's going to be 0.7 if I use a postpaid SIM. Correct? Now, what will be the fixed cost? The fixed cost will be, if I use a prepaid SIM, it's going to be 100. If I use a postpaid SIM, it's going to be 500. Clear with this, guys? Now, in this case, now, what is the indifference point? Indifference point is the point, right, where both the alternatives will give me the same amount of profit. Correct, guys? Indifference point is that point where both the alternatives will give me the same amount of profit, right? The results could be either calculated as a cost or the results can be calculated from the profit angle. Correct, guys? So now, at what point of sale, or in other words, how many phone calls should I exactly make so that whether I use a prepaid SIM or I use a postpaid SIM, both will give me the same profit. So now I need to calculate the X value, which is nothing but the indifference point. Can I say the profit generated by a prepaid SIM is going to be 0.5x minus 100 rupees. Correct? Yes, guys. Right? Minus 100 rupees. Similarly, this will be equal to the postpaid's profit is going to be 0.7x minus 500 rupees. Right? The profit is going to be contribution minus fixed cost. Guys, correct? Or in other words, can I say this is nothing but 0.5. Okay. So let me just bring it up here. So this is going to be 500 minus rupees 100 is going to be equal to 0.7x minus 0.5x. Correct? Right? Or in other words, again, so here I will just take x out in common and say it's 0.7 minus 0.5 is equal to rupees 500 minus rupees 100, or here x is equal to rupees 500 minus rupees 100 divided by 0.7 minus 0.5. So this is going to be rupees 400 divided by 0.2. So how much is 400 divided by 0.2? Once again, that's going to be how much? Same 2000. Are you clear with this? So exactly if I am planning to make 2000 phone calls, that is at the indifference point of 2000 phone calls, right? Whether I use a prepaid SIM or I use a postpaid SIM, both alternatives will give me the same amount of profit. Clear with this? Suppose I am planning to make a lesser phone call, I mean a lesser number of phone calls, that is if my volume is lesser than the indifference point, then what you need to do, you go for that option that gives you a lower fixed cost. Clear with this? Suppose you are planning for a volume which is more than the indifference point, you go for that option that gives you a higher contribution per unit. Lower variable cost means what? Higher contribution per unit only, no? Are you clear with this, guys? Right? It gives me a higher contribution per unit. Are you clear with this? Or in other words, I can also say that my indifference point calculation is nothing but difference in fixed cost divided by difference in contribution per unit. Agreeing with me on this? Because the difference in contribution per unit is purely nothing but happening because of difference in variable cost per unit only. Are you clear with this? In both the scenarios, the selling price is the same. Still, why am I having a different contribution? It is because of the change in variable cost. So the difference in variable cost is equal to the difference in contribution. Are you clear with this, guys? So in this case, can I say that indifference point is nothing but difference in fixed cost divided by difference in variable cost per unit, or I can also say it is difference in fixed cost divided by difference in contribution per unit. Are you clear with this, guys? Are you all able to understand? Right? Indifference point means what? It is a point of sale, clear, at which two alternatives are giving me the same result. Right? Clear with this, guys? Now, since it is a point of sale, this can also be expressed in value, correct? If I want to express in units, I do it like this. If I want to express in value, what will I do? Instead of variable cost per unit, I will use VC ratio. Instead of contribution per unit in the denominator, I will use PV ratio. That's about it. So it will be difference in fixed cost divided by difference in VC ratio, or it is difference in fixed cost divided by difference in PV ratio. Are you clear with this? Now, what am I going to do? Why do I need an indifference point? Only if you calculate an indifference point, right, you will know when to choose which alternative. If the volume level is going to be lesser than the indifference point, always go for that option that gives you a lower fixed cost. If the desired volume is going to be greater than the indifference point, always go for that option that gives you a lower variable cost, or you can, in other words, you can say a higher contribution per unit. Are you clear with this, guys? Right? In your everyday life, you can use the concepts of indifference point. Now, another real life example for indifference point would be, right, in your everyday life, you can maybe help your parents with this. Whether to buy a water can or whether to buy an aqua guard and keep it. If you buy an aqua guard, the fixed cost will be high. You will not be having any variable cost, because anyways you take the water from the tap, correct? Whereas on the contrary, if you are buying a water can, right, the variable cost will be high. Every time you buy a can, you need to pay him 30-40 rupees, whatever it is, right? Whereas the fixed cost might not be much. So now, when will you go for which alternative? Depends on the water consumption in your house. If you are a joint family, it makes sense to buy an aqua guard. If you are a nuclear family, it really makes sense to buy a water can, because the consumption will be relatively less. These kind of practicalities you can apply in your everyday life as well, and that is about the concept of indifference point. Now clearly understand, guys, the concept of indifference point comes into picture only when I am evaluating two different alternatives. Do not mistake your indifference point as break-even point. Break-even point, I need not have two alternatives. Break-even point is given a fact, given a particular product's income earning capacity, like sales, contribution and all. For this, when will I recover my fixed cost? That's all. There is not much of comparison between another alternative. The concept of indifference point will kick in only when I need to evaluate between two alternatives and take the best one out of it. Are you clear with this, guys? Right? Yes, you guys are clear with this. Please use the chat box. Just tell me if you guys are understanding this. We'll proceed to the next one. And let's see, is that about the number of questions we've got here? Yes, I think that's about this particular concept as well. Okay, so now look at this. This is what we have mentioned here. You can just be, you can just go through it once. That's about the concept. It's nothing but your change in fixed cost divided by change in variable cost per unit, or in other words, it's change in fixed cost divided by change in contribution per unit. And if your expected volume is exactly at the indifference point, you can go for any option. Less than your indifference point, you should always go for the lower fixed cost option. If your volume is expected to be greater than the indifference point, go for the option that has a low variable costs, or in other words, I can say a high contribution per unit. Are you clear with this, guys? Right? And that's about this particular concept of indifference point. See, this is what they are saying, right? At the indifference point, the two alternatives are better, right? Two alternatives will give you the same result. Below the indifference point, if you see, one alternative is better than the other. Beyond the indifference point, the second alternative is greater than the first one. Clear with this, guys? And that's about the concept of indifference point. And I think, yes, they have given one example as well. Let's quickly do this. Now, let's say I can carry out the production either using machine 1 or machine 2, right? If I use machine 1, the fixed cost is 1 lakh, but the variable cost is 5 rupees. If I go for machine 2, the fixed cost is 60,000 only, but the variable cost is more, 9. Now, which machine is better? Now, I can't come to a conclusion on the face of it, because machine 1 has an advantage of a lower variable cost, whereas a machine 2 has an advantage of a lower fixed cost. Both the alternatives are having one advantage and one disadvantage. Only then, the concept of indifference point will kick in. If, let's say, only one option has all the advantages, then I need not even take a decision. I will only go for that. Are you clear with this, guys? Right? So now in this case, what happens, right? Find the indifference point and recommend the range of activity where one machine is better than the other, and suggest which one to buy if the production is 12,000 units. So now what do? The cost indifference point is going to be the difference in fixed cost divided by difference in variable cost per unit. So here the difference in fixed cost is 40,000, difference in variable cost per unit is 4. So 40,000 by 4, it's going to be 10,000 units. So now what will I do? If my desired volume is exactly 10,000 units, whether I use machine 1 or I use machine 2 for production, it's going to give me the same total amount of cost, correct? If my desired volume is less than 10,000 units level, then here I should go for that alternative that has a lower fixed cost. That is, I will go for machine 2, correct? And if my desired output level is greater than my 10,000 units level, the indifference point, now it makes sense only to go for that option that gives me a lower variable cost per unit. Are you clear with this, guys? This is the reason why, if you see startups, what they do is they don't invest huge amount in fixed cost. If you look at small companies which are just starting up, at the beginning stages, they will not buy any office space. They will take it on rent, because they don't want to commit a huge fixed amount. The moment they grow big, now they buy multiple properties and keep, because now their volume is increased. They will be heavily driven by variable cost. Now they can't afford a high variable cost. They are fine with a high fixed cost. That's when they will end up buying properties for themselves. Clear with this, guys? These are some real life scenarios where indifference point can also be used. Done, guys? And that's about this particular segment. Look at this. If the expected level is greater than 10,000 units, so you go for what? M1. And if it is less than 10,000 units, go for M2. And exactly at 10,000 units, you use any machine. And to answer the second part of the question, so if my expected volume is 12,000 units, it's beyond 10,000, so I will go for the first machine, right? Go for M1. Clear with this, guys? And that is about the concept called as indifference point. Clear with this? Shall we move on to the next one? Guys? Yes. Okay. Now, next one is a concept called as shutdown point. Now this concept again is an extension of indifference point, but it's slightly different, and let me tell you what it is. So this area is also known as shutdown or continue decision. Shutdown or continue decision. Now, what does this concept talk about? I mean, what are we going to learn in this particular concept? Now, let's say I am running a company and it's super successful. It is super successful, not at all a problem. Suddenly, COVID came. Suddenly, a temporary feature is hindering my business. Okay, a temporary feature is hindering my business. Now, Now, the government has announced a lockdown, let us say for the next 3 months. Okay. Now, what happens? The decision that we are going to take here is there is going to be a temporary downfall in the market, right? A temporary downfall in the market. Now, during this 3 months, I know that before this period, my business is running fine. After this 3 months also, my business is going to run super fine. I don't have a problem with that. But I know that there is going to be a temporary hindrance in my business. Now, during this time, I know that the market is going to be dull. The decision that we are going to take here is, should I shut down my business temporarily for the next 3 months, or should I continue? The question is not about a permanent shutdown. We are not taking a long-term decision. If there is a temporary recession in the market, right? Does it make sense for me to continue, keep my shop open for those 3 months also, or is it better to keep it shut down? Clear with this, guys. This is the decision that we are going to take here. Now, let me just give you an example. Let us say, example, guys. I am running a physical academy. I am running a physical institute, a physical academy, CA coaching. Example, I'm saying. Now, what happens is, now, during this COVID time, institute cancelled one attempt. You know that, right? I think in 2020, yes, they cancelled one attempt. May attempt was cancelled, I think so. Now, let us say that, okay, I am running a physical academy. I'm being very clear because only that will relate to this example. A physical academy I have where students will come and attend. Now, what happened is, there was this attempt got cancelled by the institute, right? Now, I have to decide whether I need to keep my shop, that is the physical academy, I need to keep it open for the next 6 months or not, because I know that till now many students were coming. Even after the 6 months also many students will come. The question is only about the temporary period of the next 6 months. Should I keep my business open? That is, should I keep my shop open or should I shut it down? Basically meaning what? If I shut down, will there be any benefit and all? I need to analyze. Clear with this? Now, what will be the cost and benefit of shutting down? If I shut down, what will be my benefit and what will be my cost? Now, let us say I am running this academy, I told you, and let us say that I have hired faculties also for other subjects. Example I'm giving you guys, right? Now, what happens? There are two types of fixed costs that I am incurring in this particular business model. One is called as an avoidable fixed cost. The other one is called as unavoidable fixed cost. Now, what is an example of avoidable? What is an example of unavoidable? Now, let me say I have taken a place on rent, right? Now, irrespective of whether the next attempt is going to get conducted or temporarily if I shut down or keep it open, definitely I need to pay my landlord. Correct, guys? I need to pay my landlord for sure, right? So let us say I need to pay about 1 lakh rupees every month as a rent. Now that is rent is an example of unavoidable fixed cost. Are you clear with this? Right? Now I also hired faculties, right? And let us say I am paying the faculties a fixed amount if they conduct one batch. If you take one batch, I will give you so much amount of money, right? Now the faculty fee is an example of avoidable fixed cost. Sir, how is it an example of avoidable fixed cost? Suppose the next batch is getting cancelled, the faculties need not come and take, right? So if they are not coming and taking, I need not obviously pay them. Are you clear with this? Sir, is it a variable cost? No, it doesn't depend on the number of students who enroll. I just pay them a flat fee. Example I'm giving you, right? Now, a faculty fee is an example of avoidable fixed cost, whereas a rent is an example of unavoidable fixed cost. I need not pay the faculty any fee if the batch is not conducted, whereas I need to pay my landlord the rent irrespective of whether the batch is conducted or not. Are you clear with this? Now, in this scenario, what happens is if I shut down the business, now what will be the benefit for me? I can save the avoidable fixed cost. Correct? No? If I'm shutting down the batch for the next 6 months, if I'm shutting down my business, what happens is the faculty fees need not be paid. Are you clear with this, guys? Right? The faculty fees need not be paid. That is one savings for me. Right? Now, what will be the cost? What will be the cost? Now, there are two types of costs that I incur. The first one is called as shutdown cost. Now, this shutdown cost is not unavoidable fixed cost. No. Because I am shutting down, I will be incurring some extra cost. For example, let us say I have a factory during the COVID time, many people shut down their factories, correct? Now, you know what? When the machines are being run every day, it is slightly easier to maintain. If the machines are not being run, they require some additional maintenance. A typical example is during COVID time, they had imposed lockdown restrictions and you guys would have been having your vehicles and all, no? Right? You were supposed to not take your vehicles outside. I don't know whether you did, but yes, we're not supposed to take it. Let's say you never touched your vehicle for about 1 month. So on the 31st day, when the lockdown got lifted, so the first place that you visit is the mechanic shop. Correct? Because when a particular engine is not being used, a machine is not being used, it requires some additional level of maintenance. Had you maintained it properly during those 30 days, maybe then your your vehicle would be working properly. So why am I saying this? When you are shutting down, you need to spend some extra money on maintaining your machines. This otherwise I will not be incurring. Are you clear with this, guys? So if I am shutting down, extra what I will be incurring, the extra cost is shutdown cost. Are you clear with this? And there is also one more thing, the contribution lost on shutdown period demand. On shutdown period demand. On shutdown period demand. What is it? Now, I know that generally every batch, example I'm giving you, 100 students will come and attend face to face if I announce a batch, right? Now, during the COVID time, even if I announce, only 5 people were ready to come. Example I'm saying, suppose I shut down, right? That 5 people's contribution that I will be earning, that also I cannot earn, correct? No, that is, if I shut down, I will be losing out on the contribution that I could have possibly made during the shutdown period demand. Are you clear with this, guys? Are you clear with this, guys? So basically, there is a cost benefit analysis that needs to be done. If I shut down, the benefit is savings in avoidable fixed cost. That's all. And if I shut down, I need to incur 2 additional costs. One is the shutdown costs. That is the additional cost that I need to exclusively incur if my business being shut down, and the other one is if I'm shutting down, I lose out on the contribution that I can possibly make during the shutdown period demand. Clear with this, guys? Clear with this, guys? Now I need to evaluate this cost and benefit, right? If my benefit is greater than the cost of shutting down, then I will go and happily shut down. If not, then I will continue. Are you clear with this, guys? Right? Now let me just give you an example. Let us say I am just shutting down. Oh, one second. Yeah. So now let us just take an example. Let's say I'm planning to shut down, right? And the benefits and cost details are as under. Let's say the avoidable fixed cost is going to be 1 lakh rupees. This is the amount I will be saving. Okay. And the cost will be, if I shut down, I will be incurring a shutdown cost of 40,000 rupees, right? Of 40,000 rupees. And let us say the contribution lost will be, during the shutdown period, I am expecting my demand to be 3,000 units only, right? And every unit gives me a contribution of 4. Example I'm giving you. Right? So now what will be the contribution lost? If I shut down, even these 3,000 units I will not be able to sell. So the contribution loss will be how much? 32,000 rupees. So now you tell me, if I shut down, the benefit is how much? 1 lakh, but I am only losing how much? The cost is going to be 72,000. So I will be having a net benefit of how much? I will be having a net benefit of 28,000. Now in this case, it makes sense to shut down, correct? I will say, sir, fine, please shut down, because the benefit of shutting down is more than the cost of shutting down. So it's going to be a 28,000 rupees is the net benefit. You do it. Clear with this, guys? Now, same example. Yes, hello.
The contribution loss is 3,000 or 8,000. 3,000 into 4 or
It's I'm sorry, it's 8,000 ma. I'm so sorry. Yes, it's 8,000 into 4. Right, you're right. It's 8,000 into 4. I'm sorry. I just thanks for telling me that it's 8,000 units. Okay, so it's 8,000 units into 4, right? So the contribution loss is going to be 32,000 rupees. So assuming that during the shutdown period the demand is only going to be 8,000 units. Generally I'm running a business where I'm going to sell 1 lakh units every month, then I will not be having a question of shutdown and all. Now because of some temporary phenomenon during this period there is going to be 8,000 units of demand only. Now because of this recession I am thinking. Clear with this, guys? So yes, I stand corrected. It is 8,000 units is going to be the shutdown period demand with a contribution per unit of 4. So now the contribution loss, if I shut down, I cannot even honor this 8,000 units of sales, so it's going to be 32,000 rupees. Clear with this, guys? Now I am just giving another example with a small change. Now let us say in this scenario, again the avoidable fixed cost is going to be the same 1 lakh rupees, right? And if I shut down, the shutdown cost will continue to be 40,000 rupees. I'm just making one change. During the shutdown period, I am estimating a demand of 20,000 units instead of 8,000. Now I am expecting a demand of 20,000 units. So now you tell me, so the contribution loss will be how much? 20,000 units into 4, correct? So if I shut down, I am losing out on 20,000 units of sale, which each of which can generate me a contribution of 4 rupees. So that is going to be how much? 80,000 rupees. Are you clear with this? So now this is going to be how much? I will be losing out 1,20,000, but I will be getting a benefit of 1 lakh rupees. So now tell me, if I shut down, the costs of shutting down is much higher than the cost of the benefits that I get out of shutting down. Here it is going to be a negative 20,000. The net benefit of shutting down is going to be a negative 20,000. Or in other words, in this scenario, it makes sense for me to continue my business even though there is my business is not up to the mark, I know. But even in this scenario, it makes sense to continue because the benefit of shutting down is less than the cost of shutting down. The costs are more. If I shut down, the costs are more, so it's better to continue. Are you clear with this, guys? Are you clear with this? Or in other words, once again, the hero of this area is what? The demand, the volume. That's why we call this marginal costing as cost volume profit analysis. So, sir, when should I shut down? When should I continue? The decision depends on the shutdown period demand. If you're having a very good demand, right, you can actually, no problem, you can continue. If you're having a very low demand, then you should definitely shut down. But there is an exact point where whether you shut down or you continue, you will be indifferent. That is basically what your benefits will be equal to the cost, correct? No, that point is called as shutdown point. Why do we need to calculate the shutdown point? If your shutdown period demand is expected to be greater than the shutdown point, then it's always better to continue. If your shutdown period demand is less than your shutdown point, then you should always shut down. And at the shutdown point, if you want, you continue, or you don't want, you don't continue. But anyways, it is going to be the same benefit. Are you clear with this, guys? So now, how do I calculate the shutdown point? The shutdown point is a point of the volume or the demand where my benefit is equal to cost. Agreeing with me or not? Or in other words, can I say it is going to be 1 lakh is equal to 40,000 plus 4x. That is, I need to calculate x. X means what? The shutdown point, that is exact demand. Clear with this? The demand, the shutdown period demand, which makes my benefit equal to cost. Here the benefit is 1 lakh. The cost is going to be 40,000. That is your shutdown cost plus your contribution loss of 4x. Clear with this, guys? So now, how do I calculate this? Can I say 4x is equal to 1 lakh minus 40,000, right? Or x is equal to 1 lakh minus 40,000 divided by 4. So how much is this? This is going to be 60,000 divided by 4. That is going to be 15,000 units is my shutdown point. What is the meaning of this? So the shutdown point of 15,000 says that during the next 6 months, right, if I am expecting a demand of less than 15,000 rupees, it is better to shut down. If I am expecting a demand of more than 15,000 rupees, then the market is vibrant. Only then it makes sense to continue. If it is going to be exactly 15,000 rupees, whether I shut down or I continue, I will be getting the same result. Are you clear with this? The formula for shutdown point hence is nothing but avoidable fixed costs minus shutdown cost divided by contribution per unit. This is also nothing but difference in fixed cost divided by difference in contribution per unit. So then only one contribution per unit is there, no sir? Because if I shut down, I will not be selling anything, correct? So the contribution of that alternative is 0. This 4 rupees is the contribution that I will be getting only if I continue, right? So it's ideally 4 minus 0. Are you clear with this? So this is actually based on the concept of indifference point, but clearly understand my shutdown point formula is going to be what? Avoidable fixed cost minus shutdown cost, the whole divided by contribution per unit, right? Again, shutdown point is nothing but a demand or a sales volume. If you want to express this in value, shutdown point in rupees is equal to avoidable fixed cost minus shutdown cost divided by what? Divided by PV ratio. Are you clear with this? Wherever demand comes in, whether as sales or as break-even point or as margin of safety or as indifference point or a shutdown point, right? Wherever you are using contribution per unit, replace it with PV ratio to arrive it in value. Are you clear with this, guys? Right? This is the formula which can be logically arrived. It is a point where my benefits is equal to cost. So if your expected volume is greater than shutdown point, please continue your business temporarily only. All these are temporary decisions. If it is going to be if your expected demand is going to be less than your shutdown point, then it makes sense to shut down your business. Are you clear with this, guys? You guys are able to follow this? You guys are able to follow this, right? Fine. And that's what has been mentioned here. Okay. So now, yes, look at this. This is the formula. Avoidable fixed cost minus shutdown cost divided by contribution per unit. Okay. And if your expected sales is going to be less than the shutdown point, you shut down. And if it is going to be greater than the shutdown point, you continue. Clear with this, guys, right? There's one question given here. I think it's just relating to, yes, look at this. The selling price is 20, the variable cost is 14, the fixed overheads is going to be 7,92,000. How many units should be sold to earn a 10% of the takings? Takings means what? Takings means sales. Clear with this? So how many units should be sold here? So now, how do you find this out? It's pretty much simple. So now what you need to do here is, okay, so again put up the marginal costing income statement. Sales minus variable cost gives you contribution, minus fixed cost gives you profit. Right? So your sales is going to be, so they've given the selling price, so 20x, variable cost is going to be 14x, so your contribution is going to be 6x, right? Your fixed cost is going to be 7,92,000. So they are expecting a profit of 10% on sales. So 10% on 20x is going to be 2x, correct? So now we have framed an equation. 6x minus 7,92,000 is going to be equal to 2x, or in other words 6 minus 2, 4x is equal to 7,92,000. X is equal to 792,000 divided by 4. That gives you how much? 1,98,000, right? So you need to sell 1,98,000 units to earn a 10% profit. This is very simple. Now the second part of the question is relating to shutdown point. Calculate the shutdown point if 30% of the fixed overheads are avoidable and interpret the result. Now what they are saying, out of a total fixed cost of 7,92,000, 30% of it is going to be avoidable, correct? 30% is going to be avoidable. Clear? Now in this case, what do? Shutdown point, what is the formula? Shutdown point is equal to avoidable fixed cost minus shutdown cost divided by contribution per unit. Now what's my avoidable fixed cost? Avoidable fixed cost is 30% on 7,92,000. So 792,000 into 0.3. How much is it? 2 lakh. So it's going to be 2,37,600. Now what many students do and commit a mistake is they take the balance 70% as shutdown cost. No. See, unavoidable fixed cost is not shutdown cost. Shutdown cost means what? Because I'm shutting down, what is the extra cost I incur? In this question, have they given anything? Have they given any shutdown cost? No. Which means in this case, the shutdown cost is 0. Which means I did not spend any extra money because I'm shutting down. Are you clear with this? Right? divided by the contribution per unit. In this case, the contribution per unit is going to be 6 rupees. So now how much is that going to be? 237,600 divided by 6. It's going to be 39,600 units. Are you clear with this? So if during the shutdown period, you are expecting a demand of less than 39,600, you please go ahead and shut down. The market is not vibrant. It is not feasible for you to run the show, right? If you are expecting a shutdown period demand to be greater than 39,600, then it's always better to continue, because the benefits will be, it's better if you continue the business, right? And at the shutdown point, you either shut down or continue, both will give you the same result. Are you clear with this, guys? Right? And that is about the concept of shutdown versus continue decision and the shutdown point area. Clear with this, guys? Any issues? Any problem here? Guys, done? Shall we proceed forward? Let's move on to the next concept called as key factor analysis. Just a minute. Yes. Now, let's move on to the next concept called as key factor or limiting factor. So, key factor stroke limiting factor analysis. I hope the YouTube live is fine. Guys, can you just respond to the chat box, please? I just want to make sure that the live is functioning fine. Is it? Okay, great. Okay, thanks Aarti, thanks Murthy. Yes, Aishwarya. Fine, great. Okay, guys. Yes, Gokula. Fine. Okay, Anup. Okay, fine. Now looks like it's working fine. Now, guys, coming on to the another important concept here, which is called as key factor or limiting factor. Again, guys, let me give you an example. Please catch up running notes for this. Now, what is this concept all about? Now, let's say a company is in the business of manufacturing two products, A and B, right? The selling price, variable cost, and the contribution per unit details are given as follows. Now, A and B, just a second. Yes. So every unit of A has a selling price of 10, variable cost of 6. So that gives it a contribution of 4 rupees. And let's say product B also has a selling price of 10. The variable cost is only 4, and the fixed cost is going to be, the contribution per unit is going to be 6 rupees, right? Now, you tell me, guys, which of the two products will you manufacture? Product A or product B? Product A or product B? You will manufacture which of the two products? Product A or product B?
Product B.
Product B, is it? Okay. Now, I would say, why should I take a decision? Why should I say product B? I want to manufacture both the products. As long as a product is giving me a positive contribution, I will be happy to produce both, no? Who is asking me? So contribution per unit can be more. I will also sell unlimited units of B. I will also sell unlimited units of A. What is the problem? Clear? So practically speaking, who is limiting me on telling that no, only produce B? Right? I am finding another profitable product. Relatively, it is lesser, right? So what? I can produce both, together, right? So why am I taking this example is, when there is no constraint or when there is no scarcity of resources, right? I can go for all the options. I need not say that only one or only two, right? The question of choosing between which one to do happens only when there is some scarcity or there is something that limits my production. Are you clear with this? Suppose I am saying, no, maximum you can produce only 10,000 units, right? Whether A or B, maximum 10,000 units only can be produced. Now you tell me, now I will say, now I want to produce B only more, because that gives me a higher contribution per unit. I will go for it. Are you clear with this? Or in other words, only when there is a constraint or a scarcity will there be a question of choosing which one to produce. Are you clear with this? If I don't have a constraint, unlimited capacity I can have, I will try to produce as many number of profitable products as possible. Are you clear with this, guys? Are you clear with this? Right? Yashwant depends on fixed cost. No, it doesn't depend on fixed cost at all. It doesn't depend on fixed cost. Fixed cost is irrelevant for your decision making, because whether I produce A or B, my fixed cost will be fixed cost. Correct? In a factory, I'm going to pay a rent. Using the same factory, I can produce A as well as B. Right? Now, it has nothing to do with the factory rent, has nothing to do with which product I need to produce. So, fixed cost is completely out of this question. Right? Clear with this? Now, so the concept of key factor or limiting factor comes into picture only when there is a constraint. Now, let me just take an example here. Let us say both these products A and B, both of them use a common raw material called as raw material X, and raw material X has an availability of only 10,000 kgs in the market. Or in other words, let's say I have to import a raw material called raw material X. Using this raw material, I can produce both A as well as B. Clear? Both these outputs require the same raw material. Now, the government of India has imposed a restriction saying that, look, you can only import a maximum of 10,000 kgs, right? Now, raw material is a constraint, correct guys? Right? Raw material is a constraint, correct? Now, what happens? They are also giving me a data that, look, raw material X, for me to produce 1 unit of one unit of product A, it requires 1 kg of raw material X, and every unit of B requires 2 kgs of raw material X. Clear with this, guys? This is what they have given, right? And they have also mentioned the demand details. The demand details in the market, right? Product A has a maximum demand of 2000 units, and product B has a total demand of 8000 units. Clear with this, guys? These are the situations, these are the scenarios and constraints that we have got. Now you tell me, right, which product will you be interested in manufacturing? To which product will you give the topmost priority? Tell me, guys, to which product will you give the topmost priority?
Product A, sir.
Which product will you give the topmost priority? Yes. Now, some of you might feel that, sir, then what is the question here? Now, obviously, I will go for product B because it gives me a high contribution per unit. No. The actual answer is you need to give the top priority for product A. And let me tell you why. First of all, find out what is the constraint. Now, I know that there is a market demand of 2000 units of A and 8000 units of B. Suppose if I were to fulfill the entire market demand, tell me what is the total raw material X, quantity of raw material X that I will be needing. So 2000 into 1, right, plus 8000 into 2, 16,000. So if I want to fulfill the entire market demand by producing 2000 units of A and 8000 units of B, the total raw material required will be 2000 into 1 plus 8000 into 2. Agreeing with me? I need 18,000 kgs of raw material X. But how many kgs of raw materials X have I got? Only 10,000 kgs of raw materials X I've got, which means in this case, clearly I know that raw material X is a constraint, or it is a limiting factor. What do you mean by a limiting factor? A factor that limits your production. Are you clear with this? Now what I will do, I will not take the decision based on contribution per unit. I will take the decision based on contribution per limiting factor. Sir, what are you saying? So here product A and B are there. The contribution per unit of A and B is going to be rupees 4 and rupees 6 respectively, right? And then they have given that the kgs of raw material required, for every unit of A it's going to be 1 kg, for every unit of B is going to be 2 kgs, right? So contribution per kg of raw material used is going to be rupees 4, and here it's going to be 6 divided by 2, it's going to be rupees 3 per kg. Are you clear with this? Now if you see, the rankings will be, I will give a first rank to product A and a second rank to product B. Sir, why, sir? Now in this case, guys, clearly we established the fact that raw material X is a limiting factor, it is a constraint, correct? Now if you see, no doubt product B has a high contribution, no doubt, per unit. But what happens? It takes 2 kgs of raw material X to generate 6 rupees of contribution. So technically speaking, every time I lift a kg of raw material and use it to produce product B, I earn only 3 rupees. Whereas though product A has a low contribution relatively, it has an advantage by way of a lower consumption. For me to generate this 4 rupees through product A, I only need to use 1 kg of raw material X. So if I lift to 1 kg of product X from my stores and use it for producing product A, then itself I can generate 4 rupees of contribution. Or in other words, every time I use a single kg of raw material for producing A, I earn 4 rupees of contribution. Whereas if I use the same raw material kg for producing B, net off I earn only 3 rupees per kg. Now, since raw material is a constraint factor, I need to use it so judiciously and properly. So I will go based on the contribution per kg of raw material, and that is the concept of limiting factor. Are you clear with this? So step one, what I do is, first I establish the fact that my raw material is a limiting factor. Then step two, what I do, I calculate the contribution per limiting factor and do the rankings. Clear with this, guys? Now I do step 3, which is allocation of the limiting factor. Allocation of limiting factor. Sir, how will you allocate the limiting factor? First, you will use the raw materials for producing product A. As many units of product A as possible, you do it. Then if there is any kgs of raw material left out, you use it for producing product B. Are you clear with this? How we do this is, we use this template, rank product units, kgs per unit, kgs and sigma kgs, right? So first rank product is product A. Now in the market, we know that the maximum demand for product A is 2000 units that I just told you, and every unit of product A requires 1 kg of raw material. So now to fulfill the entire market demand for product A, you would have consumed how many kgs? 2000 kgs, right? So now as of now, you've consumed how many kgs? 2000 kgs, that is sigma kgs, that is cumulative kgs. Now you go on to the second rank product, which is B. Now come from the back. After producing product B, that is A as well as B put together, what is the total raw material you would have consumed? 10,000 kgs, because that is the maximum you've got. Out of this 10,000, you've already consumed 2,000, which means only 8,000 kgs of raw material are left for producing what? Product B. Are you clear with this? This is nothing but 10k minus 2k, that is 10,000 minus 2,000. And every unit of product B requires 2 kgs of raw material, and I have only 8,000 kgs left for the purpose of producing product B. So max, how many units of product B can be produced? So I would say 8,000 kgs are available, and every unit of B requires 2 kgs. Max, I can produce only 4,000 units of product B. Now this is the best possible sales mix that can give you the maximum amount of profit given the limiting factor. Are you clear with this? So if you want to make the maximum profit given the constraint, now what you need to do is, you need to produce 2000 units of A and 4000 units of B. If you deviate from this, definitely your overall profit will be lesser only. Are you clear with this, guys? Are you clear with this? This is the concept of limiting factor. Are you clear with this, guys? Yes, done. Now, shall we quickly do one numerical problem in this regard? I've kept one numerical problem here. So, yes, it's question number 3, I guess. Yes, question number 3. 1 second. Yes, look at this. The following particulars are extracted from the records of a company. So, product A, product B there, right? So, they have given the sales, consumption of material. Every unit of A requires 2 kgs. Every unit of B requires 3 kgs. Material, direct wages, direct expenses, machine hours used is also given. The overhead expense, fixed is unitized and given, right? And variable is given. Now always remember, for the purpose of decision making, the fixed costs are irrelevant. Why? Whether I produce or not, anyways I'm going to incur it, right? Then why would I consider it? Are you clear with this? So fixed costs are not considered for the purpose of decision making. Now the direct wages per hour is going to be 5 rupees. So this is what they have given. Now A, comment on the profitability of each product, assuming that both the products use the same raw material, when A, raw material is in short supply, and B, the production capacity in terms of machine hours is a limiting factor. First, they are just asking you to comment on the profitability. That's all they are asking you. They are not asking you to do the allocation and all. They are just asking you to comment, which means what? When raw material is a limiting factor, what will you do? You will do the rankings based on raw material contribution per kg of raw material, correct? Similarly, when your machine hour is a limiting factor, you will take the decision based on contribution per machine hour. Clear with this, guys? Clear with this, guys? Right? So that is what you need to mention here. First, they have listed out the selling price and the variable costs. Finally, they have arrived at the contribution per unit of A, contribution per unit of B, and as I just told you, fixed cost should be ignored for the purpose of decision making, because as the name suggests, they are fixed. Okay, so based on your decision, this is not going to change. Clear with this, guys? Right? Now, ranking of the two products when raw material is a limiting factor. So contribution per unit is given. Contribution per unit is given. Yes.
Expenses are they are 15 rupees and 16 rupees.
Sorry, ma. What is it?
Direct expenses.
Direct expenses.
15 rupees and 16 rupees are they.
Okay, just a minute. I think there has been some. Okay, is this calculation coming out to be correct? 1 second.
No.
No. So then this is not 15 then. Then this has to be. This is 5, ma. I'm sorry. This is okay. Direct expense is 5. Right, this is 5 and this is 6. Sorry, that's a typo error. Thanks for pointing out. That's a typo error. So remove this. They have just done. The calculation is correct, I think. The calculation is correct, no? So it's 10 plus 15 plus 5 plus 15. So it's 30, 40, 45. Yes. Here it's 30, 45 and 51. Correct. Right. So it's they have just, it's a typo error, but the calculation they have considered only 5 and 6 respectively. Okay. Right. Hope your doubt is solved. Okay, so now yes, this is what it is, guys. So they have arrived at the contribution per unit. Now in case your raw material is a limiting factor or a constraint, what do? You take the contribution per unit of both the products divided by the kgs of raw material consumed. You will get the contribution per kg, right? Contribution per kg of raw material. Obviously, based on that, I will give a first rank to product A and a second rank to product B. Are you clear with this, guys? Are you all able to follow this? Right? Similarly, suppose in this case, machine hours is a limiting factor. Machine hours is a limiting factor. What will you do? You will take the decision based on contribution per machine hour. So you take the contribution per unit. Every unit requires 3 hours of machine hours and 2 hours of machine hours respectively for A and B. Right? You calculate the contribution per machine hour based on contribution per machine hour. So I will go for product B first, right? And then only if any machine hour is left out, I will use that towards producing product A. Are you clear with this, guys? Are you clear with this? Right? That is about this particular, that is about this particular part A. Now, one more thing I want to tell you, guys. One more thing I want to tell you. Limiting factor. So what could be a limiting factor? Raw material could be a limiting factor. Your direct labor could be a limiting factor. Your units could be a limiting factor. Your machine hours could be a limiting factor. Anything could be a limiting factor. Correct, guys? Guys, yes, you guys are able to follow this, right? Now, if raw material is a limiting factor, we saw in this sum, right? So what happens? I will first give the priority to product A. Anything left out, I will give it to product B. Correct? If machine hours is a limiting factor, I will give the first priority to B. Then anything left out, I will give it to A. Correct? Now, you might be having a doubt, sir, what happens? Can there be two limiting factors parallelly? In real life, that can happen, no? Import restrictions are also there. Local machine hours are also a constraint. Both together can also happen, right? So now, sir, if I do this based on raw material, which is also a constraint, it is asking me to produce product A first. But machine hours is asking me to produce product B first. There is a conflict of ranking. What will I do? In this case, marginal costing cannot be used. In this case, marginal costing cannot be used. Instead, you use a concept called as LPP, linear programming. You guys would have studied in your 12th standard that linear programming, some graphs will be there, shaded region and all. They will say maximize Z is equal to so and so, subject to constraints. They will say 3x plus 5 is less than or equal to so much. 4x plus y is greater than or equal to so much. So you will list the constraints and try to maximize your profit. Using a graphical method or a simplex table, you can arrive at your decision when you have more than one constraint that is anyways not there in your syllabus, in your inter syllabus itself. It's not there. It is a subject matter of discussion in CA final. But remember, those LPP which you would have already studied in your class 12th basics, that is your graphs and all. You guys remember that maximize z is equal to something subject to constraints and all. They will give you 5x plus 3y is less than or equal to 0, is less than or equal to 5000, something like that. They will list out the constraints, and where x comma y is greater than or equal to 0, they will list out the constraints and they will solve it, right? So basically, to put it short, when you have more than one constraints, marginal costing will not be able to do it, right? It can be done only using something called as linear programming problems, which is a subject matter of discussion CA final. Just giving you a bird's eye view on that, right? Now B, they are asking, that is part B of the question. Assuming raw material as a key factor availability of, and the availability of which is going to be just 10,000 kgs, and the maximum sales potential of each of the products is 3,500 units, find out the product mix which will yield the maximum profit. Now what you need to do, you need to do the allocation. So they are saying clearly, assume that raw material alone is a limiting factor, right? In that case, ranking will be what? First I will try to produce A, then any raw material left out I will try to produce B. Correct, guys? So what will I do first? Now allocation of 10,000 kgs of raw materials to maximize the contribution. So first rank product is A. So 3,500 units is the maximum market potential. Every unit of A requires how many kgs? 2 kgs. Yes, it requires 2 kgs of raw material. So for producing A, I would have consumed a total of 7,000 kgs. So sigma kgs, that is as of now the cumulative kg consumed is only going to be 7,000 kgs. Clear with this, guys? Now after producing B also, the total consumption would have been how much? 10,000 kgs. Out of this, I have used 7,000 for A, which means only 3,000 is available for product B. And every unit of product B consumes 3 kgs, which means the maximum possible number of units B that can be produced is 3,000 divided by 3. It is going to be 1,000 units. Are you clear with this, guys? So now this is how I allocate the limiting factor, and when raw material is a constraint and I have only 10,000 kgs of raw material, the best possible mix that can yield my maximum profit is going to be 3,500 units of product A and 1,000 units of product B. So what would be the contribution in that case? 3,500 units into 55 rupees, that gives me 192,500, and 1,000 units into 69 rupees, it's going to give me 69,000. If you add up the two, you get what? 2,61,500. Are you clear with this? This is the maximum possible contribution that you can earn when raw material availability is only 10,000 units. Are you clear with this, guys? And this is the concept of limiting factor analysis. Are you clear with this, guys? You are all clear with this, right? Fine. So in exam, this could be a 10-mark question as well. And one more thing, some students are saying, some students and some even in some YouTube channels, I've seen this. They feel that limiting factor has been removed from our syllabus. Absolutely not. It has not been removed, guys. So what they have done is, in the earlier version of the material, there was one sum that they have removed. They have not removed the concept of limiting factor. That one sum they removed. So many people started creating a buzz saying that, the limiting factor concept itself they have removed from the new syllabus. Absolutely not. It is very much a part of your new syllabus only. Clear with this, guys? So don't fall for it. It is definitely there because it's one of the key aspects of marginal costing. Now, with this, we are done with all the aspects of CVP analysis. We are just left out with marginal versus absorption costing, which we'll be doing right now. Okay. So now all these things are done. Indifference point, shutdown point, and key factor analysis. So now we are left only with the last concept or the segment C of this chapter, which is called as absorption costing versus marginal costing. Now, shall we get started, guys? Yes. Right? Shall we get started? Okay. Now, absorption costing versus marginal costing. what is this concept all about? But before that, let me tell you, this is the only segment in this entire chapter that talks about stock valuation and profit computation, right? Now guys, absorption costing is nothing but the overage chapter that we saw. Now, what does absorption costing say? Now, as per absorption costing, we have seen that costs can be broadly classified into two: manufacturing costs, right, and non-manufacturing costs. Correct? When I say non-manufacturing costs, I mean your AOH and SOH. Clear? That is all the costs incurred outside the factory. Non-manufacturing cost. Correct? Right? And you have manufacturing costs. Right? Manufacturing costs, I can further split it into four. I can further split it into four: direct material, direct labor, direct expense, and production overhead. Right guys? Yes. So overall in costing, these are the costs that we consider. Correct guys? And again, I'm telling you, this segment of discussion talks about what? Stock valuation and profit computation. That's why we are looking at cost from the perspective of your manufacturing, admin and selling. Clear with this guys? Now in your production overheads also, if you see, there could be fixed production overheads, there could be variable production overheads. For example, your power and fuel could be a variable production overheads, whereas a factory rent could be a fixed production overhead. Correct guys? Correct? Yes, done. Okay. Let me just change the sequence here. I will put it here. I will put this one as variable and I will put this one as fixed. Now what is it? Now a company can follow either marginal costing or absorption costing. A company can either follow marginal costing or absorption costing for the purpose of maintaining their costing records. I'm not talking about decision making, I'm talking about records. Costing records, a company can either follow marginal costing or they can follow absorption costing. Now, what we have seen in absorption costing, all the non-manufacturing costs, that is any cost incurred outside the factory, these are all period costs. These are all period costs. Correct? Period cost means what? Not considered for stock valuation directly. P&L items, they get knocked off against your revenue, so they are not used for stock valuation. Correct? Yes guys. And what does our absorption costing says? So stocks, every unit should be valued at full manufacturing cost. Correct? No? Right? That is, to value every unit of a product, it should be valued at the prime cost components, direct material, labor, overheads, and your entire production overheads, that is variable as well as fixed production overheads. Correct guys? Yes, this is what our absorption costing says. Now what our marginal costing says is, look, we are also saying any cost incurred outside the factory should not be considered for your stock valuation, so they are all period costs, no problem. But they are saying every unit should be valued at variable manufacturing cost. That is, marginal costing is also saying use direct material, direct labor, direct expense, and also variable production overheads. So these four are always product costs. They are always product cost, whether I follow marginal costing or I follow absorption costing. Clear with this? But what marginal costing says is, look, fixed production overheads. First of all, marginal costing says over your fixed cost itself should never be unitized, right? Fixed cost doesn't make sense if it is unitized. Marginal costing says just because that fixed cost is incurred inside a factory, please do not consider it for the purpose of stock valuation and all. So what your marginal costing says is, wait, fixed production overheads will never form part of your product cost. That is, treat your fixed production overheads as period cost. Who says this? Marginal costing. Whereas absorption costing says, no, even fixed production cost will be considered as a part of your product cost. So here the issue arises only with respect to the fixed production overheads, right? Wherein the absorption costing says that it needs to be considered as a product cost. It needs to be considered as what? As a product cost. Whereas my marginal costing says, no, anything which is fixed, irrespective of the location, is always treated as a period cost. So now marginal costing treats this as a period cost. Are you clear with this, guys? Are you clear with this? So remember this, marginal costing and absorption costing, both of them are agreeing on this area, right? And both of them are agreeing on this area also, right? Both the methods or both the techniques of costing say any non-manufacturing costs are always period costs, right? And the prime cost components and even the production overheads, variable production overheads, are always product costs. The issue arises only with respect to fixed production overheads, where marginal costing says we will not unitize anything that is fixed. So even the fixed production overheads should not be unitized and should not be considered as a part of your stock valuation. Clear with this, guys? So anything that is fixed production overheads, you directly take it to your P&L. Don't take it to my trading account. Clear with this, guys? Don't consider it for stock valuation. Whereas absorption costing says, no, I will value the stock at full manufacturing cost. Clear with this, guys? Are you clear with this, right? This is the only difference. So look at this. Absorption costing says product cost is going to be direct material, direct labor, direct expense, and my production overheads. Production overheads means what? Full production overheads, variable and fixed. Marginal costing says every unit should be valued at material, labor, direct expense, and only the variable component of production overheads, which means what? The fixed component of production overheads should never enter into my stock valuation as per marginal costing. Clear with this, guys? Right? Now, in both these, so in case of absorption costing, what is a period cost? Only the non-manufacturing cost, that is my AOH and SOH. Whereas in my marginal costing, what happens is not just my admin and selling overheads, but even my fixed production overheads is also forming part of what? It is also forming part of my period cost. Are you clear with this, guys? Are you clear with this? So in marginal costing, the fixed production overheads and admin and selling, not fixed, even if it is a variable. See, guys, admin and selling, even though they are variable, they are also treated as period only, even under marginal costing. See, your AOH and SOH, whether they are fixed or variable, I don't mind, right? They are incurred outside the factory. Both the methods say that they should not be considered for the purpose of stock valuation. So the only difference is happening with respect to the fixed production overheads. Are you clear with this? The fixed production overheads is not considered as a product cost under marginal costing, whereas it is considered as a product cost under absorption costing. Are you clear with this, guys? Then the fixed production overheads are charged as product cost under what? Under absorption costing, whereas the fixed overheads are not charged the products. They are always taken as a period cost on actual basis. Now let me tell you one thing. Now look at this, guys. AOH and SOH are there, right? Whether they are variable or they are fixed. Now whether they are variable or they are fixed, they are incurred outside the factory, right? They are always period cost under both the techniques of costing. Clear with this, guys? Don't think that in marginal costing, if it is variable, I will always treat it as a product cost. No, I'm being very clear. Marginal costing considers only variable manufacturing cost, which means what? The cost needs to be variable and it needs to be incurred inside a factory. Clear with this, guys? So don't say that all variable costs are considered as a product cost under marginal costing. No, if it is a variable cost incurred outside the factory, marginal costing also says don't include it. Are you clear with this? In fact, marginal costing is being extremely cautious, extremely conservative. Here you are taking the full manufacturing cost. I am only taking the variable manufacturing cost. So clearly, I am avoiding the fixed production overheads. Are you clear with this, guys? Basically, what marginal costing says is, if a cost is fixed, right, irrespective of its location, that is whether it is incurred in the factory or if it is incurred outside the factory, fixed, whenever the word fixed comes, it should not be unitized and it should not be considered for the purpose of stock valuation. Clear with this, guys? Clear with this, guys, right? This is similar to that, the dialogue that we have in a movie. நண்பன்ல ஏதுமா நல்ல நண்பன் கெட்ட நண்பன் நண்பனாலே நல்லவன் தான், something like that. Marginal costing says, right, fixedல எங்க product or period, fixedனாலே period தான். So whenever fixed comes in, marginal costing says it's always a period cost, do not unitize it, right? Because it really doesn't make sense if you unitize a fixed cost and push it into the product. Clear with this, guys? Are you all able to understand this? Yes, that is what our marginal costing says. Clear with this, guys? Now, based on this, of course, there is one major difference again. In your absorption costing, you have all the procedures of absorption. That is, first, we need to calculate the absorption rate, charge it off with the products, compare it with the actual, and at the end of the year, you need to calculate the under or over absorption. Are you clear with this? Whereas, if you're following your marginal costing approach, there is no concept of absorption only. Why? Because I've made life simple. Your fixed production overhead should not be unitized. Just now we saw. Then where is the question of absorption? Sir, variable production overhead is there, no, sir? Yes, but it is variable, no? So, as and when the product comes out of the machine, I will know how much it has actually gone into it. Are you clear with this, guys? Are you clear with this? Yes, you guys are understanding this. There is no concept of absorption when it comes to what? When it comes to your marginal costing. Whereas, since we are doing it under absorption costing, in this case, at the end of the year, I need to do that rectification entry of under or over absorption. Are you all clear with this? Are you all clear with this? Now, with this, let us go and do a numerical problem. Let us go and do a numerical problem. Take question number 4. Please take question number 4. A very, very good example. It's a masterpiece. Mark this sum as important because, again, this sum is there in CA final as well. The exact sum, because in marginal versus absorption costing, this is all the concept is. Fine. This is all the concept is. Of course, there are some advanced level as well, but yes, this is a common example which is used in both inter and final. So in your final self-study, self-paced modules, you can also find the same example maybe. Right, now look at this. From the following data, compute the profit under marginal costing and absorption costing and reconcile the differences in profit. Now what they have given, the selling price is 8, variable cost is 4, and fixed cost per unit is 2, right? Now, be very careful here. What they have said is, if I am using absorption costing, right, every unit will be valued at 6 rupees, 4 plus 2, correct, guys? Full manufacturing cost. If I am using marginal costing, every unit will be valued only at 4 rupees. Are you clear with this? Are you clear with this? Right? Now, the normal volume of production is 26,000 units per quarter. So per quarter, the normal volume is 26,000 rupees, right? Now, so with this, you can clearly make out, so 2 rupees is the fixed cost they have given. 2 into 26, it's going to be how much? 52,000 rupees is the fixed cost per quarter. Are you clear with this? So the fixed cost planned per quarter is 52,000 rupees. This will be needing for marginal costing approach. Why? Because marginal costing says fixed cost doesn't make sense if it is represented on a per unit level. Convert it into total value and remove it. That's all. Contribution minus fixed cost. Bulk figure only. No per unit and all. Clear with this, guys? Now, the opening and closing stocks consisting of both fixed goods and equivalent units of WAP are as under. So they have given it here. Quarter wise, they have given us how much is the opening stock, how much is the production, how much is the closing stock, and how much is the sales and closing stock. Quarter wise data is given. Clear with this, guys? Clear with this, guys? Now, they have asked us to prepare a quarter wise profitability statement under marginal costing and under absorption costing. Yes, shall we get started with this? Shall we get started with this? Right? Done? Shall we do this, guys? Right. Now, first, let us do it under the marginal costing income statement. Now, marginal costing income statement, how it looks like, we all know. Sales minus variable cost gives you contribution minus fixed cost gives you profit, right? But till now, we didn't see any kind of stock adjustments and all. So when stock comes in, how do you prepare? The base is the same, but there are some extra things that need to be taken care of for your stock adjustment, right? So first, what do you have? The sales figure. The sales figure will be what? The respective months sales units, the respective quarter sales units multiplied by the selling price. So you will be having the sales value. Correct, guys? Yes. So from my sales, right, I need to reduce the variable cost. When I say variable cost, not the entire variable cost, the variable cost incurred in respect of units sold. Matching concept only, no? Guys, correct? So sales minus variable cost gives me contribution, correct? But what variable cost will I reduce? Variable cost incurred in respect of units sold only. Clear with this? How will I arrive at the variable cost of goods sold? Very simple. Opening stock plus my variable cost of production minus closing stock. If you look at this is my FG, right? If I want to calculate the value of my cost of goods sold, say opening stock plus the current period cost of production minus closing stock. If I adjust for these three, only then I will get my cost of goods sold, correct? But remember, we are in marginal costing area, so which means all these units are only valued at variable manufacturing cost. Hence, I use the word opening stock plus variable cost of production minus closing stock. So variable cost of production means what? Every unit is valued at 4 rupees. Are you clear with this? Are you clear with this? Sir, are you ignoring this 2 rupees, sir? No. 2 into 26, I take it as 52,000. 52,000 will come and hit in bulk. After my contribution, I have minus fixed cost. There I will adjust. I will not unitize it, because if I unitize it, a part of it will enter into the stock valuation and escape to the next year. That I don't want to do. Are you clear with this, guys? Right? So now what happens? The respective number of units are there. So here, opening stock, quarter wise, it's there. So whatever is the number of opening stocks, right, multiply that with 4. Opening stocks are also valued at 4 rupees. Even if there is a closing stock, that is also valued at 4 rupees only. All the units are valued at 4 rupees only. So here, if you see the production and all, so 4 into 26,000, that gives you how much? 1,04,000, right? Here into 30,000 gives you how much? 1,20,000. Then into 24,000 gives you 96, and into 30,000 gives you 1,20,000. Basically what you do, opening stock plus variable cost of production minus closing stock, if you do, quarter wise you get what? Variable cost of goods sold. Are you clear with this, guys? Variable cost of goods sold. Are you clear with this? So now sales minus my variable cost of goods sold, sir, it gives me contribution. I call it as gross contribution. Why, sir, is it gross contribution? It is not net contribution, because now we have only considered the variable manufacturing cost. There could also be some variable cost on the selling side and the admin side, correct? No? Even AOH and SOH could be having some variable component. That's why I'm calling this as gross contribution. From here, I will subtract the variable admin and selling. Right? In this question, it is not there, but I am preparing the format and I'm giving you. Clear with this, guys? If there is a variable admin and selling, remove that also, you get the net contribution. Are you clear with this, guys? Are you all able to understand this? You will get the net contribution. Clear with this, guys? Now from here, reduce the fixed cost. Sir, what fixed cost, sir? Whether it's going to be POH, or is it going to be AOH, or is it going to be SOH? I am not bothered. Fixed means period, always, right? Irrespective of the location, take all the fixed cost and knock it off here. Are you clear with this, guys? Are you clear with this? In our case, quarter wise, it's going to be 52,000. AOH and SOH data is not given. If that is given, you can also add it up here. Clear with this, guys? You reduce that also, you will end up with a quarter wise profit, which is being reported as 52,000, 44,000, 60,000 and 76,000. Clear with this, guys? Clear with this? This is the way to do it. Are you all able to understand this? Are you all able to understand this? Right? Right? Now, suppose we are doing the same question under the absorption costing system. Now, what do? Under absorption costing system, every unit is valued at full manufacturing cost, that is 6 rupees fully. Right, guys? Basically, this is nothing but this 2 rupees is nothing but the absorption rate. Correct? No? Yes, they would have used the absorption rate and arrived at the fixed cost per unit level. Clear with this, guys? So now what would have happened? So you have the same sales figure. Now here what will I do? From sales, I reduce my cost of goods sold. How do you do that? Opening stock plus the full cost of production minus closing stock. Here I value all the units at 6 rupees. Are you clear with this? So multiply the respective units with 6 rupees. You will get what? You will get what? You will get sales minus cost of goods sold gives you your gross profit. This is like your trading account. Are you clear with this? From your gross profit, you reduce your selling and admin. Selling and admin, whether it is variable or fixed, both will come. Variable and fixed, both will come. Here, we are following absorption costing system. We don't bifurcate variable separately, fixed separately and all, arrive at contribution. No. So after gross profit, right, all the variable and your fixed selling and admin overheads will be coming here, right? And one more adjustment is required, which again many students miss, is under or over absorption. Sir, in this question, will there be an under or over absorption? Yes, of course there will be. Of course there will be. Now look at this. In this question, what have they given? The absorption rate of fixed overheads is how much? 2 rupees. Correct, no? 2 rupees per unit, right? So which means 2 into 26,000 is going to be 52,000 rupees was the budgeted fixed overheads. Correct, guys? Budgeted fixed overheads. Now, in the question, have they given how much was the actual fixed overheads? It is not given in the question. If nothing is given in the question, you can take that as the actual fixed overheads. Also, you can assume that budgeted fixed overheads is equal to actual fixed overheads. Clear with this, guys? Right? Now, when budgeted fixed overheads is equal to actual fixed overheads, will there be an under or over absorption? Will there be an under or over absorption? Guys, will there be an under or over absorption? Yes, there could be. Because under or over absorption is a comparison between absorbed overheads and my actual overheads. It is not between budget and actuals. Are you clear with this? Now, in this case, can you calculate the absorbed overheads? Yes. Every unit I absorbed 2 rupees, and month-wise I know actual number of units of production is 26,000, 30,000, 24,000 and 30,000 respectively. Correct, guys? So now what will I do? I will calculate under or over absorption. Actual overheads is 52, 52, 52, 52. Absorbed overheads will be month-wise units produced, the quarter-wise units produced into 2 rupees. So I will be getting the figures respectively. So now for first quarter, there is no under or over absorption. Second quarter, what has happened? Actual overheads is 52, but I have accounted how much? 60,000. So now what has happened here? There is going to be an 8,000 rupees of over absorption. Are you clear with this? Which means what? I have accounted for 60,000 rupees of overheads. Ideally, I should have accounted for only how much? 52,000. So now what should I do? I should add back 8,000 rupees to my profit. I have already accounted for more cost. Reduce your cost. If you reduce your cost, your profit will increase. So add back this 8,000 in Q2. Are you clear with this? In Q2, I added back. Now what happens here in Q3? You should have accounted for 52. Till now, you have only accounted for 48. So now you go and further include a cost of 4,000. If you further include a cost of 4,000, your profit will reduce by 4,000 now. That's why they have put it within the bracket. Clear with this, guys? And in the fourth quarter, you should have accounted for 52,000. That's your actual, but you have absorbed 60,000. You have considered a cost of 60,000 rupees. So now what has happened here? Now you have over absorbed. You have already accounted for a more cost of 8,000. Now reduce your cost by 8,000. Or in other words, a reduction in cost will only increase your profit. Your profit should stand increased by 8,000 rupees. Are you clear with this, guys? Are you clear with this? So now, having considered all these things, now you find out that your overall profit under your absorption costing system is going to be 52,000, 56,000, 52,000 and 72,000. Are you clear with this, guys? Any problem here? Any issues here? Right? Now comes the most interesting part of this entire discussion. That's the final part of it. Now the profit under absorption costing is 52, 56, 52 and 72. Right? Now, what is the profit under marginal costing system? It is 52,000, then 44,000, then 60,000 and 76,000. Right? Now what happened? Why is there a difference in profit reported under the absorption costing system and the profit reported under the marginal costing system? Can anyone tell me? Why is there a difference between the profit reported under the marginal costing system and under the absorption costing system? Can anyone tell me, guys? Can anyone tell me why is this happening? Yes, Ramya, can you tell me? Yes, Bharat, anyone? Tell me, guys. Yes, you can even use the chat box. Come on, tell me. Why is there a difference in profit reported under the marginal costing and the profit reported under the absorption costing? In both the methodologies, the units sold, everything, units produced, stocks, everything was the same, right? Cost also didn't change. But what happened here? Now, some of you might be thinking it is because of under or over absorption. under or over absorption? Absolutely not.
Because of fixed transaction cost.
Yes, very good, right? So yes, it is because of the fixed cost. Now let me come to it. If some of you are thinking it's because of under or over absorption, it is not right, because in marginal costing, what we do, we have no concept of absorption, right? Directly, whatever is the actual fixed cost that hits my P&L, correct? In absorption costing, what we do, we first absorb something, right? That is different from actual, but at the end of the year, we match it with the actual by doing an under or over absorption. So technically speaking, even in absorption costing, finally the fixed overhead that has entered into my profit and loss statement is also actuals here. Are you clear with this? So it is not the under or over absorption that causes the difference in profit. Then what is the reason for the difference? The reason for the difference between the profit reported under marginal costing and absorption costing is wholly and solely the fixed cost lying inside my net stocks. The fixed cost lying inside my net stock. So what do you mean by that? Now, you see here, always absorption costing, right? In our example, values every unit of stock at 6 rupees, whereas marginal costing values every unit of stock at just 4 rupees. Correct, guys? Right? Now, what happens is, right? Let us say I am having a closing stock. I am having a closing stock here, right? In a particular question, I'm having a closing stock. Now, what happens? This closing stock, let us say I have 1000 units, right? Each of these 1000 units are valued at 6 rupees by absorption costing, whereas they are valued at only 4 rupees by marginal costing. This closing stock is on the credit side, correct? So if there is a closing stock, what happens? Obviously, the credit side will be more under absorption costing, because of which the profit under absorption costing will be greater than the profit under marginal costing, correct? Suppose instead of this, I am having an opening stock of, let us say, 1000 units, right? Each of these 1000 units will be valued at 6 rupees under absorption costing and 4 rupees under marginal costing. Anyways, whether it's on the opening stock or on the closing stock, the stock valuation will be done higher by the by absorption costing system as compared to marginal costing system. It depends on which side it is. If you are having a net closing stock, right, then marginal costing will be reporting a higher amount on the credit side, and hence your absorption costing will be reporting a higher amount on the credit side, and hence absorption costing will be reporting a more profit. If there is a net opening stock, right, more the debit side, it means what? Obviously lesser will be your profit. Now absorption costing will be reporting a lesser profit. Or in other words, now in this scenario, if you see in our example, in the first case, what happened? How much was the opening stock? 0. How much was the closing stock? That was also 0. So the net stock was 0. Opening, closing, both adjusted together, it was 0. Since there was no stocks here, if you notice, the profit reported under the absorption costing and marginal costing was the same. Are you clear with this? Now, in the second situation, what has happened? Do I have an opening stock? No. Do I have a closing stock? Yes. I had 6000 units as a closing stock, correct? Now, closing stock is on the credit side, correct? And absorption costing values every unit at 2 rupees more, correct? No? So 6000 into 2. So absorption costing has a higher amount of 12,000 rupees on the credit side, because of which, to the extent of 12,000 rupees, absorption costing's profit will be more. That's why marginal costing was 44, right? The absorption costing's profit was 56. Are you clear with this, guys? Are you able to understand this? Similarly, in the third quarter, what has happened? There was an opening stock, right? Opening stock of how much? 6,000. There was a closing stock of how much? 2,000. If you see net of the two, there was a net opening stock of 4,000 units. Correct, guys? Right? And each of these 4,000 units would have been valued more. Always absorption costing only values more by 2 rupees right? 4,000 into 2, 8,000 rupees. The debit side was more in absorption costing by 8,000 rupees. So more the debit side, it means what? Lesser will be your profit. So now your absorption costing will be reporting a lesser profit to the extent of 8,000 rupees. So look at this. That is the reason why absorption costing was reporting only 52 while marginal costing was reporting 60,000 rupees. Are you clear with this, guys? Are you all able to understand this? And finally, if you see, I think that is also another scenario. Yes, you have what? An opening stock of 2,000, a closing stock of 0. Once again, this fourth quarter is also a scenario where you have a net opening stock. So 2,000 into 2, 4,000 rupees more on the debit side, which means a lesser profit as per absorption costing. So absorption costing would have reported a lesser profit to the extent of 4,000 rupees. Look at this. Absorption costing has 72,000 rupees of profit, whereas your marginal costing is reporting a 76,000 rupees of profit. This is what we have reconciled here. Are you clear with this? We have taken opening stock, we have taken closing stock, and we have taken the net stock. Are you clear with this? If I am putting net credit, it means that it is lying on the credit side. That is, there is a net closing stock. This case, the third case, is going to be a net opening stock, right? And the fixed cost sitting inside the next net stock is going to be 2 into the net stock. Are you clear with this? So this is going to be the reason for the differences between your absorption costing and your marginal costing profit. Are you all able to understand, guys? Are you all able to understand? This has been explained here as a conceptual, as a concept point. Just a minute, let me just show this. Look at this. Have they given it anywhere here? Okay, I don't think it's been mentioned. Okay. Now let me just write a conclusion here. Please write it down if you want. Now, yes, when opening stock is equal to closing stock, right? So the marginal costing profit is equal to absorption costing profit. Correct, guys? Correct, guys? Or let me just put it, let me keep absorption costing as the base. Absorption costing profit is equal to marginal costing profit, right? Or when there is no opening stock and closing stock, even then my absorption costing profit is equal to marginal costing profit. That is, there is no net stock. No net stock can be can happen in a scenario when you don't have any stocks, or when your opening stock is exactly equal to your closing stock. Clear with this, guys? Suppose my opening stock is greater than my closing stock. That is, now my debit side is more in your absorption costing. When the debit side is more, the profit will be less. What happens? The absorption costing's profit will be lesser than the marginal costing profit. Why? Because absorption costing always has higher only, right? That higher you should see whether it's on the debit side or the credit side. If there is a net opening stock, absorption costing will be having a higher debit side, which will report a lesser profit. Suppose if the closing stock is greater than the opening stock, now absorption costing has a higher credit side, which will increase its profit. So absorption costing's profit will be greater than marginal costing profit. Are you clear with this, guys? This is the conceptual understanding of the differences between your absorption costing and marginal costing. Are you all able to understand this? Are you all able to understand this, guys? Yes? You guys have got this? You guys have got this? Right? And that is about this entire chapter. We have taken about 4 hours approximately, right? And we have covered almost the entire chapters. I mean, the revision, obviously it was revision, because in our regular lectures, as I told you, we'll be doing more than about 35 numerical problems will be done, along with detailed explanations for every single concept. But here we have touched upon all the major aspects. There are even some small aspects that we generally cover in the regular batch, but of course in a revision we can't cover everything. But the maximum extent possible, that has been covered here, and I hope you guys are also clear with all the concepts that we just finished. Fine, guys, right? And with that, we are concluding with this particular chapter called as the mighty marginal costing. Right? Have we left out anything? Can you guys just check and let me know? Have we left out anything? I hope I've covered everything. All the concepts mentioned. Let me just see. Yes, I think yes, I've just ticked up everything. Yes, guys, and that's about this chapter. Please don't fall into the trap of mugging it up. Marginal costing is an absolute beauty. It's an absolute beauty. So now, guys, have you all understood it? Are you all getting the confidence in this chapter? Are you all getting the confidence in this chapter? Please use the chat box. right? Please use the chat box. Tell me, let me know, are you getting the confidence in this chapter? Is there even a single formula to be mugged up? Absolutely not. There is not even a single formula to be mugged up, right? Please tell me, guys, are you all clear with this, right? Even if you are later on watching it on a recorded mode, please use the comment box or on the comment section. Please tell me whether you have understood this or not, right? Fine, guys. Fine, guys. I hope you found this very useful. Fine. Done. Great, guys. Great. It's good to know. It's good to know that guys are getting a lot of confidence in this. Superb. Great. Fine, guys. Done. So now let's break now for lunch. So it was super comprehensive, I suppose. So now let's break for lunch. So just imagine in a revision batch we have covered this much. So in a regular batch, actually the coverage is going to be much 5-6 more times of what we did here right now. So this chapter is so mighty. Which one, ma? Ramya, you're asking me how did you get the figure? Which one?
The last questions calculation of overheads under the option. Observe overheads 52,000, 60,000.
How did I get the absorbed overheads amount?
Yes.
One second. How did I get the absorbed overheads? One second. I've mentioned it there. No, it's nothing but 2 rupees per unit into number of units produced. Now, quarter wise, the figures are available. One second, ma. So let me clarify that before we break. I think you're asking about, yes, this one, I suppose. Are you talking about this one?
Yes, sir.
Yeah, actual units into predetermined rate. So predetermined rate is 2 rupees. Actual units, I am having it here. So production is 24,000, 30,000, 24,000, 30,000, right? So multiply that.
How did you get the predetermined rate, sir?
Predetermined rate is 2 rupees. Of course, that is what is mentioned here. The fixed cost they have given, no? This is the standard cost per unit. This is the cost per unit they have given. That should be based on predetermined rate only.
Okay.
Yes. Right? Clear. Fine, guys. Done. Okay, if you hadn't attended this revision class, I would have probably mugged up the formulas. Mugging up in costing and FM, not just this chapter. Any chapter mugging up is a crime. It's a crime. So no, you don't mug up. Don't do it. It never works out. Trust me, guys. I'm saying this is the smartest way to prepare for your exam. Right, sir? I'm not going to take this costing field and all. I'm not asking you to take it only. That's your wish, your choice. For exam preparation only, I'm telling you, mugging up is definitely not a shortcut. It is not at all a shortcut. In fact, the shortmost cut of all the cuts is going to be your, the logical way of understanding. So that's how it works, guys. Do this for all the subjects. Trust me, at the time when you're doing it, you might feel that you're a little slow, but that is a permanent solution. Else, it's going to be number of attempts only. Now, honestly, I'm telling you, I don't want you guys to fall for it. Don't, try to mug up something that can be easily remembered by way of logics. Why do we want to do that? So this is a fairly simple way of doing. So now, anytime, even in midnight, someone is asking you for the formulas, logically you can think and tell them on the spot. That's all it is. Why do you have to take the pain of remembering things? Okay, done, guys. Fine then. Okay, superb. Right, guys, can you make a video on what is that? Second, someone has texted something in call messages. 1 second. Can you make a video on question paper analysis? Yes, wait. I'll do all of that later on. These are separate, right? This is a revision batch, so I will be doing it separately on the channel. So don't worry about it. I'll post videos on that. You need not have to worry. Yes, definitely will be done. Strategy video, I think that's what you're asking about in terms of which chapters are important. We will do it. Don't worry about it. Right, guys. Fine. Then we will we'll break now. And we will get started at 1:45. It's 12:45 now. We'll take an hour break.
Okay.
Right. We'll meet back at 1:45 and we'll start off with the next mighty chapter, process costing. Process costing is not as big as this, but again, there are so many things. The basic things, the fundamentals of process costing itself is kind of, I think it still remains a mystery for many people. They don't even know why they are doing, this concept of equivalent units and also beautiful logic again there. So yes, we will be seeing it. Maybe we'll break now and I'll meet you guys at 1:45, right? Around 1:45 we'll meet. Thank you guys. Thank you so much. I will see you all. Come back again. It's going to be the same link. So I'm not going to change any links and all. This streaming will continue. Okay. Right guys, take a break now of 1 hour. Please inform your friends as well. The ones who are still in break. Tell them the break is done now. Let's start, guys. Let's start. Shall we? Well, the strength on YouTube Live is less. Looks like it's not just a long lunch break, it's been a heavy lunch break, I guess. Why have the number of students who turned up is less? Okay, I think we're good to go. Yeah, I hope I'm audible, right? Ramya, I'm audible? Yeah.
Yes.
Okay, and the YouTube folks as well, hope I'm audible. Please inform your friends as well. Oh, okay. Yes, okay, Aarti, thanks for confirming. Okay, right then, let's get started. So now, let's start off with the revision of the next chapter, which is process costing. Now, first, let me tell you, let me give you a background of this chapter. But before that, so this chapter is slightly heavy in terms of the intricacies and complexities involved. So again, in this revision batch, I will try to touch upon all the important aspects, but let me be honest with you, the depth of the coverage, it's generally done in the regular batch, but nevertheless, this will help you in revising the entire chapter properly, right? Because this chapter is slightly heavy. It's not voluminous, but it's slightly heavy in terms of the depth of concepts involved. So I will just give you an overview of the entire chapter with certain intricacies involved. We'll be solving a few numerical problems as well. Definitely there will be some value addition, but as compared to a regular batch, you can't expect the same level of the depth of knowledge in this chapter, because it requires a lot of time in explaining certain aspects. So here, for a revision, what is required will definitely be done. Clear with this, guys? Now, this chapter, process costing. Now, this process costing, this chapter, is basically an advanced version of unit costing. So what do you mean by unit costing? So an example of unit costing was your cost sheet. That is, what we do is, how do you calculate the cost per unit? You take the total cost incurred for a period divided by the number of units, you arrive at the cost per unit, right? Fine. An advanced version of that chapter, an advanced version of unit costing is only process costing. Now, process costing is generally used by industries where the raw material gets converted into an FG by passing through multiple processes. A typical example for this would be a cement industry, right? If you see in a cement industry, right, limestone is a raw material, right? Just like that, it cannot get converted. It has to pass through multiple processes like grinding, blending, cooling. It has a long process. So it needs to necessarily pass through multiple processes. And the most important part is, now the output of one process is going to be the input of the next process. And the output of the next process is going to be the input of the following process, and so on. Are you clear with this? It has to be a continuous chain. Are you clear with this, guys? Right? Now, let me give you an example. Let me give you an example of this cement industry that I told you. So, in a cement industry, as I just told you, you have a main material which is limestone, right? Let us say I'm inputting 1000 kgs of limestone at the rate of rupees 100, right? So that's going to be 1 lakh rupees worth of limestone, that is the main material I am adding, right? Now this gets inputted into the first process P1 called as grinding. Okay, so there's a grinding process where the stones need to be grinded, right? In this process I add material, I add labor, and I add overheads, right? All these things put together is going to be 20,000 rupees, right? The process one, I'm incurring a cost of 20,000 rupees over and above the main material 1 lakh. In process one alone, I'm incurring a cost of 20,000 rupees. So here also one more material you are adding. You said material is limestone. Yes, over and above that, in process one, they add a new material. Let's say in this case, it's going to be sand, right? So limestone alone will not get converted into cement. You need to add sand to it and it needs to be mixed. So, sir, sand is an indirect material. No, sand is also a direct material, but it is not the main material. Are you clear with this? It is not like a main material. For example, it is like saying, I need to prepare, a bowl of vegetable rice, right? So the main material here is the rice, that is the base. But what I will be doing is I will also be adding vegetables to it, correct? That also adds up to the weight. Here I will say for every bowl of vegetable rice, of course I will be needing rice, which is the main raw material. But yes, I also need to add on some vegetables. I can't call it as indirect material. That is also a direct material, but the predominant weight comes out of my rice. Are you clear with this? This is something like that. Because had it been an indirect material, it would have anyways been included in production overheads. Clear with this, guys? Now, the input, I input the main material, it enters into the grinding process. The output of grinding process enters into the second process P2, which is called as blending. Here once again, I add material, labor and overheads of this particular process. Sir, what material you will be adding? Let's say clay gets added here, right? Really clay gets added, right? So material, labor, overheads, once again I incur of this department. How much is it? Let us say it's going to be 30,000 rupees. The output of blending department now becomes the input of the cooling department, which is going to be P3, right? So cooling department. In cooling department, once again, I add its own material, labor and overheads. Let's say that P3 department or the P3, the process 3's cost is going to be, let's say 50,000. And finally, I get the output. Which is cement, right? So how many kgs I get? So let's say I get the entire 1000 kgs as output of cement. Are you clear with this, guys? Now, the objective of this chapter is to calculate the cost per unit of output. That is, we are here to calculate the cost per kg of cement, that is output, right? Now, sir, what is the big deal again, right? Just now you gave us all the cost data, 1 lakh plus 20,000 plus 30,000 plus 50,000. Total cost is how much? 2 lakh rupees. So can I say cost per kg of cement is going to be rupees 2 lakh divided by how much was the output that I got? 1000 kgs. So per kg it is going to cost me 200. That's all, chapter done. This is what anyways we did in our cost sheet chapter also. Then why do you have a separate chapter called as process costing, right? Clear with this? First, are you able to understand the issue involved here, right? Are you able to understand first the question that I'm raising here? Anyways, you are saying the objective of this chapter is to calculate the cost per unit of my output, correct? Right? That anyways can be done in a simple unit costing setup, that is your cost sheet area. Why do we need a separate chapter called as process costing? Two reasons. Reason number one, now whatever I input need not come out as output. That is, or in other words, there could be some losses in between, correct? Yes guys, there could be some losses in between. Now if the loss happens at the end of grinding department, every unit lost will be valued only at the costs incurred in the grinding department. That is my main material cost plus the grinding department cost. Suppose if the loss happens at the end of blending department, every unit lost would have been incurred a cost of main material plus grinding department cost plus blending department cost. Suppose the loss happens at the end of the third process. In that case, then every unit lost, I would have spent my main material cost plus my process 1 cost plus my process 2 cost plus my process 3 cost. Or in other words, the losses can arise at any different process, at the end of any different process. So now I also need to know, where exactly the loss is happening, based on which the losses can be valued. Are you clear with this? So if I just say, sir, take the total divided by 1000, no. So the units lying at the end of process 1 will not be valued similarly as that of the units lying at the end of process 2. If the loss happens at the end of process 2, then every unit lost at the end of process 2, I would have spent the main material cost, the grinding cost, as well as the blending cost. Whereas the loss happens before itself, then for me, the cost incurred on these units would have been slightly lesser, because I would have only incurred the cost up to this place. Are you clear with this? So the first reason why we are seeing this chapter is losses can be incurred, or you can be having losses at the end of any different process, and the treatment of losses will be different based on where the loss happens. That is number one. Number two, now whatever I input in a process need not necessarily come out as output, correct? Now at the end of the period, maybe some units are still in process at the end of process 1, some units are still at the end of process at P2, some units are still in process at the end of P3, or in other words, I will be having a WIP stock, and the WIP can be happening at the end of process 1 or at the end of process 2 or at the end of process T. If a unit is lying as a WIP in process 2, which means on every unit lying as a WIP in process 2, the cost I would have incurred would have been my main material cost, plus processing 1 would have also been done, plus processing 2 would have also been done to some extent. Whereas if the unit is lying as a WIP here at the end of process 1, then only the main material cost and the process 1 department's cost would have only been incurred. The other 2 and 3 costs wouldn't have been incurred. Once again, the similar thing, the place where my stocks are lying will also play an important role in valuing the WIP. So I cannot just say, WIP is so much. No, you need to know that WIP is lying at the end of process 1 or at the end of process 2 or at the end of process 3, based on which they need to be valued separately. Are you clear with this, guys? So here, though I say that every unit of output needs to be valued, it depends on where they are physically present. Are you clear with this, guys? Because of these technicalities, that is the reason why we have a separate chapter called as process costing. Clear with this, guys? Now in process costing, generally what happens is, so they will ask us to prepare a process account, right, wherein the debit side items will be given. That is the main material. You will be having the ancillary material. I told you right now, right? So here the limestone is a main material, maybe sand is an ancillary material. Then you will be having your labor, you will be having your overheads and all that. The debit side items will be given, right? They will ask us to find out the credit side items. The credit side items would be units completed, right? Units completed and transferred. Units still lying in my closing WIP. There could be some losses also. Those loss could be normal loss. Those loss could be abnormal loss. So the debit side items will be given. They will ask us to find out the credit side items. This is what this entire chapter deals with. Are you clear with this, guys? Are you all able to understand? This is the big picture of this particular chapter. Now, before we enter into this area, first there is one small thing that I need to tell you guys, a small prerequisite or a background. Now, let us just take an example. Let us say I inputted 10,000 kgs, right? 10,000 kgs of some raw material into a process, right? The overall processing cost, meaning what? All the material, labor, overheads, everything put together came out to, let us say, 10 lakh rupees. Okay, let us say it came out to 10 lakh rupees, right? Manoj, can you just mute yourself, please? Thank you. Right. So now the overall processing cost comes out to 10 lakh rupees, right? Just an example I'm giving you. Now what happened? I inputted how many units? 10,000 units. Okay, let us just call it as units. Okay, 10,000 units got inputted, right? And I incurred an overall cost of how much? 10 lakh rupees, right? Now let us say the output that I got was how much? The output that I got was only 9,800 units. The output that I got was only how much? 9,800 units. Clear with this, guys, right? Which means what? Which means I have actually lost how many units? I have actually lost 200 units. Are you clear with this, guys? Are you clear with this? Now, what they are further saying in this question is, see, out of these 200 units, they know that 60 units are normal loss. Means what? Generally, if I am in this business, I know if I input 10,000 units, I know that for sure I will lose 60 units, because that is because of the inherent nature of the particular business, right? But what has happened? Over and above my expectation, the actual loss was not 60, it was 200. So beyond my expectation, how many units have I lost? I have lost how many units? 160 units. It is called as abnormal loss. Are you clear with this? So the units, 140. Yes, I'm sorry. So 140 units is your abnormal loss. Are you clear with this? That is, I know that if I input 10,000 units, I will generally lose 60 units. But what has happened? I have actually lost 200 units. So 140 units were lost beyond my expectation. Are you clear with this, guys? Are you clear with this? Now, how do you value this? How will you value this? First, in this case, what I will do is, so first I should calculate the cost per unit of output. The cost per unit of output. How I will calculate this? Now, it's a very important thing. And one more thing, guys, scrap income is equal to rupees 10 per unit. Means what? Whatever units I lost, I was scrapping it. I can scrap it and generate a revenue of how much? 10 rupees per unit. Clear with this, guys? I'm consolidating the sum. So what we have done, what is the given data here? I am saying that I am inputting 10,000 units, right? And I am incurring an overall cost of how much? 10 lakh rupees, right? And at the end of the day, I am actually getting an output of how much? 9,800 units only, which means I have lost 200 units. Out of this, 60 units, I know it's an expected loss, 60 units, and 140 units were lost beyond my expectation. Clear with this, guys? And every unit that I just scrapped, every unit lost can be scrapped off at the rate of 10 rupees per unit. Clear with this, guys? This is the data given. Now with this data, first we need to calculate the cost per unit of output. Now always remember, cost per unit of output is calculated as follows. It will be calculated as total cost minus normal loss scrap income divided by input quantity minus normal loss units, right? This is always the formula which we will be using. Why? Logic, I will tell you right now, right? So what is the formula for cost per unit of output? Total cost minus normal loss scrap income divided by input quantity minus normal loss units. Now let us put the figures here. What was the total cost I incurred? I incurred a total cost of 10 lakh rupees. Correct, guys? I incurred a total cost of 10 lakh rupees minus normal loss scrap income. Now, I inputted how many units? 10,000 units. At the time of starting the process itself, I knew. At the time of starting the process itself, I knew that I'm going to lose how many units? 60 units. Correct? That was expected, right? At the end of the process only, I knew the actual loss and all. But at the time of beginning itself, I knew that, yes, I am going to incur 10 lakh rupees, correct? And I'm inputting 10,000 units and I know that I'm expecting to lose how much? 60 units. Each of these expected units will generate me how much? 10 rupees of scrap income, correct? So technically speaking, my expected cost, even before I started the process, my net expected cost was how much? 10 lakh rupees I know I will have to spend. But anyway, 60 units I will be losing, and on each of these 60 units, I will be generating a scrap income of 10 rupees. So my net expected cost will be what? Total cost minus the scrap income generated out of normal loss units. Correct, guys? Because normal loss units are the ones which are expected, right? Abnormal loss are unexpected units. Are you clear with this, guys? Right? Divided by input quantity. How many units I inputted? 10,000 units minus normal loss units. How many units were normally lost? 60 units. Or in other words, this formula is nothing but in the numerator we will be having expected costs. In the numerator we'll be having the net expected cost. At the time of the start of the process itself, I know that my expected cost is going to be how much? I know I will be incurring 10 lakh. I know I will be losing 60 units, and on each of these 60 units I'll be generating a scrap income of 10 rupees, right? The net expected cost divided by the expected good units. Expected good units. That is, I know I will be inputting 10,000, and at the time of starting the process itself, I know that I'll be losing out on 60 units. Expected good units. Are you clear with these? Are not actuals. These are expectations. Clear with this? That's why in costing, stock is always valued at normal cost, not at actual cost, because actuals can have inefficiencies. Clear with this, guys? So now tell me what's the numerator here? What's the numerator here? So it's going to be 10 lakh minus 600. That is going to be 9 lakh 99,400, right? Divided by, so it's 10,000 minus 60. It's going to be 9,940, right? So what is the cost per unit? What is going to be the cost per unit?
100.52.
So how much is this? 100.5433, right?
Yes, sir.
So 999,400 divided by 9940, it just keeps on going. Okay, so it's going to be 100.54333 something. It just keeps on going like that. Okay, fine. Right, clear with this, guys. So technically speaking, what I need to do is every unit needs to be valued at how much? It needs to be valued at 100.5433. Clear with this, guys? Are you all clear with this? Right? But strictly speaking, what happened originally, if you see this, I know that I was incurring a total cost of 10 lakh rupees, right? By inputting how many units? 10,000 units. 10 lakh divided by 10,000 units. You would have thought that, sir, the cost per unit is only 100 rupees, right? But what has happened here? No. What has happened here? My expected cost after adjusting for normal loss scrap income, and in the denominator you had what? Your expected units. That is, you know you will be inputting 10,000 units, but you were also expecting for a loss of 60 units. So technically speaking, every unit of output should be valued only at how much? 100.5433. Are you clear with this, guys? This is the expected cost, and this is always the cost at which we will be valuing every unit of output. Are you all able to understand? Right? Now with this backdrop, what we will do is we will go and do one illustration here. we will go and do an illustration here. Now, let's look at this. Take this illustration, a simple and a basic illustration. Now, guys, look at this. Input was 10,000 units at the rate of rupees 20, right? The labor cost was 1 lakh rupees. The overheads was 150% of labor. The estimated normal loss was 10% on input. Scrap is 5 rupees per unit, and the actual output was 8,500. Now, look at this. How many units did I input? 10,000. How many units did I get as output? It was 8,500, which means the actual loss was how much? I have actually lost 1,500 units. Correct, guys? Out of these 1,500 units, how much was normal loss? How much was abnormal loss? Normal loss was 10% on input, 10% on 10,000. I knew that I will be losing 1,000 units. But what has happened? I have actually lost 1,500, which means I have lost 500 units beyond my expectation. Are you clear with this, guys? Are you clear with this? So technically speaking here, the normal loss is 1,000 units and your abnormal loss is going to be 500 units. Now, how do I put it up in a process account? So basically, I inputted how much? 10,000 units, right? I inputted how much? 10,000 units. Out of these 10,000 units, where are they lying on the output side? If you see, out of this, normal loss was 1,000 units. My abnormal loss was 500 units, and the balance output, right, that I was able to transfer to the next process is going to be 8,500 units. Clear with this, guys? So basically, whatever I inputted, am I at least able to track where they have went? Yes, I have lost something, but at least I have a tracker. This 10,000 units, they are lying as 1,000 units are normal loss, 500 an abnormal loss, and 8,500 as your output. Now look at this. In your process account, how it looks like is, the process account is a stock ledger. It's a stock ledger, right? It's nothing but a WIP ledger. Clear with this, right? Here, obviously, all the costs that are incurred to build my WIP will get debited. Correct. So to material, so the quantity was 10,000 units at the rate of 20. So it's going to be 2 lakhs, labor 1 lakh, overheads 1,50,000. Right, guys? Fine. Now have this thing very important set in your mind. Now immediately what will happen? So technically what has happened is the net expected cost. So how do you calculate the cost per unit of output? The cost per unit of output is going to be the total cost minus normal loss scrap income, right, divided by my input quantity minus normal loss units. Correct, guys? So now what was the total cost? The total cost was 4,50,000, right? So 4,50,000 minus normal loss scrap income. What is your normal loss scrap income? Normal loss units were 1,000. The scrap rate was 5 rupees. So 1,000 into 5, that is going to be 5,000 rupees. Correct, guys? Divided by what is the expected good units? Whatever I had inputted, 10,000 minus the normal loss units of 1,000. So 10,000 minus 1,000. So here what I have is, so finally what I have here is, so 4,45,000 divided by 9,000 units. So every unit is valued at how much? It is valued at 49.44 rupees. Are you clear with this? Right? Now, how do we present it in a process account? First, you will put all your expenses on the debit side, right? Immediately what you do, by normal loss scrap income, 1,000 units I scrapped. Each unit had generated me a scrap revenue of 5 rupees. So 1,000 into 5, that's going to give me 5,000 rupees. So now basically what has happened is my net cost, my net expected cost is only going to be 4,50,000 minus 5,000, 4,45,000. Are you clear with this, guys? Normal loss units are not valued separately. Normal loss units are never valued separately. Clear with this? Because what we are doing here, even in the denominator, we are only valuing 9,000 units. That is all the units except the normal loss units. Correct? No? Right? Because the normal loss units should not be valued separately, but its presence will only inflate the per unit cost of expected good units. Are you clear with this? So technically speaking, in a process account, I will be debiting all my cost, and from that I should subtract what? The normal loss scrap income. That is basically nothing but the formula we used, right? It needs to be presented in your process account as well. right? Now this is represented by way of, so I was expecting how many units? 9,000 units. Where are these 9,000 units right now? Sir, out of this 500, over and above my expectation, I lost, and 8,500 units, I am having it properly with me. So now you can multiply this 49.44, whatever it is, into 500. That gives you this figure. So 24,722, right? Instead of rounding off, if you retain the decimals, you will exactly get this. Similarly, your 8,500 into 49.4444, that gives you how much? 4,20,278. Are you clear with this, guys? So basically, when you're preparing a process account, how it works is, on the debit side you park all your expense, and immediately on the credit side you reduce your normal loss scrap income. Are you clear with this? So this is your net expected cost. Net expected cost. This is represented by expected good units. Expected good units was how much? 9,000 units. So in this case, the expected good units are represented by abnormal loss and what? The units completed and transferred to the next process. That's why they have written it as process 2. Are you clear with this? Sir, abnormal loss, you're calling it as expected good units? Yes. Abnormal loss means what? Originally, I expected that to be a good unit only, but unexpectedly it turned out to be bad. Are you clear with this? So it is also an expected good unit. So what will I do? Each of these 500 units, I will value it separately at 49.44, and what will I do? I will take it to my costing P&L. I will take it to my costing P&L. It's a loss for me. Sir, normal loss is not valued separately. No, because I knew that. I knew at the beginning itself that, look, I'm going to lose these units. Accordingly, I prepared and I calculated the cost of every unit of output. So that's why I said normal loss is not valued separately, but its presence will increase the per unit cost of expected good units. It is being borne by these expected good units of 9,000 units. Are you clear with this, guys? So the cost of 1,000 units is being borne only by, the cost of 10,000 units is being borne only by 9,000 units, which means the cost incurred of the normal loss units are also shared by the expected good units. So hence it is not valued separately. Are you clear with this, guys? Hence, if you see, you don't have anything called as normal loss account at all. In entire costing subject, there is nothing called as normal loss account, because normal loss is not valued separately. If at all you find it somewhere, that is actually a normal loss scrap income account. It's an income ledger. It's not a normal loss ledger. Are you clear with this, guys? Are you all able to understand, right? So now, basically, how do you value your every unit of output? This is the formula we follow always. The total cost minus normal loss scrap income. Visualize that process account. This is how it is, right? Divided by input quantity minus normal loss units. That is nothing but my expected good units. Are you clear with this, guys? Are you clear with this, right? Now what we will do is, we will move on and do the first question, which is question number 1. We will move on and do question number 1. Now slowly we will increase the complexity. Now in process 1, so question number 1, in process 1, 1,000 units were introduced during January and 200 units, 40% complete in all aspects, remained as closing WIP at the end of the month, right? Compute the equivalent production and obtain the cost of closing WIP if the total process costs during the period were 1760. Now what they are saying is, how many units were inputted? 1,000 units, right? And what they are saying, at the end of the month, 200 units were only 40% complete, meaning what? They were lying in my closing WIP, right? And the remaining was all completed and transferred to the next process. In this question, there is no loss and all that. Now, if you look at this, I inputted 1,000 units, right? Out of this, what has happened is, now 800 units were completed and transferred to the next process, right? 200 units were only 40% complete and they are still lying in my closing WIP. Clear with this, guys? Now they are asking you to value, that is, they are asking you to prepare a process account. Is that what they compute the equivalent production and obtain the cost of closing WIP? Fine. Now guys, tell me, guys, how will we calculate the cost per unit? The cost per unit is going to be total cost minus normal loss scrap income divided by input quantity minus normal loss units. Correct? right? Now, in this case, what was the total cost? 1760. What was the normal loss units? Scrap income. First, there is no normal loss only. So, it is 0. Correct, guys? Right? Divided by, what is the input quantity? I have inputted 1000 units. Correct? And what is the normal loss units? That is 0. I didn't expect to lose anything. So, if you use this formula, what is the cost per unit of output that you are getting? So, you will be getting how much? You will be getting 1.76 rupees as the cost per unit of output. Correct, guys? Correct? Yes. Now, what happens here is, now if I do this, what happens here is, now these 800 units, what will I do? So I will say there are 800 completed units. Correct, guys? These 800 completed units will be multiplied with 1.76. What is the value of completed units? 800 into 1.76, that is going to be 1408. Right? And how many incomplete units were there? So 200 incomplete units were there, right? So that multiplied with 1.76, if I do, what happens? So 200 into 1.76. So now what I will be doing? I will be giving it a share of 352 rupees, and total, if you see, it will match with your overall figure of 1760. That is 1760 is a cost that is represented by the units completed and my closing WIP. Now, if I do this, there is one big mistake I will be committing. What? I am valuing my completed units as well as my incomplete units in a similar fashion. Whether it is a completed unit or an incomplete unit, what am I doing? I am giving both a share of 1.76 rupees as a cost. Is this correct? Absolutely not, because each of these 200 units were only 40% complete. First of all, you tell me, can I add this 800 units with this 200 units? No, this is like adding donkeys and monkeys, right? They are dissimilar items, they cannot be added, right? So 800 units are completed units, 200 units are incomplete units. So first of all, why did we end up adding the two? Because we use this formula. That is, guys, in this case, what has happened? The input was how much? 1000 units, correct? The normal loss was nothing was there, right? The units completed were 800, right? And in this case, you had your closing WIP. Your closing WIP was how much? 200, correct? Now, input minus normal loss, right? This way I can compute, or I can say this is represented by units completed and my closing WIP. Agreeing with me on this or not, right? So whether I say 1000 minus 0, or if I can add this individually, both will give me the same result. Agreeing with me on this or not? Now, in this case, what we did, if we use the formula, we are saying 1000 minus 0, we are indirectly, unintentionally adding two dissimilar items. Are you clear with this? So now in this case, you can't use the formula. So this denominator alone needs to be computed separately, and that is the reason why we have something called as statement of equivalent units. So now in the statement of equivalent units, what will we be having? Now guys, in this denominator, this is nothing but expected good units only, no? Right? What they are saying is, look, if you use the formula, right, you will commit a mistake of adding dissimilar items together because each of them have different degrees of completion. So what you do is go and find out which are all exactly your expected good units, track them, convert them all into equivalent completed units, and now you add it. Are you clear with this? So now in this case, I had inputted 1000 units. On the output side, where are they present? Units completed were 800 and units incompleted were 200. So I'm just having a tracker column. Don't think I'm adding the two. This is a tracker column. Whatever I've inputted, I'm able to track it on the output side. Now what I do is, each of these 800 units are 100% complete. So I multiplied the two and I say, okay, so 800 completed units are equivalent to 800 completed units only. Whereas 200 units, 40% complete, can I say is equivalent to 80 units fully complete, correct? Each of these 200, physically I have 200 units, but each of them are only 40% complete. So the cost consumed by 200 units, 40% complete, can I say will be similar to the cost consumed by 80 units fully complete, right? So what am I doing? I'm converting an incomplete unit into an equivalent complete unit. So ideally 200 units 40% complete is only equal to what? 80 units 100% complete. Now can I add the two? Yes. So now what I do, I add up the two. So now technically speaking, my expected good units is 880 equivalent units. Sir, physically I'm finding 1000 units. Yes, but I can't add my completed units and my incompleted units because they have a different degree of completion. So what am I doing? I am still using the same formula, but instead of using it as a formula, I'm going out and finding out which are all the expected good units, converting each and every one of them into equivalent completed units and arriving at the denominator. Are you clear with this? Or in other words, this step 1 called as calculation of equivalent units, statement of equivalent units, is nothing but the denominator calculation of this formula. Why are we using it? Because each of the ingredients of the expected good units are having a different degree of completion. Clear with this, guys? Clear with this, guys? Are you all able to understand? Now what do I do? Now what do I do? Of course, I need to calculate the cost per equivalent unit. Guys, this is what we all need to do anyways, right? Cost per equivalent unit. So how will you find out? So they have given that the total cost is 1760, right? The denominator is how much? Just now we got in step 1 880. So you divide the two, you get what? The cost per equivalent unit as 2 rupees. Right? And now you have a step 3 called as statement of apportionment of cost. So the units completed and transferred, how many equivalent units are there? 800 units. So 800 into 2, the value of the units completed and transferred is going to be 1600, right? And the incomplete units, how many equivalent units are there? 80. 80 into 2, that's going to give a value of 160 rupees. So now whatever was the total cost has now been properly apportioned between completed units and incomplete units. And now step 4 is just a matter of preparing the process account. In your step 4, what will you be having? In your step 4, it's just the process account. I think this is not there. Sorry. So your total cost, that is all the cost, material, labor, overheads put together, is 1760, right? And this is being apportioned between my units completed and transferred and units still lying in my closing WAP. Here I will not be mentioning the equivalent units and all. This is a tracker column, 1000 and 1000. So whatever I input, it should be represented on the output side. I will be having a tracker column, and these values are picked up from the previous step, step 3. Are you clear with this? And with this, I can prepare the entire process account. So to sum it up, I am always use that formula only. But in this case, when I have a closing WAP which has a different degree of completion, so because I cannot add dissimilar items, I am forced to have a step 1 called as statement of equivalent units. That is nothing but my denominator calculation. Clear with this, guys? And once I do that, I now calculate the cost per equivalent unit, which is the step 2. And number step 3 is going to be each of these expected good units will now be valued. That is called as statement of apportionment of cost. This is nothing but my credit side items of my process account, and step 4 is just preparation of process account, wherein the debit side will be picked up from the question and the credit side will be picked up from step number 3. Are you clear with this, guys? Are you all able to understand? This is the 4-step process in process costing. Are you clear with this, guys? Are you all able to understand? This is a very basic level sum. Slowly we will be increasing the complexities. This is why I said this chapter is kind of heavy in terms of concepts. So in a revision, right, whatever best is possible, I'm just trying to give you guys an insight into whatever is important from an exam perspective. But strictly speaking, there are so many other things in this particular area which requires actually a lot of time to learn. But anyway, since this is a revision, I hope that you guys would have already studied process costing to some extent so that you will be able to appreciate the discussion. Clear with this, guys? Clear with this, guys? Fine. And that is about the first numerical problem. Now, so what we did till now was, see, if I don't have a closing WIP, I can directly use this formula. In the example that I gave you, we didn't have a closing WIP, right? So we can directly use this formula approach. Suppose you have a closing WIP, the denominator cannot be calculated as such. So what you need to do, list out each of the components of expected good units, convert them into equivalent completed units and add it up. Clear with this, guys? 4-step approach. What are the 4 steps? Number 1, statement of equivalent units. Number 2, calculation of cost per equivalent unit. Number 3, statement of apportionment. And finally, number 4 is your process account. Process account debit side given in the question, and on the credit side, you will be having what? You will be having the figures that you just got in your step 3. Clear with this, guys? It's a very structured approach. It's a very structured approach. Now, guys, what happens is things slightly get little complicated and little tricky as we proceed into the next few problems. Now, just a minute. Let me just see if I've given this up. Just a minute. 1 second. Okay. Just a minute, guys. Just a minute. Okay. Now, let's move to the next question and see what is there here. The following data are available in respect of process 1 for the month of Feb 20x1. They have given that the opening WIP is 900 units, right? And the value of opening WIP is 4500. The degree of completion they have given with respect to material, it is 100%, labor 60, overhead 60. Input of material, they are inputting 9100 units at a material cost of 27,300. The direct wages is 8,200. Production overheads is 16,400. The units scrapped is 1,200. The degree of completion for the units scrapped is given component wise. Closing WIP 100 units are there. And again, the degree of completion for closing WIP is also given. The units transferred to the next process, that is also being given here. That is units completed and transferred. The normal process loss is 10% of the total input. That is basically your opening stock plus units put in. And the scrap value is going to be 3%, 3 rupees per unit. Right? They are asking you to prepare the process account and all of that. Now, guys, this is where the subject gets little complicated. Now, I'm just representing the sum here. I'm just representing the sum here in a simple tabular format. Now, this is my process account, right? This is process number 1. Okay, process account, process 1 account. Now, see what happens here. What happens here? I have an opening WIP, right? How many units have I got? 900 units, right? Forget the degree of completion. No, first let me just present the question here. In the current period, I am inputting how many units? I am inputting 9,100 units. I am inputting 9,100 units, right? Next, what they have said, now they have completed how many units? 7,800 units. So basically, the total units of input were how much? 10,000 units. That is, I already had an opening WIP. Plus in the current period, I have freshly introduced how many units? 9,100 units. Now, one more thing they have said, units completed fully and transferred to the next process is how much? 7,800 units. that is units completed and transferred, correct? And then they've also mentioned that the closing WIP, how much is the closing WIP? 1000 units are there. So 1000 units of closing WIP are also there. So clearly you have inputted how many units? 10,000 units. But now how many units are actually physically present here? Units completed were 7,800 and still lying in your WIP is going to be 1000. So technically only 8,800 units are present somewhere, which means you have lost how many units? 1,200 units. That is what they have mentioned here, units scrapped. Are you clear with this, guys? Are you clear with this, guys? Right? So they have given it as units scrapped here. So the units scrapped is going to be 1,200 units, and out of this they have mentioned generally 10% of the total input is going to be what? 10% of the total input is going to be my normal loss, which means 10% of 10,000. So normal loss is 1000 units. Expected loss is 1000 units. So over and above my expectation, I'm losing how many units? 200 units. That's going to be my abnormal loss. Are you clear with this, guys? Right? So basically, this is how your input side and output side will be looking. You have an opening WAP of 900, right? And you freshly introduced 9,100 units, right? So that makes your total input equal to 10,000 units, right? The represented on the output side, you have your normal loss 1000, abnormal loss 200, your units completed and transferred 7,800, and your closing WAP as 1000 units. Now, in what way is this sum different from the previous sum? In the previous sum, no doubt we had a closing WAP. The moment you have a closing WAP, clearly it means that you need to use the statement of equivalent units. You cannot use your formula, right? Now, what extra thing we are having in this question is you are also having an opening WAP. Sir, if I have an opening WAP, what is the big deal? Now recall what I told you in cost sheet. When you are having multiple lots of receipts and each of them are valued separately, then stock valuation issues will come. That is FIFO, weighted average and all. In this case, what happens? Yes, you have completed 7,800 units, right? It will be valued at what? Because opening WAP are valued differently. They have given the value of opening WAP as what? 4,500 and all. And in the current year, whatever cost you have incurred are completely different. These are the costs you have incurred. If you average out, the per unit cost will be different. So now how am I going to value this? Obviously, you need to go for valuation techniques. Are you clear with this? In this question, we will be using first in, first out method. We will be using what? First in, first out method. This is one aspect of the question. The other aspect of the question is, now what they have mentioned component wise degree of completion. What is the meaning of that? Now look at this. Closing WAP is how many units, guys? They have mentioned 1000 units are lying in your closing WAP, and they are saying each of these 1000 units are 100% complete with respect to material, 80% complete with respect to labor, 80% complete with respect to what? With respect to overhead. Sir, what is the meaning of this? What is the meaning of this? Now, let me give you a small example for you to understand this. Let's say you are actually boiling, you're boiling milk, right? A bowl of milk, right? Now, let's say that you have on a gas burner, on a gas stove, you have 3 burners, right? So you have 3 bowls, bowl 1, bowl 2, bowl 3, right? So what you're doing is you're going to boil a milk, okay, a bowl of milk. Let us say it takes 10 minutes for the milk to be completely boiled, okay? Let us say it takes 10 minutes for the milk to be completely boiled, okay? Now, what happened was, this stove 1, what you did, you turned on the stove at 11:50 p.m. 11:50 p.m. on 31st March, you are doing this exercise. At 11:50 p.m. you turned on this stove number 1, right? The stove number 2, you turned it on at 11:54 p.m. okay, right? And stove number 3, you turned it on at 11:58 p.m. Just an example I'm telling you. Now, what has happened is, at the stroke of 12, what happens? The year gets over, correct? No, right? At the end of the year, at the stroke of 12, if you see, your bowl number 1 would have been fully boiled. Agree? Yes. So you will say this is a 100% completed product. Now at the end of, at the stroke of 12, if you look at the burner number 2 or bowl number 2, so you started it at what? 11:54 p.m. So only 6 minutes of boiling would have happened. So you will be saying, so this is only 60% complete. Correct, guys? Right? Whereas if you take the burner number 3, you will say it's about, I turned it on only at 11:58. So this is only 20% complete. Correct? No? Right? No. Now, for you to boil the milk, what are all the costs that you will be incurring? Now, 3 costs. One is your material, then your labor, then your overheads. Material will be milk. Labor will be, let us assume you are hiring a chef to perform this job, right? You are paying him based on the time he spends. Clear with this? Then overheads is your stove, your gas burner, your gas charges. Now tell me, in all the 3 cases, so case 1 100% complete, case 2 60% complete, case 3 20% complete. Now irrespective of which burner you are talking about, with respect to material, the entire milk was poured in this year itself. No, correct, guys? Or in other words, can I say, irrespective of whether you call it a WIP or an FG in this case, with respect to the material cost, all the 3 burners or all the 3 the vessels have actually consumed the entire 100% of my material cost. Agreeing with me on this? The cost consumption pattern of your FG or your WIP in this case, just to give an example, right? Irrespective of its degree of completion, what you call, with respect to raw material, in this case, it has completed 100% of what a completed unit would have consumed. Agreeing with me, right? Similarly, but with respect to labor, what will I say? Yes, the first stove, it took what? Entire 100% labor, 100% overhead. It is complete in all aspects. But what about the second vessel, the second bowl? The second bowl, it is only 60% it would have consumed labor and 60% overheads at the end of the period. Correct, guys? Similarly, the third bowl, it would have consumed only 20% of labor and 20% of overheads. Or in other words, what happens is, if I am saying something as WIP, the consumption of resources needs to be seen component wise. That is, if this particular bowl, I'm calling it a 60% complete, it need not have consumed 60% in all the components of cost. You see here, with respect to material, it consumed fully, right? So with respect to material costs, right, it has consumed fully as what a completed product would have consumed, right? Only with respect to labor and overheads, in this case, what has happened? It has consumed partly. Are you clear with this, guys? So now what you need to do, now you need to prepare an equivalent unit, statement of equivalent unit for apportioning each and every component of cost. So using my material cost, how many equivalent units have been produced? Using my labor cost, how many equivalent units have been produced? Using my overhead cost, how many equivalent units have been produced? So I need to look at it component wise. Are you clear with this, guys? Right? So now all this entire exercise now needs to be done for each and every component of cost. That is the first learning in this particular question. Are you clear with this, guys? Are you clear with this? So now what we do here, so first we need to prepare a statement of equivalent units, right? And for the statement of equivalent units, it needs to be prepared component wise. And of course, one more thing, remember, in your statement of equivalent units, you should only consider what? Expected good units. That is all the units except your normal loss units. Are you clear with this, guys? All your units except your normal loss units. This is what needs to be considered here. Clear with this, guys? Now what we do here is, one more thing that is quite important and slightly advanced here is the use of first in first out method. Now what about first in first out method here? Now as you know, first in first out means what? So whatever cost came in first will actually be consumed first. Correct? So first in first out. Correct? So now what I do here is, so the opening WIP value will now fully sit into the units completed and transferred to the next process. Agreeing with me on this? So the opening WIP value, that is the ones that got processed in the previous year and carried forward to the current year, the value of opening WIP would be completely entering into my units completed and transferred. Are you clear with this, guys? So when I am following first in first out method, what needs to be apportioned is only my current period cost. Why? Because anyways the entire value of opening WIP will enter into my units completed and transferred. So the concept of apportionment of cost arises only with respect to the current period material, labor, overhead and all. Are you clear with this, guys? So now in this case, what I will be doing here is, look, so first I will prepare a statement of equivalent units under first in first out basis. Now carefully listen. So what was the total input? Opening WIP 900, units introduced 9100, and a tracker column I tracked down that, look, I have 10,000 units with me, right? This is represented on the output side. Now be very careful. Look at this here. What has happened? I have an opening WIP of how much? 900 units. Correct, guys? Now 900 units I have in my opening WIP. So this breakup I will say, so in the current year I have completed and transferred how many units? The completed units were 7,800. So the breakup of this I will say, this 7,800, out of this 900 units came from my opening WIP, and the balance 6,900 units is coming out of the current period units introduced. Correct, guys? The breakup is given here. Look at this. These two put together is actually units completed and transferred. So out of this, 900 units came from my opening WIP and 6,900 units are coming out of the units introduced. That's why it is written as units introduced and completed. Are you clear with this? Then what is the closing WIP units? That anyways we have 1000 units, right? The normal loss is 1000 and the abnormal loss is 200 units. We are just catching up the tracker column here. So the closing WIP is 1000, the normal loss is again 1000 and the abnormal loss is 200. So whatever I have inputted, first I am tracking down as to where it is being present. Are you clear with this, guys? Right? Now what we do? Now component wise we prepare the statement of equivalent units. Why? Because the consumption pattern changes for each and every component of cost. Using my material cost, how many equivalent units have been produced? Using my labor cost, how many equivalent have been produced? Using my overhead cost, how many equivalent units have been produced? So I need to come up with this kind of breakup. Only then I can properly apportion each and every component of cost. Now if you see, now in this current period, I have completed how many units? I have completed 7,800 units, correct? Out of this, 900 units have come from my opening WIP and 6,900 units have been introduced and completed. Clear with this, guys? Now, in this case, what happens here? Now look at this. They have said that the opening WIP units were already 100% complete with respect to material, 60% complete with respect to labor and 60% complete with respect to overhead, which means what? During the current year, with respect to material, I would not have consumed anything on the opening WIP units because it is already 100% complete with respect to material. With respect to labor and overheads, the remaining 40% would have been complete by consuming the current period cost. Correct, guys? Right? I am repeating, each of these 900 opening WIP units were already 100% complete with respect to material, right? 60% complete with respect to labor and overheads. So which means in the current period, I would not have consumed any material cost on this opening WIP units. With respect to labor and overheads, remaining 40% alone would have been completed by consuming the current period resources. So that's why what I do on the opening WIP units completed, what we do here is with respect to material, I put it as 0. With respect to material, I put it as 0. With respect to labor and with respect to overheads, we put it as 40-40 each. So 1 minute. So they have mentioned it as 8% and all. It is not 8%, it is 0%. It's a typo error. So with respect to materials, the opening WIP units are already fully complete. Now in the current period, on the opening WIP units, I need not do any working with respect to material. So it will not consume any material cost in the current period. But with respect to labor and overheads, it is only 60% complete. The remaining 40% will be completed by consuming the current period's material cost and current period labor cost and overhead cost. So I will take 40% and 40% here. Clear with this, guys? Now, what about these 6,900 units? See, they were introduced and they were completed. They were started from the scratch and they got completed also in the current period. So with respect to material, labor and overheads, they were started from the scratch and they have also been completed fully. So now the consumption will be 100%. These are all completed units, right? Now, what about closing WIP units? The degree of completion is given here. With respect to the closing WIP units, material is 100%. Obviously, when the closing WIP units were introduced freshly, they were started in the current period, but at the end of the period, they could not be completed. Are you clear with this? So now what happens here? With respect to material, it is 100, labor 80 and overhead 80. So you can just take it as such, 100, 80 and 80. Are you clear with this? Now, most important part here is normal loss will not be valued separately. Why? Basically, this entire calculation that we are doing is nothing but the denominator calculation. I should only consider the expected good units. I should only consider the expected good units for the purpose of calculating the equivalent units. What do you mean by expected good units? Input minus normal loss, or in other words, everything except normal loss. So I will not consider normal loss because the cost of normal loss units should be borne by the expected good units. If I once again consider the normal loss here, then it defeats the purpose. Are you clear with this, guys? Hence, the normal loss units will not be valued separately. In your statement of equivalent units, the normal loss will always be nil. Now, what happens to abnormal loss units? What happens to abnormal loss units? The units scrapped, the degree of completion is given 100% and labor and overhead 70%. So the degree of completion with respect to abnormal loss units. What do you mean by abnormal loss units? It was originally planned to be a good unit only, but what has happened? Because of some reason, it turned out to be bad. So the degree of completion 100, 70 and 70 needs to be done here. Sir, what do you mean by this, sir? How can units scrapped, how can it have a different degree of completion? Very simple. The same example I'm giving you. So your mom boiled a milk, right? She boiled a bowl of milk, right? Now what happened? She poured the entire milk into the pan, right? Into the bowl. Now what has happened? It got boiled for 7 minutes. In the 7th minute, she noticed that the milk got spoiled. Now, what will she do? No, it should fully boil for 10 minutes. I will fully boil it for 10 minutes and then only I will throw it off. Or now anyways, I have noticed that it is already spoiled. She will turn off the gas in the 7th minute itself, correct? Now, the loss was identified when it was 70% complete, right? However, with respect to material, it was 100% complete. With respect to labor and overheads alone, it only consumed 70% of what a completed unit would have consumed. Hence, in this case, the degree of completion with respect to material alone was 100%. For my labor and overheads, it was just 70%. Are you clear with this, guys? This is the reason why even for abnormal loss units, you have a separate degree of completion. Are you clear with this, guys? Now, what you will be doing, you will take the respective units, multiply it with the respective degree of completion. So finally, you will arrive at the equivalent units. Or in other words, the material cost, using the material costs, now what has happened? 8,100 equivalent units have been produced. Similarly, using the labor cost, 8,200 equivalent units have been produced, and using the overhead cost, 8,200 equivalent units have been produced. Meaning what? The material cost needs to be apportioned between 8,100 units, labor between 8,200 units, and overheads between 8,200 units. Now, once you do this, automatically what happens is that each and every component of cost gets properly and evenly apportioned based on their degree of consumption. So that's about the step 1. Now comes the step 2. In your step 2, what will you do? So material cost was how much? 24,300, right? The material cost was 24,300. How did you get this? Wait, look at the question here. Now, in this case, what have we got? The material cost was, yes, they have given 27,300. That was the material cost here, 27,300. But wait, recall, we are still in that formula approach only. But because we are not able to use the formula, we are putting it in under a different statement approach. Now in the numerator, what will you have? The total input cost, yes, the total cost of the process minus normal loss scrap income. So the normal loss scrap income needs to be adjusted. In this case, how many units of normal loss were there? The normal loss were 1000 units, and each and every normal loss, each and every unit was scrapped at 3 rupees. So 1000 into 3, 3000 rupees. What needs to be done? It needs to be subtracted from my overall material cost, and I have the material cost net of scrap income as how much? 24,300 rupees, right? The labor was 8,200, overhead was 16,400. These are all the costs, each and every component wise cost. Now the material cost should be apportioned between how many equivalent units? 8,100 equivalent units. Take it from step 1. Similarly, your labor should be apportioned between 8,200 equivalent units, and overhead should also be apportioned between 8,200 equivalent units. So now what happens? The material cost per equivalent unit is going to be 3. The labor cost per equivalent unit is going to be 1, and the overhead cost per equivalent unit is going to be 2. Or in other words, if a product is fully complete, it should get a share of 6 rupees as the total cost. Are you clear with this? And that is about the step 2 of this particular the equivalent question. Right now, the next one talks about the statement of apportionment. Now, guys, in the process account, if you see, what are all the expected good units I've got? Everything except the normal loss. That is, I have three different components of expected good units. That is my abnormal loss units, my units completed and transferred to the next process, and I also have a closing WIP, right? Now each of these figures need to be valued separately, right? That is, I have a separate step called as apportionment of cost that deals with how I'm going to value each and every component of the credit side. Now in this case, you see, first we are going to value the closing WIP. How will we value the closing WIP? Very simple. Step 1 into step 2. Now closing WIP has consumed how many materials? So closing WIP has consumed 1000 equivalent units of material, and every equivalent unit of material should be given a share of how much? 3 rupees. So now look at this. So 1000 into 3. So the material value sitting inside closing WIP should be 3000 rupees. Clear with this, guys? Similarly, in case of labor, how many equivalent units were there for labor? 800 into 1, that gives me 800 rupees. Similarly, for overheads, it is going to be 800 equivalent units into 2 rupees per unit, that is going to give me 1600 rupees. So overall, if you see closing WIP, right, the cost consumed by closing WIP is going to be 3000 rupees of material, 800 rupees of labor, and 1600 rupees of overheads. So the overall closing WIP should be valued at what? 5400 rupees. Are you clear with this? Now, what about abnormal loss? Similarly, in abnormal loss, we know that you can go to the step 1 and you can find out, look, there are 200 equivalent units for material, 140 equivalent units for labor, and 140 equivalent units for overheads. So there you have the respective equivalent units, multiply it with the respective cost per equivalent unit. So now you will be getting the total value of abnormal loss. Are you clear with this, guys? Now finally, about the units completed and transferred. Now this is where you have 2 steps. Now here, basically, how many units were completed and transferred? I think it's 7,800. No? Yes, look at this. We had 7,800 units, right? Out of this, 900 units were opening WIP completed, right? And the remaining 6,900 units were what? The 6,900 units were units introduced and completed. Now, each of the units introduced and completed, 6,900 units, were started from the scratch, correct? So if you look at this, it was 6,900, 6,900, 6,900. That is, with respect to each and every component of cost, it was 6,900 in all aspects, right? So multiply that with fully 6 rupees per unit, because each of these units were started from the scratch and they were also completed by the end of the year. So now what happens here? So 6,900 into 6, this is going to be 41,400. This is the cost pertaining to the units introduced and completed. Are you clear with this? How about the opening WIP of 900 units? Wait. Opening WIP of 900 units were partly completed in the previous period and the remaining were completed in the current period. How, sir? How do you know that? Because it is given in the question, no? Opening WIP, the degree of completion was, it was complete in all aspects with respect to material, But labor and overheads, only 60% was completed the previous period. The remaining 40% we completed only using the current period cost. Correct, guys? So now here it has a two components here. Look at this. It has a current period cost and it has a previous period cost. The previous period cost is nothing but the value of opening WAP itself. Clear with this, guys? The value of opening WAP is how much? The value of opening WAP is going to be what? 4,500 rupees. That is the value of opening WAP. I think they have taken a lot of, one second, I think there's a calculation error here. One second, guys. This is notes. This is 4,500. So sorry, guys, there's a calculation mistake. I just request you to make a correction. Yes, there's a calculation mistake here. It is going to be 4,500. It is not 45,000. They have taken the wrong figure here. It's going to be 4,500. Now, the previous period cost is nothing but the opening WAP value already processed in the previous period. Now, in the current period, the remaining 40% of labor and overheads alone got completed, right? That's why in the current period cost, if you see, material is 0. Labor and overhead, how have we got this? You go to the equivalent units. Look at this. 360 equivalent units were produced by consuming the labor, and 360 equivalent units were produced by consuming the overheads figure. So now 360 into 1 plus 360 into 2. This is going to be your breakup for labor and overheads. 360 into 1 and 360 into 2. So 1080 is going to be your value of opening WAP now completed. Clear with this, guys? Value of opening WAP now completed. So it's 1080 plus 4,500. So that is going to be a total of 5580, right? I think they have given a wrong figure here. One second. They have just is it tallying, guys? Can anyone help me out with the figure? Is it tallying? One second. Let me just do the calculation. Units completed. I think some mistake is here in the typo error. So it's 41,400 plus 1080 plus 4500. So okay, the total is correct. 46,980. Correct. This is correct. So what they have done is they have added everything. So 41,400 is the value of units introduced and completed, right? Then opening WIP's current period cost is 1080. Previous period cost is 4,500. So all these things put together, 41,400 plus 1080 plus 4,500 is going to give you 46,980, which is the overall value of units completed and transferred. So basically, guys, this 6,900 units were fully manufactured using the current period cost of 41,400, right? This 900 units, what happened? Partly were produced by consuming the previous period cost of 4,500 rupees and partly by consuming the current period cost of 1080 rupees. So overall, the value of these units completed and transferred of 7,800 units is going to be 46,980. So now if you look at the process account, what they do is these debit items are all given in the question. Your opening WAP, value of material, value of labor, value of production overheads, all these are given. Immediately what we do is normal loss scrap income 1000 into 3 that we will reduce. So basically this will be what? This will be my net expected cost, my numerator calculation. Clear with this, guys? This will be my expected cost. This is going to be my numerator calculation, right? And now this is represented by expected good units. What are the expected good units? Units completed and transferred 7,800, that is transferred to the next process. That's why they have written by process 2. Your closing WAP of 1,000 units and your abnormal loss of 200 units. And how do you get these figures? Go refer step 3. So units completed and transferred, the value is 46,980. So this is the figure. The closing WAP value is 5,400. This they have just populated it here, and your abnormal loss is going to be how much? 1020. This is going to be your abnormal loss. Okay, again here they have done some mistake, I guess. It is, isn't it 1020? Isn't that right? Yes, I think this also they have done 1020. Please correct it, right? Everything else is correct. Clear with this, guys? So basically your process account, This figure is your net expected cost, and this is going to be your output side. Are you clear with this, guys? So your step 4 is the easiest step because debit side are given in the question and credit side you can find it from your step 3. Clear with this, guys? In most of the cases in process costing, what is the observation that I have made is that, you know, if you get your step 1 correct, that is your statement of equivalent units correct, the entire sum, you will mostly, the chance of getting it right is going to be almost 95%, unless and until you do some silly mistake. The entire question you will get it right, provided you get the first step correct. If the statement of equivalent unit is wrong, the entire sum is gone for a toss. Clear with this, guys? Clear with this, guys? Right? Yes, Surya Kumar. Okay, sir, will you please tell the abnormal loss of 70%, how it came? Which one you want, ma? 70% of abnormal loss, as in, see, they have given it in the question, no? Abnormal loss, the degree of completion. See, abnormal loss are basically units scrapped, and the degree of completion of units scrapped is given here. With respect to material, it's 100%. Labor and overhead 70%. It is given in the question, right? So since it is given in the question as 70%, we have taken. Suppose the question is silent, you assume that the loss is getting identified only at the end of the process. You take all material, labor, overheads as 100% complete, right? That is how you need to take it. If the question is silent, that's how you need to take it. Okay, will the method be to be used? Will it be mentioned in the question? It might be mentioned. If not, you can use any method. That shouldn't be a problem. Clear with this, guys, right? Now, this is predominantly about this particular segment of your the predominant portion of process costing lies here. The 4-step approach, guys. What are the 4 steps involved here? What are the 4 steps involved here? I have just summarized it and I've mentioned it here. Look at this. Look at this. Debit the process account with all the expenses. Immediately credit the process account with your normal loss scrap income. You remember this? Yes, this amoeba you draw. Fine. So this is going to be your normal loss scrap income. Then calculate the estimated cost per unit. Then find the value of abnormal loss, abnormal gain. Adjust the normal loss account with cash or abnormal gain. So basically that is what they have mentioned. And whatever it is, calculate the expected good units. Your expected good units could be your abnormal loss units, units completed and transferred to the next process, and your closing WAP. This is what it is. I think I had mentioned the 4-step procedure here somewhere. Yes, look at this. The 4 important statements of your process costing is statement of equivalent units, statement of cost per equivalent unit, then your apportionment, statement of apportionment, and your process account. This is nothing but your denominator computation. This is nothing but numerator upon denominator computation, right? Once you find out the cost per unit, find out the credit side items, and now you prepare the process account. Clear with this, guys? It's a very structured approach. Now, whatever I have done here is just on a bird's eye view, because process costing is such a chapter that requires a huge level of intricacy, right? It requires a lot of numerical examples to be explained. But what I did here was I picked the topmost sum in such a way that it covers all the major adjustments. Clear with this, guys? Not all the adjustments have been covered, but I have taken the major adjustment and I have covered it. Now, one more small area is there in this particular chapter, that is called as waste multiplier. What do you mean by waste multiplier? Now look at this. This was a past exam question, once tested for 5 marks, right? So it's like an easy puzzle only. So nothing great here. Look at this. What they have said, suppose, so there are 4 processes, A, B, C, and D. Now what they are saying is, in process A, the normal loss will be 25% of its input. Process B, the normal loss is going to be 20% of input. Process C is going to be normal loss is going to be 20% of its input, and process D, the loss is going to be 16.67% of input. The question is, what will be the initial input required to produce 4000 kgs of the final product? What they are saying is, I have 4 processes, A, B, C, and D, right? If I input something in process A, right, the output of process A will become input of process B. Output of process B will become input of process C. Output of process C will become input of process D, right? And finally, they are saying, I want an output of 40,000 kgs, right? At the end of process D, I want an effective output of 40,000 kgs. They are asking us how many kgs should be inputted at the beginning of process A. This is what is being asked here. Are you clear with this, guys? Now they have also given that if you input some units in process A, 25% will be normal loss, which means only 75% will come out of it, right? And whatever gets inputted in process B, of that 20% will further be lost, and whatever you input in process C, out of that 20% will be further lost, and whatever you input in process D, out of that 16.67% will be lost. So now they are saying, I want an effective output of 40,000 kgs. How many kgs should I input at the beginning of process A? Very simple. What you will do is, let the input in process A be 100. Okay, right? Now they have given that the normal loss is 25, which means what will be the output, guys? Hello, the output will be how much? 75 units, right? Now this output of process A will be the input of process B, right, guys? Now in process B, 20% of its input, which is 75, is going to be lost. How much is that? 75 into 0.2, that's going to be 15. So net off, what do you get as an output from process B? 75 minus 15 is going to be 60. Now this is going to be the input in process C. There I further lose another 20%. So 20% on 60 is 12. So what is the output of process C? It's 60 minus 12. It's going to be 48. Now this 48 is going to be the input for process D. And out of this, 16.6666% is going to be lost in process D. So 16.666% on 48 is going to be 8. So technically I will get an output of only how much? 40 rupees at the end of process D. Now 40 units at the end of process D. So now what they are saying, if you input 100 at the beginning of A, you will get an output of 40 at the end of D. Correct, guys? So if I input 100, right, I will get an output of how much? 40. They are saying they want an output of 40,000 kgs. Now how much input should be done? So if 40,000 is equal to 40, how much is going to be 100? So 40,000 divided by 40 into 100. So we can say that overall, only if you input 1 lakh kgs at the beginning of process A, after all the losses, effectively you will get an output of 40,000 kgs. Are you clear with this, guys? This is called as waste multiplier. You just keep on accumulating the waste, and you finally find out the net input to the output ratio, and with that you can see how much kgs of raw material should be inputted to get an effective output of whatever is given in the question. Are you clear with this, guys? Yes, you guys are clear with this? Done? Right? Now that is about this particular chapter. Now guys, this particular chapter is slightly heavy. Now please be very clear about this. I have seen students skipping this chapter. So generally in a revision batch, I generally don't take process costing because process costing is one such chapter that requires a lot of explanation, and of course if at all it needs to be done in a regular batch. But still I did it here because I've been getting a lot of messages from students asking me to specifically do this chapter. That's the only reason why I at least wanted to cover the major areas, the important areas, and the logical reasoning behind every steps involved, right? That is the reason why I did process costing here, because the moment you take process costing, it's not like the other chapters where at least you can quickly give a brief introduction and move on to it, because in a revision batch that's what generally happens. Whereas in process costing, you need to start off with something called as treatment of losses, and slowly I increment it, and in a regular batch it takes about 10 hours for this particular chapter itself. It cannot be properly diluted, so as in it cannot be given as a nutshell. If I enter into it, it's going to be very huge, but still I made an attempt just to give you a big bird's eye view of this particular chapter. Now I think there are two other sums. I think I asked the DTP person to keep 2 questions. I think they have also kept some other questions here, but anyways, I had planned to discuss these 2 main questions and the waste multiplier in a revision batch for a simple reason that if at all you are left with about 1 or 2 weeks away from the exam. Now what I would suggest, let me tell you. Now, if you already have attended my regular batch or elsewhere, or you've already prepared process costing, in that case, yes, definitely please do practice a few more numerical sums in this area. No, sir, I do not know anything about process costing. I'm just left 1 week away from my exam. You do the other chapters, and if you still have time, you come to this. This would be my suggestion with respect to process costing. This chapter alone, I would say, because it is not from an exam viewpoint or anything of that sort. It has so much depth of concepts involved in it, right? If you notice, even in a regular batch, I would have told certain things. If you were learning it for the first time, maybe even marginal costing or other chapters you might have appreciated by learning it for the first time, but process costing, it definitely requires at least one time of preparation from your side. That's when the process costing can be understood, because this chapter is slightly heavy in terms of the conceptual background and the conceptual knowledge required. So what I would suggest is, right, for those who feel that, for those who have already learned this chapter once, yes, this is going to be like, definitely you practice a few more sums in this regard. For those who are just 1 or 2 weeks away from the exam and you feel that, sir, I am not very sure or confident about this chapter, you finish the other chapters, right? Focus so much on the other chapters, and if you have time, you come back to this chapter. Clear with this, guys? Clear with this, guys? Yes, you guys are clear with this, right? Fine, guys. Done. So, yes, you have a doubt here. Tell me now.
On which basis we did the previous sum in FIFO method, sir?
Okay, so on which basis we did the previous sum on FIFO, based on FIFO method? Okay, so based on the data given in the question, that would be the answer. Again, that's what I would say. If I have to explain that, that's going to be one big explanation, not for a revision batch. That's why I wanted to be very, very concise with respect to this. Anyways, since you have asked, let me just tell you, let me just give you a bird's eye view again on this. Now you ask me on what basis did we do the sum on FIFO method. Now this was based on the figures given in the question. Opening WIP data, they have given only the degree of completion with respect to each and every components of cost. Had it been a weighted average question, they would not have given it like this. They would have given component wise how much is the cost. That is, they have given the value of opening WIP is how much? 4,500, right? Had it been a weighted average question, they would have given us the breakup of, out of this 4,500, how much is material, how much is labor, how much is overhead. So the breakup, cost wise breakup, component wise breakup of opening WIP, if it is given, then the sum needs to be done under weighted average. If you look at this, the next sum, actually they would have given it opening WIP, they didn't give you a single figure, they gave you component wise breakup. In that case, it needs to be done under weighted average. Clear with this, guys? Right? That's how it needs to be done. See, that's why I didn't want to confuse you much, because generally a revision batch is something students watch just before the exam. So I should not do something because I know it, right? And at the same time, if I'm not able to, condense something and give it to you, I would rather not do it in a revision batch. That's what I would generally prefer. So this is the reason why I stopped here at this particular, just by taking up the major areas and covering it. Clear with this, guys? Because this chapter is kind of, it requires a lot of explanations, to be very honest. In your regular batch, if you see this chapter, every single thing we will be seeing with a lot of numerical examples. Here time is a constraint. That is the only reason why I try to cover the major areas and I'm leaving it here. Clear with this, guys? But all other chapters can be easily condensed and presented, whereas this particular chapter has this particular limitation by itself, right? It's a normal loss, inherent nature of process costing. Okay, done, guys? Fine, done. Any other doubts? Any other doubts you've got? Inter process profit important to look on? Okay, I can only tell you based on the past exam trends, not much. But again, if I say something is not much important, then if it comes in the exam, I know what you guys will do. You will pull the top 3 generations, the next upcoming generations. So you will pull everyone, my ancestors and all, you will start scolding. So based on past trends, I think it has not been tested for that frequently. That's all I can say. It completely doesn't guarantee that it is not going to come for your attempt. So it depends on your luck. That's what I would put it as. Else then I'm the one to suffer. So okay, right? Inter-process profit, that's what. So it is not been tested much, but it can come. See, there is nothing called as important or unimportant in a CA exam, because generally what we feel as less important, is what interested is the institute is really interested on, because if you omit something and institute gets to know about it, that is the first concept they would like to test. So there's nothing called as important or less important. But yeah, this is the bird's eye view of the overall chapter. It's like what we have seen right now in this revision class of process costing is just a trailer. It is just a trailer. So in actually the real big picture is only seen in the regular batch. So I am admitting that only with respect to this chapter, it needs to be condensed like this. Okay, fine guys, done. Anything else? Right, so then we will sign up for the day. Okay guys, fine. So now we are done with these chapters. Rest of now we are done with what? So cost sheet, right? Overheads, ABC, marginal and process costing, right? So this is what we have completed as of now. So now tomorrow, that is in part 3, we will be having service cost accounting systems and material costs. By the way, I told you, so the first 2 days are live. So these 3 chapters will be premiered. And of course, even in day 4, you have standard costing, budgets and unit batch and job costing. The day 4 will also be premiered, right? And again, here also for the remaining chapters. So the recordings are pertaining to our this one, the revision batch that I took. The recordings have come up really well, and I'm going to premiere that. Very much applicable for your upcoming exam. So don't think that some random recording I'm giving you. I would rather not give you a random recording just for the sake of making it count and all. Absolutely not. These are also going to be very much applicable for your exams, and especially the standard costing lecture. The standard costing, that alone comes for about 4 hours. The entire chapter is covered here by way of this revision. Clear with this, guys? Right? Fine then. So I'll see you all tomorrow on the premiere. See you all so much. Bye bye. Yes, anything else? Can you please take MCQ plus theory in live? MCQ plus theory in live? That's not quite possible right now. Definitely I'll give a premiere. Don't worry about it. All the MCQs will be covered. All the study material MCQs will be covered. Do not worry. Thank you, sir. It was a great conceptual learning. Okay, ma, thank you. Thanks for your efforts. Okay, great. Anything else, guys? You want to ask me something? Yes, I will still be around for the next 5 minutes on YouTube live. You guys want to ask me something? Any doubts here? Thank you, Ramya. Thank you, Aishwarya. Thank you, Harija. Yes, thank you, Moti. Yes, Aarti, thank you. Great, guys. I hope you guys found it useful. You guys found today's session useful as well. And in fact, we have covered the entire marginal costing. Almost all the important concepts in marginal costing have been covered. So yeah, savior for South Indian students. Okay, right. Okay, thank you. Okay, by the way, guys, one more thing. I am basically from Tamil Nadu. For those who don't know, my name sounds like a North Indian. So nothing wrong in being a North Indian, but I just want to make it clear. So I'm from Tamil Nadu. I'm a proper Tamil person only. Mother tongue and all is Tamil only. Thank you, sir. It was really value added. Okay, ma. Thank you, Ashwant. Okay, great. Anything, guys? Anything that you want? Anything that you want to ask me? Any doubts? Or shall we just wind up? Joint and byproducts weightage. Well, this is new syllabus, boss. Not even the institute can tell you that. So I don't want to give you a false hope, but could be somewhere between 5 to 10 maximum. Maximum, I'm saying, not beyond that. Because just imagine you've got some 15 chapters, and for that, anyways, 30 marks is going to be MCQs. So out of 120, 30 marks MCQs, remaining 90 marks, 15 chapters. There are so many important chapters to be tested. So definitely, these are the main chapters for sure. Join and by employee cost. I'm not saying it will not come, but yes, we are predominantly covering all the main areas. So nothing to worry about it. I hope Shankar Ramakrishnan. Yes, I hope I have clarified your question as well. Right, guys, fine then. See you all in the premiere tomorrow. So we'll be posting the next 2 days as a YouTube premiere. Please do watch it. Trust me, it is also going to be effective. It is not like, okay, so this guy is not going to come, so I'm also going to skip. Don't do all that. Definitely it's going to be a value addition. If there is no value addition, I would rather not post it. So there will be a value addition, so please do watch that as well. Fine, guys, so thank you all. Thank you so much. Can you please tell me the sequence of preparation in 1.5 days? You mean your exam study leave? I'll make a separate video on that. So how to utilize the time between MCQ and practical part? If you have a conceptual learning, I think the MCQs are already sorted for you. So I don't think some separate level of effort is required. What I would suggest is, anyways, in the Institute Board of Studies portal, they have taken a good initiative with respect to having this a dashboard wherein you can also attempt some case study based MCQs. I think that is the best thing that can be done right as of now. And of course, I'm anyways going to give you guys the MCQ discussion from our regular batch, about 150 plus MCQs. I think that is more than enough. And you having a conceptual clarity of the subject, I think anything that comes in, you will be able to handle it. That's the open secret of how to handle MCQs, right? Okay. Yes, I think that's all. For theory, we have to study every chapter. Don't study, don't open your textbook and read line by line. In costing, it doesn't work that way. So what you can do is, anyways, I'm going to do the theory, I'm anyways going to premiere the theory as well. You just follow that, that will be enough. That is nothing but a compilation of past 5 RTPs and exam questions with respect to the theory. So theory itself, you prepare it like question and answer format. Don't read line by line. That will be a waste of time for costing subject, I'm telling you, because anyways 30 marks MCQ. Apart from that, some theory comes in. Yes, it might come in. Now if it comes, then again, don't leave it as a choice even before entering the exam hall. You just be prepared. Some important questions, important as in every chapter, at least the past 5 RTPs and MTPs theory question, you just go through it once. That will do, because in costing it is just about conceptual learning and putting it in your own words. So do not try to mug up anything for the sake of theory. Yes, that's about it. For theory, we have to study every chapter. I think I just answered that right now. Okay, done. Okay, right, Manoj, I think I've answered your question. Priyanka, yes. Yes, Jay Shri Ram is also done. Okay, guys, fine then. Right, guys, all the very best. Don't worry, I'm not done yet. I will definitely come up with some preparation videos as well. So strategy video as well before your exam. As someone asked me, how do you spend those 1.5 days, right? So stay calm. Don't be too worried about your exam right now. Rather, you can spend that worrying time on preparing. That's about it, right? So your results will be taken care of by itself if you focus on the controllables. So just focus on what you can do right now. Don't worry about the results today. Right, guys? Fine then. I'm signing up. I'm signing off. Thank you so much. Thank you so much. It was great to have you all here. Thank you, guys. Bye-bye.